Just as a diya spreads light, NJFIO seeks to educate future leaders on factor investing and mutual funds. And now, without any further delay, let's get this event started. To share NJMC's vision and officially welcome you all, please welcome the co-founder of NJ Group, Mr. Jignesh Desai.
Hello. Hare Krishna. Hare Krishna. Very good morning. First of all, congratulations to all the team, those who have participated in this competition, and many congratulations to all of you, those who are today qualified for the grand finale. At NJ, as you all know, that we started our company in '94. In 1992, the private sector mutual fund entered in India. And if you look at before that, the medium of savings for the Indian citizens were mainly post schemes like KVP, NSC, monthly income scheme and all. Apart from that, bank deposits and Unit Trust of India, largely Unit 64 Master Gain Master Plus. After this new version of regulation in 1992, all the open-ended schemes, open-ended mutual funds entered in our country. When we started, the industry was close to around 50 crores, and today it is around 75 lakhs crores. So now it's a huge industry. But unfortunately, 85% of the money is from urban areas, and there are only 5 crores investor in mutual fund. And if you look at the total number of investors who participated in Indian capital market is close to around 12 to 13 crores. And on other side, if we see, there are lots of gaming applications where their subscriber base is more than 25, 30, 40 crores. So I think going forward, we see a huge scope in this industry. And there is a role of a asset management company, a mutual fund distributors and other agencies as well. So our idea is to take this mission forward and to reach out to the masses, to reach out to the people, those who really need this kind of a product. So wish you all the very, very best and warm welcome to this event. Thank you. Hare Krishna.
Thank you, Jignesh sir.
Now, to walk us through the journey of NJFIO Season 2, we would like to call on stage Mr. Nirmay Choksi, Director and Head of Investment at NJMC.
Thank you, Ashvi, and very good morning to all of you. And I welcome all of you to the grand finale of NJ Factor Investing Olympiad Season 2. It's a great honor and privilege to welcome each one of you, all the dignitaries who are present over here, the chief guest of our event, Mr. General Bikram Singh, ex-chief of Army Staff, our esteemed judges, Mr. Dhirendra Kumar, founder of Value Research, Mr. Sashi Krishnan, director at NISM, all the co-founders of NJ Group, Mr. Neeraj Choksi and Jignesh Desai, all the board of directors of the NJ AMC and NJ trustee companies, independent directors. I would take the names as well. Mr. Imtiaz Ahmed Pirzada, Mr. Sanjay Nayak, Mosmi Nandidhar, and Devesh Pathak. Also, all the elite partners of NJ Wealth who've come from different parts of the country specifically to attend this event. I welcome you all as well. I hope you all have a great day and enjoy this very, very eventful, power-packed day that we're going to have today. And obviously, all the employees of the NJ Group, employees of NJ Asset Management Company, employees of NJ Wealth and other group companies, I heartily welcome you all to the grand finale of NJ Factor Investing Olympiad Season 2. And lastly, a huge round of applause to all the 8 finalist teams who made it to the grand finale. It was an extremely competitive, cutthroat competition, and I'm glad that we are back again with the second season of the NJ Factor Investing Olympiad, and these guys were going to present their strategies today. They've proven their mettle, they've proven why they are distinct from the rest of the participating teams, and that's the main reason why they are here. So I'll be talking a bit about the NJ Factor Investing Olympiad. I'll be, laying a context, throwing some light on the Factor Investing Olympiad, how it started, how it culminated into an event at such a scale. So can I please get the presentation? So before we get the presentation, I would just throw some context about NJ Factor Investing Olympiad. So as the name suggests, it is a 100% factor-based, rule-based investing competition. It is I am very, very proud to say that NJ Asset Management Company is the only asset management company in this entire country that is 100% into rule-based investing across its mutual fund as well as PMS businesses, and we manage about 11,000 crores in assets in totality. And as a service, as our duty, we believe that we have to spread knowledge, we have to spread awareness about factor investing to the masses, and obviously we start with the brightest minds of our country, and that is the main reason how this entire factor investing Olympiad, this thought germinated and it started into this competition. So if I talk about this year, the season 2 of NJ Factor Investing Olympiad, it was a very, very exciting competition. As Niharika and Ashwi were talking about it, that 57 teams, all the brightest minds of the top premier institutes, business schools and management institutes across the country, they participated in this competition from 35 different B schools and colleges across the country. And what they had to do, so as I said, it was a completely rule-based, 100% rule-based investment competition, and they had been given a case study. The assignment that they had been given was regarding an asset management company. They had to think of themselves as the founding fathers, put themselves as in the shoes of a founding father of an asset management company, and create a 100% rule-based portfolio for their flagship mutual fund scheme for their first NFO. And these were some of the points related to that. As I said, 100% rule-based asset management company launching their first NFO. And the objective of this competition, unlike last year where we had 2 distinct portfolios, the participating teams had to create 2 distinct portfolios. One was an aggressive portfolio for a family office, a high risk, high return kind of a portfolio, and the other portfolio was a moderate, low risk portfolio for a pension fund. This year it was slightly different, and they just had to create, as I said, one flagship product, one flagship scheme. And that flagship scheme, the thought process was to prioritize on the consistency of returns, to not to be the star performer, not to be the top performing scheme, or in the category or in the industry, but rather be a consistent performer. And the idea was to generate a moderate, inflation beating real return of about 3 to 4%. And because it was of a moderate kind of a risk nature, the product that they had to create, the expectation was that the teams create a portfolio that does not have a temporary loss of capital. In simple terms, it does not have a maximum drawdown of more than 40%. The capital that should get wiped out in a short period of time due to temporary market crashes should not be more than 40%. And also it should have a lower volatility than the benchmark, and also it should recover quickly. It should fall lesser than the market, it should fall lesser than the benchmarks, but at the same time it should recover quickly as well. And overall, as I said, because it was a moderate risk tolerance kind of a product, so the idea was that the teams create a portfolio that in any scenario does not lead to a loss of capital of the investors over a holding period of 3 years and more. So there should not be any loss of capital over a period of 3 years and more. And it obviously was their flagship mutual fund scheme, and as we all know, SIP is basically the core of mutual fund investing, the core of retail investing through mutual funds, wealth creation through mutual funds. And that's why these teams had to create a portfolio which was also appropriate for generating good long-term consistent returns through the modes of SIPs and not just lump sums. And obviously there's if we look at the industry, we know that there are more than 40-45 asset management companies. It's a very, very crowded competitive market, so they had to think of themselves as actually launching their own 100% rule-based AMC in this market, and how they are going to uniquely position their portfolio. So regarding their overall strategic positioning, their future roadmap, their go-to market strategy, those were also very, very important elements of this competition. And all the teams, all the participating teams, 57 teams that participated in the season 2, they had to submit a report questionnaire. So it was a set of questions pertaining to their portfolio methodology, pertaining to their philosophy, pertaining to their overall strategy and positioning, and how they've constructed their portfolio. And basis that, we shortlisted these 8 teams. And obviously they also submitted a fact sheet and a video pitch as well along with that. And some of the key points or rules regarding the competition was, as I said, 100% rule based, and the teams were free to choose any mutual fund scheme of their choice from all the subcategories that are available within equity as well as hybrid categories as per SEBI, except for certain restrictions, which was number 1, arbitrage funds in case of hybrid schemes, and sectoral and thematic funds within equity schemes, excluding the quant fund category obviously. But other than that, these were the certain restrictions, and then they were free to choose all the whatever kind of strategy that they wanted to. And within the equity portfolio that they create, they had to create a portfolio from the investable universe of Nifty 500, NSE 500, which are the top 500 companies by market capitalization. They had to use that index as their main investable parent universe and create a portfolio of equities within that. And at the same time, they were free to use mixture of gold and debt. So we had given them an MCX gold index, and we had also given them a Nifty 5-year GSEC index. So they were free to use those indices as well for the exposure to the gold and debt asset classes. And we had given them the access to our proprietary research platform, the NJ Smart Beta platform. I'll be talking a bit about that as well I'm sure many of you already know about it, but still for the benefit of everyone, I'll just take you through that. And we had set a backtesting period from 1st of January 2006 to 31st of May 2025. So this was a set backtesting period. Within that, the teams had the flexibility to have a shorter backtesting period should they wish to do that, but still they had to justify why they had chosen that specific backtesting period. But if they wanted to start before 2006 or end their backtest after 31st of May 2025, and that was not allowed in this competition. And as I said, effective positioning and their strategy was also very, very critical. And also one of the most important aspects was their regulatory compliance, since they were acting as a founding father of an asset management company. So we made it even more practical and challenging that they cannot just create any portfolio. They have to create the portfolio, the strategies as per the mandates, as per the regulations, as per the restrictions and the guidelines that are mandated by SEBI, which is our regulator. So that was also one of the very, very important aspects. So talking a bit about the Smart Beta platform, as you all are aware of, the NJ Smart Beta platform is our proprietary in-house research platform that has been created right from scratch by our in-house IT team under the leadership of Mr. Lakil Vyas, who is our Chief Technology Officer. And it's a huge repository of data. We have data spanning more than 25-30 years in time, and that data consists of the data of all the NSE 500 companies since the inception of that index back in 1995. So it's an index of 500 companies, but all the unique companies that ever came in that index right from its inception in 1995, we have the entire repository of their fundamentals as well as their market data, their consolidated financial statements, their standalone financial statements, P&Ls, cash flows, balance sheets, their corporate actions, their dividends, stock splits, bonuses, and all their market data as well, their close prices, open prices, high, low, adjusted prices, unadjusted prices, their volumes, turnovers. And we've used this entire repository, aggregated this data set into a very, very beautiful front end, which was given to the participants as well, which is known as the Smart Beta platform. And the beauty of this platform, the beauty of this overall backtest engine is that, let's say if I get any idea that I want to test this strategy, I want to see if I want to create a, let's say, portfolio of 50 companies from the universe of Nifty 500, I want to select those 50 companies, let's say based on their 9 months momentum and their free cash flow yield. I want to give a 70% weightage to their 9 months momentum and 30% weightage to, let's say, the free cash flow. This is just a set of random ideas that are coming to my mind, so I'm just giving an example right now. And let's say I want to rebalance the portfolio on a half yearly basis and give an allocation to each of the companies in the portfolio based on their 9-month momentum. So it's a simple set of rules. It's a simple idea that I got, and any such kind of idea, any dynamic idea that we get, because of the beauty and the dynamism of this platform, we can test it very, very effectively. I'm going to show you some data as well, how much data crunching and back testing these teams have done over these past 1 month when they were given the access to the platform. And just to put on another context, like because of this dynamism of this platform, the NJ Asset Management Company's research team has backtested more than 23,000 different strategies over a period of about 2.5 to 3 years. So kudos to that platform. And if I talk a bit about its usage, because coming from research, I like to look at data, I like to put some charts. So I'll just talk about this very, very interesting infographic that we have on this slide. So this shows the comparison of the portfolios that were created by the participants in the season 1 and what was the growth. And I am very, very happy and proud that there was a colossal 300% increase in the number of strategies that were created by the participants. Huge round of applause to each one of them. While in absolute terms, if you see, The participating teams were 69 last year, and this year it was 57. But clearly the quality of the teams that we got, their dedication and commitment and their tenacity is clearly demonstrated in this very simple data point. And 260 portfolios, as I said, were created last year, which led to a more than 300% increase to 1053 strategies, 1053 portfolios being back tested just over a span of 1 month, which is extremely amazing. And because of that, the the average portfolios that were created per team also increased more than 4x, from about 4 portfolios in the last season to more than 18 portfolios in this season. So it's a huge growth in the usage of the platform. And even if I talk about the finalists versus the non-finalists for the season 2 itself, and there is a great distinction, and you can clearly see that out of the 1053 strategies that were tested by all the 57 teams this year, only these 8 teams tested around 450 strategies with an average of 56 strategies, average of 56 portfolios back tested per 8 finalist teams, as compared to 12 for the non-finalists and a global average of 18. So huge round of applause once again for all these finalist teams. Clearly shows why they should be over here. So I'll talk a bit about the timeline of NJFIO. If I talk about it, so as I said, it started from this very simple purpose, the purpose of spreading awareness, the purpose of creating awareness and education related to factor investing in academia, in among the brightest minds in the country. And if I talk about season 2, and the journey more or less started somewhere in April 2025, when we started the college visits, we started prospecting for the NJFIO season 2. Then if I talk about the registration period, then we had started the registrations in 5th of May 2025, and we kept it for about 40 days, from 5th of May to 15th of June 2025. And we had given them this access to the Smart Beta platform that I was talking about on the 17th of June 2025, where on which date the case study of the season 2 was also released. On the 19th of June, we conducted a digital welcome event, a digital orientation session for all the participating teams. And on the 2nd of July, we opened the submission window. So they did not have to submit their reports directly from the 17th of June. Rather, we had given them a leeway of about 2 weeks, where they can, study more about the case study, explore the platform, or get acclimatized to that platform, get, understand the nuances and the features of the platform in depth, and start their submissions from 2nd of July up to 18th of July 2025, when we close the submission window and also revoke their access to the platform. On the 1st of August this month, we announced the top 8 finalist teams, and trust me, it was a very difficult job for us as well. The evaluation committee, it was a evaluation committee of about 6 to 7 people from the research investment functions, and trust me, looking at all the other participants as well, and the kind of work that was put in by all the people this time, all the participants this time, it was a very difficult task for us. And finally, here we are today at the grand finale. Yesterday on the 22nd, we had an orientation session and a briefing session for the students at our NJ head office, and today here we are for this power pack day. So wouldn't take a lot of time. I'll just quickly introduce our very esteemed panel of judges, starting from Mr. Dhirendra Kumar. And I am very happy, sir, that you took agreed to come for the judge as the judge for NJ Factor Investing Olympiad Season 2 once again. And he was also one of the judges last year, so very grateful for that. And if I talk about Mr. Dhirendra Kumar's profile, he has a rich experience of more than 3 decades in the mutual fund industry, and he is the founder and CEO of Value Research. I am sure most of you all are aware about Value Research. You must have, researched about different mutual funds and stocks, or, read multiple articles, high quality content on value research, because it is one of the best information as well as data providers pertaining to mutual funds in the industry. They have their flagship magazine known as the Mutual Fund Insights magazine, which is a monthly publication. They also have their Wealth Insights magazine, which is also one of their monthly flagship publications. So he'll be one of the judges. Along with Mr. Dhirendra Kumar, I am very happy to welcome Mr. Sashi Krishnan, who is the director at National Institute of Securities Market, NISM, and he also has a very vast experience of about 40 years, more than 40 years in this industry. And prior to joining NISM, he has also played a pivotal role as a CEO of Aditya Birla Sun Life Pension Management Limited. He was also a CEO at National Pension System Trust, and also he has had various stints in multiple other organizations such as Bajaj Allianz Insurance Company, DBS Bank, and DBS Cholamandalam Asset Management, and UTI. So vast experience across life insurance, across asset management, and as I said, about 4 decades of experience. So very well versed. And lastly, we have our own very co-founder of NJ Group and the chairman of NJ Asset Management Company, Mr. Neeraj Choksi, as the third judge for the NJ FIO Season 2. And as you all know, he's the founder of NJ Wealth, the largest mutual fund distribution company in India, which he started with his college roommate actually, Mr. Jignesh Desai, and they're managing more than 2.7 lakh crores of assets under management, serving about 40 million 4 million customers, and have a distribution network of more than 50,000 people across the country. And over the years, NJ Group, as you all know, you were told about it in the orientation session yesterday, has forayed into multiple lines of business now, into insurance broking, asset management, which is one of the new businesses which we started in 2021 with our first mutual fund scheme. And also, other than insurance broking and asset management, we have an NBFC business, NJ Capital, where we provide loans against this units of mutual fund schemes. And other than that, we have also forayed into certain businesses other than financial services. So these three esteemed judges would be judging all the 8 finalist teams once we start the presentation soon. I know you all are very excited, so not gonna keep you all waited too long. And they'll be judging them on a set of predefined 8 predefined criteria, and those criteria pertain to the different aspects that I just talked about, ranging from their investment philosophy to their strategy, to their positioning, to how they've constructed their portfolio, what factors, what parameters they've used in this their portfolio, their flagship scheme, how they're gonna market it, how practical that portfolio is to execute in the real world, what are the challenges that they may face in terms of impact costs and execution and trading costs, and also how well they've adhere to the regulations, and of course how well they present their strategy, their pitch to the judges, and how coherently they answer the questions by the judges. So before I end this presentation, it would be incomplete if I don't take a few moments to express my earnest gratitude to each of the team members of NJ Group, who has been an extremely pivotal person in this entire journey. If I reflect over the past 2 to 3 months, or 4 months rather, it has been an incredible journey, and it wouldn't have been possible without the participation, the collaboration of the people of the NJ Asset Management. So starting from Bhavik Shah, a huge round of applause for Mr. Bhavik Shah for spearheading the entire NJ Factor Investing Olympiad, right from all the mundane and cumbersome coordinations during the registrations, to the ideation of the case study, to the execution, and even till today. Huge round of applause. Also huge round of applause to Ashwi Shah, who also supported Bhavik and played a very, very pivotal role in, creating this NJFIO season to a grand success. Niharika Javeri along with Ashwi Shah for, hosting today's event. Also, the entire research team, core members of my research team, obviously Bhavik along with him, Mr. Raj Mehta, Divyajit Dhadal, Krishnam Mundra, Vineet Nandwani, Dhaval Patel, Viral Shah. Huge round of applause to all of them. Despite their busy schedule, we took the time off to, evaluate in depth each of the nuance of the assignments that were submitted to us. Also, sincerest gratitude to all the coordinators, all the POCs for coordinating with the teams, and also, huge appreciation to the investment IT team. As I said, they've done a great job with the Smart Beta platform, not just for the research team, but the way they, created the new features in the Smart Beta platform this time within a very, very limited time. And that is truly commendable. So huge round of applause to Mr. Lakil Vyas and his team, Mr. Kaushik Joshi, Diya Shah, Slesha, Aman. Huge round of applause to all of them. And of course, Mr. Himanshu Modi for all the seamless, communication to all the stakeholders at all the relevant times in a very, very prompt and efficient manner. And lastly, I would also like to thank I will also lastly like to thank Poonam Upadhyay and the entire compliance team for creating a very, very good platform for us and ensuring that whatever we've created, they've given us speedy approvals and also given us very, very good suggestions for the same. And the list is very, very long. I apologize for that, but I really have to thank each and every one of them. So still I'll just share a few more names. Mr. Ankur Marfatia, huge round of applause for him as well. Ankur Marfatia and his entire admin team for, prospecting to all the colleges, meeting all the college professors and the faculty members, and, spreading awareness about the Factor Investing Olympiad, getting all the registrations. And of course, our CEO Mr. Vineet Nayyar and our co-founders Neeraj Choksi and Jignesh Desai for their wholehearted support in this event. And lastly, the man himself, Mr. Samanvay Manyar. I am deliberately taking his name in the ending because he's the guy who stands up in the beginning whenever he has to deliver, and he's always the last man standing. So huge round of applause for him. His team, Utsav Shastri, Rajiv Topiwala, Pallav Desai, all of them, extraordinary execution capabilities and always deliver, never fail to deliver, and deliver way more than what was expected. So that was some, very, very heartfelt, sincere appreciation from my side. And as I said, it is a teamwork, it is a testament of the collaboration, of the spirit of the NJ Group, of the NJ Asset Management Company. So that is all from my side. I wish you all the best of luck. And my question to all the 8 finalist teams, are you all ready? No, I can't hear you. Are you all ready? Great. So let's get started. Thank you very much. All the best.
Thank you. That deep dive sets the tone for the day. Now, let's get to the part that we have all been waiting for, the presentations.
Before we begin, here are the guidelines for today. Each team will get 20 minutes to present their pitch. At the 18-minute mark, the first buzzer will be a gentle reminder to wrap up in 2 minutes. The second buzzer at 20 minutes will signal the end of your presentation. This will be followed by a 10-minute question and answer session by the judges. The judges will evaluate based on 8 predefined criteria. From the strength of your investment philosophy and the clarity of your strategic roadmap to how well you've defined your factors and aligned them with your chosen mutual fund category. They'll also assess the ease of execution, cost efficiency, and the portfolio performance. And of course, the way your team collaborates, presents, and handles the question and answer will also play a huge role.
Alright, let's begin. Please welcome our first team for the day from BIT School of Management, Team X Capital, led by Rahil Gosalia and joined by Kartik Sood, Vaishnavi Ahuja, Navya Beriwal and Akash Bhansali.
Good morning. Good morning to everyone, our esteemed panelists, judges, and all my colleagues. We are Axe Capital Asset Management Company, and we are proud and delighted to announce our flagship fund scheme, Axe Capital Multi-Asset Factor Scheme. Let me run you through our team. I am Kartik Sood. I'm the CEO. I head overall vision and strategy for the firm. Next is our CIO, Vaishnavi Ahuja, spearheading the investment strategy and portfolio design for the fund. Our CFO, Rahil Gosalia, is responsible for the risk management frameworks and he conducts stress tests and scenario analysis. Our CCO, Akash Bhansali, is the custodian for regulatory compliances. And lastly, Navya Beriwal, our CMO, leads data-driven storytelling for the firm as well as the go-to-market strategies. Next, let me run you through what Axe Capital Management Company is about and what truly differentiates us. I begin with our vision. Our vision is to redefine wealth creation by becoming the leading factor-based investing, delivering resilient, sustainable returns that generate confidence among generations of investors. Our mission turns this vision into action. We apply a disciplined, factor-based and multi-asset investment process which transforms market insights into consistent risk-adjusted returns for our clients. We do this through our investment philosophy. We believe that no single asset class can consistently outperform the market. This means that for us, diversification is essential. We have some guiding principles for the same. A disciplined, research-based, factor-based investing, which means that we remove sentiment from our decision making. We have a multi-asset focus. We combine equities for growth, fixed income for stability, and commodities like gold for a macro hedge. Third, we remove behavioral biases via scalable, replicable, data-driven processes, which ensure a structured approach to ensure consistency and transparency to our clients. We do this through 4 key equity factors, a combination of quality, value, momentum, and volatility, a strategic blend of which we believe becomes the most consistent and robust platform and portfolio. We follow a combined blend as a fund for top-down approach, which talks about macro analysis like interest rate cycles, as well as a bottom-up approach, which looks at security-specific analysis for identifying investment opportunities. Finally, and what we believe is absolutely critical, our risk management techniques. We believe in diversification as well as position sizing to avoid portfolio concentration risk. Secondly, we rebalance quarterly as well as required to maintain target allocation and risk profiles. Third, we consistently monitor volatility thresholds in place to manage risk proactively, ensuring drawdowns are stable. Lastly, we monitor correlations across all our asset classes. We want to prevent any hidden risk of buildup.
Let's deep dive into Axe Capital's flagship fund. The first step of the process is to decide between equity allocation or a hybrid multi-asset scheme. We chose the latter, a hybrid multi-asset scheme. The rationale is twofold. First, it embodies Axe Capital's vision of being scientific, investor-centric, and risk-aware. Second, it strikes the right balance between growth potential and risk control. In a pure 100% equity strategy, you may maximize your upside, but it also comes with sharp drawdowns and heightened volatility. In contrast, a multi-asset scheme of equity, debt, and gold is resilient across market cycles. It manages volatility. It manages volatility. It offers downside protection, and it also adapts flexibility to macro indicators.
Talking about talking about the tax efficiency, in case of a pure equity mutual fund, there might be some internal rebalancing or churning, due to which the investor might face some taxable triggers. But in case of a multi-asset allocation fund, in spite of any number of internal rebalancing or churning, there is no tax triggers for our investors. Talking about our Axe Capital multi-asset allocation scheme, since we invest at least 65% of our AUM in equities, we are classified as an equity-oriented mutual fund. Thereby, as per the Indian tax laws, the taxation that we fall into, that we fall under into are as follows. For the short-term capital gains, that is if the investors redeem their units before 12 months, they are taxed at 20%. While if they redeem their units after 12 months, they are taxed at 12.5%, keeping in mind the first 1.25 lakhs is entirely tax-free. This structure is far more superior and efficient as compared to other debt-oriented mutual funds, wherein the taxation goes as per the individual's income tax slab rate, which may go as high as up to 30% plus surcharges and cess. Thereby, multi-asset allocations fund offers best of both the worlds. That is, first, the benefit of equity diversification, the benefits of diversification, and second, the efficiency of equity taxation. Talking about flexibility, as the name suggests, in case of a pure equity scheme, the majority chunk of our AUM is invested in equities. But talking about multi-asset schemes, we are mandated by SEBI to invest at least 10% of our AUM in each of the three asset classes, that is equity, debt, and gold. As for us, we have a variance of investing in investing 65 to 80% of our AUM in equities and 10 to 25% of our AUM in both debt and gold. Lastly, the investor profiles. In case of a pure equity scheme, it is usually designed for moderate to high risk taker investors, while a multi-asset scheme is designed for a varied risk takers.
So now we're going to deep dive into the actual methodology that we used. This slide illustrates our process. We began a three-stage factor process for the selection. We looked at over 30 plus parameters across quality, volatility, momentum, and value. Taking a time period from 2011 to 2025, we assembled monthly returns and factor data for around 200 plus stocks. We then applied a variance filter relative to the Nifty 500. Thereafter, we narrowed down to approximately 100 stocks. We then ran a two-stage multivariate panel regression model with fixed effects to test for significance, direction, and correlation, with excess returns and using a 95% confidence interval as our selection threshold. The factors used in each parameter are ROE, ROA, interest coverage ratio and dividend payout ratio in quality, earnings yield in value, a 12-month price performance in momentum, and a 16-month rolling standard deviation in low volatility.
This factor discipline is applied across macro allocation. We apply this rule-based structure for rebalancing as well. This underpins our stock selection and portfolio level risk management, ensuring that position sizing and turnover remain controlled and transparent. Let's deep dive into the factors now. So for quality, our flagship fund is dominated by quality and momentum, and it is complemented by low volatility and value. For quality, we look for capital preservation and stocks which have stability to meet future payment obligations. For momentum, a longer period is preferred due to preference for low risk investments. For low volatility, it is a value-oriented approach with preference for stable and income-generating stocks in nature. For volatility, we look it is a conservative value approach where we look for stable and income-generating stocks in nature over here as well.
The final set, as we can see, is displayed here. For quality, we combined ROE and dividend payout at 35%. interest coverage ratio at approximately 20% and ROA at 10% over a 5-year look-back period. Earnings yield is at 100% in the value segment. Momentum is, while we tested a 3 and 6 month period, we narrowed it down to 12 months to avoid any cyclicality and high risk tilt. We chose to exclude financial sector stocks, specifically in the quality segment, to avoid any cyclicality, and also given that they have slight differences in accounting. We then used a Z-score that we normalized to get to a composite factor score. We applied a 3% cap to each stock to avoid any concentration risk. This shows that we are choosing factors that are alpha seeking, but also keeping in mind stability.
Compliance for us at Axe Capital isn't just a passive box-ticking exercise, but it is rather a proactive safeguard which ensures that our investors instill their confidence in our long-term strategies. Benchmark selection is one of the most crucial responsibilities when it comes to compliance. Sorry. As for us, our selected Tier 1 benchmark is the mix of 50% equity, 25% debt and 25% gold, wherein the Nifty 500 TRI index is the equity benchmark, the MCX ICOMDEX Gold Index is the gold benchmark, and the Nifty 5-year GSEC government bonds are the debt index. This has been carefully chosen after evaluating multiple peer benchmarks, since this benchmark mirrors our asset mix, volatility index and investment objectives, making it both a true to label and a fair measure of our active management.
Next, for the portfolio construction is the flagship fund. This slide codifies our method. Our primary objective of achieving consistent returns through diversification, focused on moderate risk profile and medium to long-term horizon. So what are the constituents of our flagship fund? Which is dominated by quality and momentum. It comprises combined 70%. For quality, it is 40% and momentum at 30%. The remaining is between volatility and value. Volatility at 20% and value at 10%. The asset mix is equity dominated with 65%, debt at 20% and gold at 15%. We also implement quarterly rebalancing method based on quantitative models and macro indicators, with special attention to replacing stocks that fall out of the factor cohort. We also fix the underlying indices, the Nifty 5-year G6 for debt and the MCX Gold Index for gold. Overall, our portfolio holds 60 stocks with a modified equal weight approach, and as mentioned earlier, a 3% cap per stock to avoid concentration risk.
The line items that are mentioned here, which include ROE, ROA, dividend payout, interest coverage ratio, earnings yield, 12-month price momentum and 60-month rolling standard deviation, along with the indices that we have chosen, are exactly the levers we use to calibrate in this process. This keeps our execution transparent, systematic, and it tightly connects our security selection to the overall portfolio outcomes.
Next, for the portfolio construction is the backtesting horizon. We started from 2011 and not 2006 to avoid the aftermath of the global financial crisis. In 2011, it was a stable macroeconomic and regulatory environment, allowing us to establish a strong foundation for factor performance without noise of major recession. In 2013, there was macroeconomic disruption due to global monetary policy shifts. This led to liquidity tightening and currency pressures. This created a challenging environment where only the most resilient and robust factors would thrive. In 2016, India faced structural reforms, namely GST and demonetization. This altered sectoral and consumer dynamics, creating a volatile and uncertain world, which tested the factor's resilience. In 2020, we were faced with COVID-19, which was a critical test to our factor performance. There were sudden, sharp market drawdowns, which were met with rapid rebounds. This tested the factor's resilience, but along with that, it also tested our factor's performance to rapid and swift recovery. This validated our factor thesis. In 2022, we were met with global inflation and rising rate hikes, which created significant market pressure, creating rising borrowing costs and a shift in risk-return dynamics. Our backtesting during this period shows that our strategy has performed in an environment where traditional asset classes would generally face a headwind.
So how did our fund actually perform? If an SIP of rupees 100 invested monthly was invested today over the period of 2011 to 2025, in our fund it would approximate around 62,000. While if the same amount was actually invested in the benchmark, it would approximate around 45,000. This shows that while we are able to achieve excess returns, we're also keeping in mind to try and get steady income and outcomes for our investors over longer horizons.
Let's move on to the fund performance. There are 7 major metrics that we are tracking, divided into return and risk. For return, there are 3 major ones, the all-time CAGR, the 5-year annualized performance, and the 3-year annualized performance. And as you can see on the slide, they are significantly higher than what the benchmark is offering. The all-time CAGR is at approximately 17%, which is 4.5% higher than the benchmark. When we move on to maximum drawdowns and the annualized volatility, it is close or near to what the benchmark is offering. The max drawdown, which is a controlled drawdown of 21%, and the annualized volatility of 10%. But let's move on to, let's deep dive into the ratios of Sortino and Sharpe ratio. Both of which are again significantly higher than what the benchmark is offering. The Sortino ratio is at 1.3 and the Sharpe ratio is at 0.81.
These risk-adjusted metrics matter because they reflect how our factor design and our rebalancing policy play out in practice. The Sortino ratio, for example, at 1.3 versus the benchmark at 0.86 showed that we are able to achieve excess returns with better protection against downside volatility. A key promise that we provide our investors in a multi-asset factor-driven framework.
This is our equity mix as per the most recent rebalancing. Here, we can observe that almost 1/5 of our weightage is invested in pharmaceutical sectors. We also have a good investment in sectors like FMCG and metals and mining.
As CMO, my role is to ensure that our investment philosophy and unique product differentiators are effectively communicated to the right investors in the right way at the right time. We cater to a diverse set of audience: retail investors, emerging HNIs, and mass affluent and ultra HNIs spread across metro cities as well as tier 2 and tier 3 locations. Our investors have varied objectives. Some seek capital growth, some prioritize stability and income, while many want both. The common thread is that they all value a structured, disciplined approach to wealth creation. Now, if we look at the slide, you will see our go-to-market strategy, which we have structured into 3 phases. Phase 1, which will last for 0 to 2 years, we will establish our presence with a flagship diversified equity fund. Alongside this, we are planning thematic funds tied to India's growth sectors, supported by a basic investor app for onboarding and portfolio tracking. The phase 2, which will last for 2 to 4 years, we are planning to broaden our reach by ESG and sustainability-linked funds and creating demographic-specific portfolios such as for women investors, retirement focus, and Gen Z wealth starters, along with other goal-based investment strategies. This phase will also include the launch of an AI-powered digital advisory platform to improve engagement and personalization. The phase 3, which will last for 4+ years, we will further strengthen our positioning with cross-border investment products, alternatives such as REITs and global ETFs, and a fully integrated wealth platform with predictive analytics and automated rebalancing. This phased approach ensures that our distribution evolves alongside our products. On the traditional side, we are planning to work with IFAs, MFDs, and institutional channels. On the modern side, we will leverage fintech and wealth tech platforms for digital onboarding, portfolio monitoring, and customized engagement. We also see investor education as a core enabler of our GTM strategy. We are planning to produce clear, data-driven content explaining the benefits of factor investing, the role of asset allocation, and the long-term value of disciplined rebalancing. In conclusion, the Axe Capital Multi-Asset Allocation Fund will not just be another product in the market. It will be a disciplined, transparent, and adaptable wealth-building solution designed to perform in uncertainty and seize opportunities with precision. Through consistent communication, targeted education, and strategic innovation, we aim to make Axe Capital synonymous with disciplined, data-driven investing in India.
Thank you, Navya. You've seen how our investor-centric, risk-aware, and method-driven approach is expressed consistently, whether it is through our factor selection, our portfolio construction, our benchmarking selection, or our performance outcomes. We follow a hybrid multi-asset scheme. It gives our investors long-term capital appreciation, downside control, tax efficiency, as well as flexibility, exactly what our investors expect from us. This is all from the team here at Axe Capital. Thank you so much, and now we're open to questions.
Desh, I have a couple of questions. One is that I guess we have not capped the Z score. Flooring and capping is not done. So many a times in a particular factor can be very, very dominating because it can have an outlier, maybe more, far higher than 3. So why you have not capped or done that flooring? You can answer that.
Sir, so the Z-score value that we've selected is that is statistically significant. That is 5%. So whichever factor loaded below 5%, we selected those factors. After which there were multiple factors, and in order to reduce the effect of multicollinearity, we also reduced a few factors. So.
In a particular stock, there is a possibility that one particular momentum can be very, very high, or within the factors, one factor can be very dominating. So that will only reflect in the performance then, or in the portfolio construction. So didn't come across any such scenario where a particular factor was very dominating in the portfolio selection, or a stock used to come because of a very high Z score.
So is it that you are asking about the 3% stock cap?
So you haven't capped that any cap, that is what I...
No, we have capped it at 3%.
Okay, you have capped it.
Yeah.
Okay, fine. Another question is that in quality and value, you have not taken lending companies and non-financial companies. Why so?
Yeah, so in case of qualities, so the accounting procedures for financial companies is quite different as compared to the non-financial companies. So taking for example ICR, interest coverage ratio, for financial companies, we won't be able to value financial companies on the basis of ICR as we would be able to value other companies. So this might skew the entire portfolio. So we have just excluded the financial sector in case of quality. But if you see our portfolio mix, we do have BFSI category as investments.
But there can be certain other factors which can measure quality or value in a lending company, like can have a ROA, which is a quality parameter. Then you have already taken ROA for other non-lending companies. Then ROA definitely is you can also take it for lending companies. Why you have completely avoided that quality and value parameter for lending and non-lending finance companies?
Basically, when we're choosing quality as a whole, we will not explicitly be able to exclude from the sub-metrics for quality. So for example, if you would have to include lending companies for ROA under quality, we would have to include it for ICR as well. That is how it is structured. So that is why we were able to either completely exclude it from quality or completely take it in quality. We were not able to sub-metrically exclude it. So that is why, because of the ICR ratio and how skewed we felt it would be for lending companies in particular, we felt it was better to exclude them completely from quality. Then
also, sir, we have included them in value.
And we have our portfolio does have a good exposure to BFSI companies as a whole. So we felt in the overall portfolio construction, it is not that such a big market like BFSI is not, we don't have exposure to it. So we felt we have adequate exposure through other factors. So in the long run, it should be adequate.
Fine. And what is the expense ratio you have taken, and have you taken that in the back testing?
We haven't included our expense ratio in back testing, but the expense ratios that as per the guidelines are, so we are aware of about those expense ratios, but we unfortunately haven't included them.
That's it from my side.
Really, if you've got a 40% weightage to quality, you will but get pharma at the top of your sort of weight, right? But you know what I was wondering is that you've looked at ROA at 10%, I think interest cost at 20% and ROE at 35%, right? In your factor weight when you're looking at quality. I just wanted to understand one thing is that, you know, the drawdown, primarily if you take these factors, will obviously be very low, right? If you change these these weights, how would your drawdowns have looked? Have you, I mean, sort of modeled that?
So,
because you've also got debt, you know, so the problem very simply is that you're using quality and you're using debt, which intuitively means that you will have lower drawdowns.
yeah, absolutely. So our the risk profile of our investor was such that they required moderately risk. They had moderate risk tolerance.
Right.
So also about the other parameters that you told, we did calculate, we did iterate them, but in our final selection they did not reflect. But yeah, we did calculate. So that's not at the back of our mind, but yeah, we did calculate.
But you know,
on
the
our-
second question I had was, you know, given again 30% weight to value, right? Now, unfortunately today, I mean, even if you remove that non-BFSI exposure, I mean, a large number of, you know, these stocks will have intangibles. I don't see that getting reflected anywhere because, you know, very typically if you had included, say, intangibles, EVB, EBITDA, you may have got, you know, possibly a better outcome. Any particular reason why you didn't look at it? Because, I mean, if you're looking at ROA, I mean, or things like that, you're basically looking at let us say, like companies like IT, software, etc. Somehow get excluded.
Before he answers, I just want to add to the quality point specifically. We did know that adding both quality and that together would reduce in drawdowns. But we felt with the long backtesting horizon that we have taken, which includes so many market cycles as well as COVID-19, we felt that that needs to be added because we did not want even in sub years, for example, to have excess drawdowns at all. So we felt a blanket for a longer horizon, having this in place would be better long term for our investors. So we
So
felt
if I may interrupt, did you do sub-period analysis?
we did look at it, but not
Because
we
you,
didn't
you
do very
gave,
good.
ran me through a whole set of, you know, from this year to this year, this thing happened, from this year to this year, this thing happened. So you also did sub-period analysis?
We have checked year-on-year returns for per
But
year
you didn't
from
do
2011.
sub-period analysis.
Not sub-period, but
So if you
year-on-year.
had an economic downturn, how would these factors work out and what would be factor correlation?
So not specifically, not for sub-periods. We just
Okay.
looked at the years
Okay.
individually.
Right. And lastly, in terms of your performance analysis, you look at Sharpe ratio, if I'm not mistaken. So you did a full period Sharpe ratio. Okay. So you didn't do, again, a sub-period Sharpe ratio for your performance analysis. Okay. And what about the multi-factor performance analysis? Did you do that? And what could you attribute to each factor? Did you do that kind of an analysis over the entire period?
We have it in our Excel, I think.
Okay. No, it's okay. I want to know whether you did that or not. Then
My only question is, you had the opportunity of taking that global financial crisis phase as well. Why did you choose to exclude that?
Yeah, so we specifically chose to
More
exclude.
so for your, the customer or the investor profile, that if they are faced with once in a 15, 20, or maybe 50-year or such occasion, that is the time for which you are, or that is the occasion for which you are preparing this product for.
Sure. Thank you for the question. We did try to analyze if it would make sense to actually include the global financial crisis or not. However, we felt that it was an outlier and it was extremely externally driven, and the way we actually recovered from it was because of a lot of policy interventions. So we felt it was a bit of an anomaly. And when we included, let's say, the COVID-19 and other different things that we walked you through, we felt it more than accounted for just this one specific global financial crisis. For example, the COVID as well that we've included to show that our portfolio actually does show resilience across these different changes.
We felt the recovery for the 2011 financial crisis was very much extended, which is why 2008 financial crisis was very much extended, which is why we felt it is right to start our fund in a more stable macroeconomic environment post all the recession fears of 2011 had done. We still felt like we did take an anomaly into consideration through the COVID-19 pandemic. So when we felt we wanted as the resilience of factors and the robustness of our portfolio, we feel in a period of excess downturns that was covered when we took COVID-19 into account. And so we felt over a long-term horizon, everything was there, taken into account.
And adding on, we also saw one of those portfolios, but the issue was that the returns over the downside risk weren't as high as compared to the period after which it was excluded. Yeah, those are the reasons.
Just can I ask one more question? You know, somewhere towards the end of your slides, you talked about thematic funds and robo advisory. I was just wondering, does factor investing lend itself to robo advisory? I mean, I would be sort of put off if, I have a robo advising me as to, why these factors are the factors that are, best suited to my risk profile.
So the AI advisory platform was during the phase 2 of our future roadmap, which will start after 2 years. So we believe that we would have enough time to backtest our portfolios and actually build an AI platform which can look at the profile of the investors and suggest funds that would suit to the specific investor profile. So we felt that we would be able to cater to a large audience and we would be able to advise a large set of people if we had an AI bot, as well as pair it up with like suggesting it ourselves as well.
Yeah, and one last question I had. This rebalancing which you talked about was a fixed calendar rebalancing.
It was quarterly rebalancing.
It was, yeah, but it's a fixed. No, because you've got quality and value, and unfortunately, what typically happens in quality and value is that, this factor lags. It can have huge lags, So balancing like this could sometimes, create problems. I mean, I don't know whether you thought about that or not. But anyway, it's okay. You do a quarterly rebalancing. I just wanted to ask you that. Yeah, go ahead. Yeah.
Thank you so much for your questions.
Congratulations.
What a strong start to the day. The way you applied multivariate panel data regression to select your parameters was truly impressive. Up next, from Pandit Deen Dayal Energy University, please welcome Team Investing Brains, led by Man Desai, Mehak Mehta, Dev Gandhi, Hina Wadhwa, and Sanjana Mirwani.
greetings to all of those present over here. Before we move ahead to the presentation, we would like to see you a short video that we have conducted as a part of our market research, because we agreed upon the thought of Kurt Lewin that no action should be taken without doing any research. Can we have a video, please?
मेरी एक्सपेक्टेशन ये रही कि रिस्क कम हो, प्रॉफिट ज़्यादा हो, और अगर जिस कंपनी में कर रहा हूँ उसका बैकग्राउंड क्लीन है तो वैसे अच्छा.
But what I've always checked is the mid-cap the firms, if they're doing well in the market, in the current market, how have they performed in the last few years? So, and moreover the returns.
एवरेज मार्केट के हिसाब से, दूसरे फर्स्ट के हिसाब से अप्रोक्स 15% एवरेज रिटर्न होना चाहिए उसमें. लॉन्ग टर्म इन्वेस्टमेंट करे तो गेन अच्छा होना चाहिए और उसमें रिस्क मिनिमम होना चाहिए. वैसा फर्स्ट
mutual fund obviously should give a reasonable amount of return. Should be one that gives me peace of mind.
I guess if I get the right kind of information as to how it's been performing and if the actual returns are like sure shot, yes, I would definitely go for it. I wouldn't mind investing. Okay?
Sure, hybrid fund में investment.
So that's always a welcome idea. And there has been a history of hybrid mutual funds giving good returns to the investors. I think that would be something that I can always explore.
So like while interviewing all these different kind of investors, what we found common in all of them are having the expectation of generating more returns while maintaining the peace of mind. And to fulfill this requirement, we come up with the investing brains, an AMC that smartly believes to invest to the rule-based factor investing. At Investing Brains, we have backtested 100 of the portfolios over a different time horizon to give our investors the best fitted portfolio. As we can see, that match with the ideology of NJ Group also, like we yesterday visited the office visit and we came across that your customer don't care that what you know unless they know how you care. So we have backtested several portfolios to give our investor the best portfolio. Now talking about the brains powering the investing brains. Hi, my name is Man Desai and I am the CEO of Investing Brains, who oversees the strategic direction and its future innovation roadmap.
Hi everyone, my name is Dev Gandhi. I'm the Chief Investing Officer at Investing Brain and I make sure that your heartbeat stays right.
Hello everyone, I'm Hina Wadhwa, the CCO of Investing Brains, and I make sure that our AMC works well within the Lakshman Rekha of SABI guidelines.
Hello everyone, I'm Mehek Mehta, the Chief Financial Officer at Investing Brains, and I make sure that the numbers are right on track.
Hello everyone, I'm Sanjana Virvani, the CM of Investing Brains. We turn our rule-based investing into the trust by building strong partnership and a message that goes beyond returns.
So now talking about our investment philosophy and its vision. So the investment philosophy at Investing Brain is very simple. Invest through the rule-based factor investing that will generate the return over a long term while managing the risk very carefully, because that matches our principle of following the rules and conquering the returns for our investors. Now talking about the investment-centric approach, also the investment-centric approach at the Investing Brain would be focusing on the investor who want to create the wealth over a long period of the time, also while managing the risk very carefully. So to fulfill this, we are going to launch the hybrid multi-asset allocation fund that will invest into the equity, debt and gold in 50:25:25 ratio. Now the question we get is, why just hybrid? So the answer to this question is like, we feel that all these three different components, equity, debt and gold, will provide the best diversification of the risk across the assets. And as we can see over here, how this, through the snapshot that we have attached here, that how these three components have contributed to the returns of the investor. So blending all of this seems just wow option to us and for our investors. Now, next. Now, as likewise any building that gets the strength from four main pillars, right? Similarly, our equity portfolio gets the strength from four main factors, leading with the quality of 35% of weightage, value with the 25% of weightage, and momentum and the low volatility of 20% of weightage each. We ensure that we allocate this weightage to each factor to meet our principle of data meeting the discipline. Now I would like to hand it over to CIO, Mr. Dev, to take you to the deep dive of each four factors.
Thank you, Man. Now I'll be explaining you each and every single factor in detail. Starting with quality, we have assigned 35% weighted to. In quality, we make sure to check that the company is profitable, is able to grow sustainably and fundamentally correct. So we carefully invest in three types of company: finance, non-finance companies and non-finance lending companies. I'll be explaining you each and every single one. Starting with non-finance companies, we ensure to check on ROIC, which is return on capital, which will help us to ensure that how efficiently the company is using its capital to generate its profit, well, alongside with other parameters. Next up, talking about the finance lending companies, the highest weighted that we assign here is to ROE, which helps us to understand the current profitability metrics of the company alongside with the other parameters. And then talking about the non-finance lending company, the highest weighted that we assign here is to EPS growth average weighted compared to its PV, which will help us to understand how effectively the company will be able to sustain for long term. Next up, I'll be talking about value, which we have assigned 25% of our weighted to. In value, we are very clear. We want to make sure which stock is undervalued and the company is fundamentally correct or not. So as in quality, we have assigned from finance, non-finance and non-finance lending companies. Starting with finance lending companies, the highest factor that we have assigned here is to FCFF to EV, which will help us to understand how efficiently the company is positive cash flow compared to its enterprise value alongside with the other parameters right here. Next up, talking about finance lending companies, the highest weighted that we have assigned here is to ROE. That will help us, price to book, that will help us to understand if the company is currently undervalued or not. And lastly, talking about non-finance lending companies, the highest factor we have assigned here is EPS growth at a weighted average compared to its PE, which will help us to understand if the company is able to grow sustainably in future or not. Next, I'll be talking about momentum. So momentum is like a wave that we ride when our stocks are performing strongly. The Z-score we have kept here is -3 and 3, which will help us to remove the extreme outliers. And the number of lag month that we have kept is at 1. That we help us to ensure that we are not misled by the short-term noises happening in the market. Now, if I talk about the construction of momentum, we have done a balanced split of 50:15, 36 months with a volatility period of 36 months and 12 months with a volatility period of 12 months, which will help us to understand this our portfolio is long-term friendly, also agile and risk adjustable. Next, I'll be talking about low volatility. Low volatility we have assigned 20% weighted to, and which will help our investors to stay invested and stay calm. So the Z-score kept here is -3 and 1, which again will help us to remove the extreme outlier and volatile stocks. And talking about the frequency for standard deviation for calculation, we have kept it daily, which help us to understand the current market trends daily. Next up, talking about period to get price data, we have kept it at 24 months, which will help us to understand medium and the long-term trends happening in the market. Now I'll be explaining you the blueprint of our hybrid fund. So starting off with the period taken, we have taken the period from January 2009 until May 2025, which is a 17-year period, which helps us to understand that our portfolio strategy is sustainable in bear, bull and volatile market. Next up, talking about the stock count, we have kept it at max at 50, which help us to diversify, also help us to manage this effectively. And talking about the weightage method, we have used NAV weighted composite method, which tells you that we are not randomly or equally assigning weight, but we are doing it fundamentally correct. And lastly, talking about the rebalancing period, we have done it quarterly, which will help us to understand the current market trends as well. Alongside all of this, we have taken gold and debt using NJ Smart Beta platform to be fundamentally correct. Now I would like to invite CCO Hina Wadhwa to continue.
Thank you, Dev. Now let's talk about how our AMC complies with the SABI norm. So in India, launching a fund is not just about its performance, it is also about following SABI's rulebook. And we at Investing Brain don't just follow the rulebook, we over-deliver. So first, our category is crystal clear. We are a multi-asset allocation fund. It means exactly what it says: equity, debt and gold in one portfolio. Second, SABI says 3 asset classes, 10% each. We say, why just settle for minimum? So we have built a portfolio with 50% equity for growth, 25% debt for stability, and 25% gold for inflation protection. Third, SABI says rebalance twice a year. We rebalance quarterly in order to cope up with the market trends. Fourth, transparency. From name to risk label to disclosures, we put out everything on the table for our investors' trust. Lastly, we have positioned our SABI's riskometer to moderately high, which is a sweet spot where the risk control and the growth potential perfectly balance. Now I will be inviting our CFO Mehak Mehta to continue.
Thank you, Hina. So who does not like consistent wins? Exactly for that, our multi-asset allocation fund has not just performed, it has outperformed the benchmark in 14 out of 17 years. That's a track record you can trust. With an average of 4.72% higher returns compared to the benchmark. The benchmark is taken from the NJ Smart Meter platform in equity, debt and gold into 50:25:25 ratio. And in investing, this extra compounding makes a massive difference over long term. So how did we do this? It comes down to our balancing in our hybrid fund of equity, debt and gold, which gives us a sweet spot for stability and growth. So now let's talk numbers. With a CAGR of 18.41% and annualized volatility of 7.98%, which shows that our average return is 5% more compared to the benchmark, which means higher return, less risk and less stress. With a Sharpe ratio of 1.13 and Sortino ratio of 2.03, which are also a great indicator for risk-adjusted performances. And our max drawdown is slightly lower compared to the benchmark, which shows that capital protection is built in our DNA. And our beta at 0.77, which also shows that our risk is less compared to the market predicts. So now let's make it all roll. Let's take an example of an SIP. Imagine Mr. Sharma would have invested ₹1,000 with us each month for 17 years. His corpus amount would come to around 1.97 lakh rupees. With our portfolio, he would have generated a return of around 9.28 lakh rupees after 17 years. And in benchmark, he would have generated around 6.36 lakh rupees, which has a difference of around 2.93 lakh rupees, which comes to around 46%. And not just that, we are beating the benchmark in all time horizon, which was also mentioned in the case study given to us by the NJ. Now let's take another example of lump sum leap. Imagine Mr. Sharma would have invested 2 lakhs rupees with us for 10 years. After 10 years, he would have generated a wealth of rupees 8 lakhs, which is a solid 4x return. And he would have generated more returns of 2.26 compared to the benchmark. So what does this mean? Whether it's an SIP or a lump sum, our portfolio is beating the benchmark. And another part where we offer various plans to suit every investor's goal and their objective, starting with a direct plan, regular plan, growth plan and IDCW. And our expense ratio for direct plan is 0.5% and regular plan of 1.5%, which shows that we are cost effective as well. To sum it up, it's just not a portfolio, it's a strategy to protect your capital and grow your wealth. Now I'll request our CCO to continue.
Thank you, Mehak. Now let's talk about tax implications. So when we talk about returns, majority people think that pre-tax returns are what really matters, but the serious portfolio managers know that the post-tax return is what really matters. We are classified as a debt-oriented fund since our equity is less than 65%. This gives us two major advantages: minimum churn rate and uninterrupted compounding. This makes the real difference in a 10-year SIP. At 30% tax slab, our investor gets post-tax return of around 5 lakh rupees, while the benchmark investors only get returns of around 3 lakh rupees. And you know what the best part is? Even at 30% tax slab, our post-tax returns are beating the benchmark's pre-tax return. Now let's talk about our target market. So we have divided our target market into three main categories. First is steady builders, HNIs and professionals who want strong and steady returns but don't want wild swings in their portfolio. Second, smart savers, people who want more than 6 to 7% of FDs but also don't want to invest in pure equity. Lastly, calm wealth creators, new to the market investors who value discipline and diversification in their portfolio. We have summed up our philosophy in one line: we don't just manage portfolios, we manage investors' confidence for the long haul. Now I'll be handing over to Sanjana Virwani, our CMO.
Thank you, CCO. Now let's continue our presentation by unlocking our USP. We solve investing biggest challenge, investor behavior. Our rule-based fund smooths volatility, reduces panic, and keep investment compounding. So this USP has been unlocked by the two factual analysis that we have done, starting with first, superior all-round performance. So we can see at the table given below that our IB hybrid fund has exceeded pure equity, pure gold, and pure debt. So for example, one investor is investing in our portfolio, he will get the return of 18.41% CAGR with very less volatility of 7.98%. That means whenever an investor is investing, he can get more amount of money in less time with less risk. Also, gold, which we have taken as a built-in safety net. So we can see in the graph below, from 2009 to 2025, gold has been considered as perfect hedge. And whenever the equity market has got tumbled, the gold prices has always risen up, which is, and not only that, the 20 to 40% of the allocation with Nifty 500, it has not only reduced the drawdowns, but it has also increased the returns, which is why we have taken gold as an integral part of our portfolio. So at Investing Brains, it's not just about chasing returns, it's about protecting them. As Warren Buffett has also said, we don't have to be smarter than the rest, we have to be more disciplined than the rest. Continuing with, our other part of USP lies in our investment and go-to-market strategy. So we believe that right investment plan needs right way of approaching people. So we follow simple three-step approach, starting with first, educate to convert. So firstly, we have decided to launch the webinar named Hybrid 101 and to evaluate case study based and the real life problems. We will teach in simple language what exactly 50 is to 25 is to 25 allocation means. Also, we have decided to launch the AI-based targeting ads and the smarter hair, hybrid hair reels as a short-term content. Why short? Because in this algorithm-driven world, it's become very important to go digital. And also, as per the fact given by SEBI, 70% of the mutual fund investors in last 3 years, they have discovered the fund online. So digital doesn't just become optional, it becomes essential. Secondly, dual engine run and reach. So for Tier 1 cities, we have decided to launch our app called IB Smarter, where the investor will keep updated what exactly NAV and rebalancing updates are. Secondly, for Tier 2 and B30 cities, we have decided to partner with local advisors, be part of their community events, and last but not the least, also to partner with the independent financial advisors. By partnering with them, we are not just entering into the new audience, but we are also entering to the trust which is already built. Last but not the least, trust to transparency. So we are very proud that we are 100% SEBI compliant, and also for that we have decided to publish our all quarterly rebalancing notes. So at Investing Brains, by blending education, trust and transparency, we turn our curious transfer into confident long-term partners. Now I would like to call Man to continue the presentation.
So now talking about our future innovation roadmap, our future innovation roadmap launch include the particular sector start series that we feel that particular sector is going to dominate the market in the near term. So we would like to invest in that particular sector to give the investor the edge of returns. Along with it, we are also planning to launch the Golden Retirement Age Fund that will provide the cushion to the retired citizen as the safe income. And along with it, we are also planning to launch the pure play performance that will invest into the pure equity funds for the investor whose risk appetite is moderately high to give them the edge of the pure equity returns. So whether it's a Sharmaji or any other investor, all just upgraded their financial journey with the Investing Brains. So now what you all are waiting for? So these were some of the references that we have gone through while making the presentation, and at last we will express the gratitude to the NJ Group for providing such an amazing NJ Smart Beta platform and its YouTube channel through which we upgraded our financial journey. So after such an amazing presentation and with such an amazing people, we at least expect the 5 crore of the corpus.
Wait a minute, man. Why just 5 crores? Since we are in the diamond capital of India, we can at least expect 50 crores so that we can return 200 crores back to you. Thank you, and we are open for questions and some investments.
Very well done, congratulations. You said about that you consciously selected 50% in equity being categorized as a debt fund where you don't get the tax advantage. And you compared the post-tax return with the pre-tax return of the benchmark, and which was outperforming. But did you backtest it with a 65% equity exposure with the current factors which you have, and how was it looking vis-a-vis that? Because ultimately that's a cost which an investor is paying higher. So by just increasing a 15% exposure into equity, you are getting a complete tax advantage.
So So sir, yes, obviously the 65% of the equity will give some of the tax benefit more to the investors. But what we at the investing brain feel is like, apart from generating the returns, what we do is managing the risk very well. So the portion of the 50% to the equity is kept to cap our portfolio the risk agile, so that we provide the better risk adjustment to our investor along with the debt and the gold portfolio.
Also, I would just want to add to his point that we backtested 100 portfolios, and from that we also did equity testing as well. And through that testing of 100 portfolios, we came up out with this one, which was the best out of.
No, yeah, I understand that, but what I was asking that if you had tested at a 65% equity exposure, how was it looking at it in terms of both returns and risk on a pre-tax as well as on a post-tax
Yes,
basis?
sir. So the 65% was having the more return, but as we mentioned earlier, the risk adjustment was not as good as the current portfolio. So we prefer this portfolio over the equity.
So to answer your question, we did compare it with the 65% equity when we were backtesting several portfolios. We saw that equity would give a better tax benefit at the same time, but we were also considering the risk factor while building the portfolio, and that is the reason we are a debt-based portfolio and not an equity-based portfolio.
Okay, and what is the expense ratio? You have taken any expense ratio?
Yes, sir. So while going through, we have estimated the expense ratio for the direct plan of 0.5% and for the regular plan of around 1.5%. So overall, we were having the expense ratio of around 2%, so which was very nominal and adjustable.
2% means direct plus regular,
Yeah,
0.5 plus
yeah,
1.5 becomes 2%.
Yes, sir. Combination
Okay.
of both.
Okay. And that is not in the back testing. You have not taken that in the back testing, or have you taken the expense ratio in the back testing also?
No, sir, we haven't taken it in the back tested because what we feel is that that won't, as it is the estimated, it won't give the accurate result. So as it is very nominal, so we haven't taken it as in a back tested period.
Okay, fine. I'm done.
So you've got 3 asset classes in your portfolio, right? So what was the, did you check out the correlation between gold and equity? What was that correlation?
Yes, sir. So the earlier, as we likewise, there was a kind of inverse relation between gold and equity. Like whenever the equity is not performing, the commodity assets like gold were performing. But in a recent
so
period,
for which sub period was this?
sir, from around likewise as we from like our knowledge, it was like around 2018 or 20. Both were inversely.
So were there any sub periods where they had positive correlations?
Yes, sir. In the recent year only, about like 2024 or 20 from
the last 3 years,
yeah,
maybe.
from 2022 to 2025, there has been positive.
So how did that impact the performance of this portfolio?
Sir, the reason why we taken the gold over here is not to just generate the returns, but also the gold was providing the edge in the drawdowns. But in the recent years, how the gold has performed, so they were the gold was also able to provide us some more returns alongside with the equity that eventually increased the performance of our fund.
So I mean, just a question on your factors. Your factors seem to be more or less equated, right? So, unfortunately, momentum, quality, low volatility tend to have a serious factor overlap.
Yeah.
So, did you check this factor correlation? Because the factor overlap in a, could result, if you do an out of period sort of run on your model, it could result in serious drawdowns.
Yes, sir. So we have likewise said, like we have back tested our 100 portfolio.
So
with the
back
different-
testing is okay. I mean, if you do an out of period.
Yeah, sir. We ensure that we have allocate different weightage. Likewise, the quality.
But they're
has been
almost same, 20, 20, 35, 20, I thought.
35, 25 and 20, 20.
Very
yeah.
similar.
Yeah. So it is led by the quality factor. Likewise, we feel that quality will help us to
No,
unlock.
but did you do an overlap analysis?
No, sir. We
You didn't.
haven't. Yeah.
Okay. So just, okay, fair enough.
in this whole simulation, have you factored in the transaction cost, or if the smart beta platform is taking care of it?
Sir, the smart beta platform was taking care, but we ensure that our transaction cost stays minimum because we rebalance quarterly in order to stay with the market trend, and also our allocation is done on the fixed basis, like fixed reallocation. That also help us to reduce our churn rate and to, as it is done quarterly, so to stay with the market trends also.
And nothing else in between was leading to any transaction?
Sir, so there was not, like we have not come across that feature over the NJ Smart Beta platform. Like
No, I'm not talking of smart beta. Nothing in your process triggers any transaction which is not quarterly?
No, sir, I am like we have
Only new inflows and other
yeah.
things will.
Yes.
Okay. No periodic rebalancing beyond just straight calendar cutoff.
Yes, sir. So likewise, we have tried to rebalance in a different, like taken monthly, half yearly also. But what the factor was, like monthly was having the more, monthly might be having more churn rates, while the half yearly won't be able to catch the momentum and the market trends as well as like the quarterly rebalancing does. So we stick to the quarterly fixed reallocation.
Okay.
On this transaction cost, did you check how much transaction costs impacted gross alpha?
So sir, as I mentioned that there was not a feature available like checking
Not
the
available
transaction.
on the system.
Yeah.
Okay, sir. So you couldn't check that?
Yes.
Thank you.
Thank you. Thank you so much.
That was really fantastic. You not only showcased a clear understanding of the theme and concept, but also ensured that all the requirements of the case study were thoughtfully addressed. Moving on to our third team for the day, please welcome Team Alpha Vault from the Indian Institute of Management, Ahmedabad, led by Jitesh Agrawal, along with Ranjana Ramesh, Vyush Agarwal, Mayuk Sardar, and Muskan Bhalotia.
Hari Krishna. Savers everywhere have two persistent issues: deep drawdowns, inconsistent opinion-based decisions. Our solution is simple: a single rule-based multi-asset product to not just protect the downside, but also capture upside consistently. Good morning, everyone. We are Team Alpha Vault from IIM Ahmedabad. Today, we are excited to present our flagship fund, a product based on a philosophy of discipline, data, and a steadfast commitment to the long-term creation of wealth for an Indian investor. To give you a sense of how safe your savings are, let me introduce you to the talented team that we have. We have Jitesh Agarwal as a CIO, who is a gold medalist from IIT Kanpur and has worked in the markets desk of Goldman Sachs and has also worked as an HFT trader in iRich. We have Mayuk Sarkar, the CMO, who graduated from St. Xavier's College and has worked as a consultant in Accenture and frequent post that. We have Ranjana Ramesh, an All India rank holder in Chartered Accountancy, who has worked in Aditya Birla Group and also in the private equity division of India RF. We have Vyush, our CCO, who graduated from IIT Kanpur and has a diverse work experience across wealth management as well as software development in Oracle. And I am Muskan Bhalotia, the CEO, who has worked in Goldman Sachs and JP Morgan in the IB divisions, and I am a qualified chartered accountant and cost accountant. Our investment philosophy rests on four major pillars. First, strategic drawdown protection. We build our shallower falls and quicker recoveries. Gold plus debt act as a ballast, cut peak drawdowns to over 50%, and inside equity, the low volatility screens and 15% single stock caps keep the risk contained so that we stay in the less than 40% drawdown quadriles. Second, efficient upside participation. We let the strength compound without churn. A 50% momentum sleeve with a 9-month look back and 1 month lag helps capture durable hands with the filtering whipsaws. Third, structured factor diversification. Our equity exposures are predefined and complementary so that SIPs stay on track across all regimes. Finally, disciplined execution framework. Everything runs on rules, from pre-trade liquidity checks to quarterly resets. This helps us deliver transparent, reliable, and proper results across all market regimes, be it a bull, choppy, or bear market.
Next, let's talk about the portfolio strategy. Here we introduce the core building blocks of our investment strategy. Our approach is built on a foundation of well-researched, academically backed factors, ensuring every decision is systematic and data-driven. We focus on 3 primary factors. First one being the momentum. This is a primary engine for growth. We identify stocks that have shown sustained price strength. Specifically, we use a 9-month look-back period with 1-month lag. This helps us to capture durable trends while filtering out the short-term market noise. To align with our risk goals, we use scaled momentum where the price change is normalized by its 12-month volatility. The number 2 factor we have used is the low volatility. This factor acts as a portfolio shock absorber. We select stocks that have historically exhibited lower price fluctuations measured by their standard deviation. Here, a 25% allocation cushions the portfolio during market stress and helps smooth the overall return path of our moderate risk investors. The third one that we have chosen is the value factor. This factor injects crucial valuation discipline. We employ a multifaceted screening process to identify fundamentally sound, underpriced businesses using a composite of several metrics. While core measures like the earnings yield and book value yield are key, our model also incorporates enterprise value metrics like the EBIT to EV ratio, cash flow measures such as the free cash flow to firm to EV ratios and dividend yield. Crucially, these parameters are intelligently tailored with different weighings for distinct sectors like the financial lending, financial non-lending, and non-financial companies, ensuring we apply the most relevant valuation lens to each business. This sophisticated approach provides a robust safety net, helping to cap the downside when high-performing, high-flying momentum stocks begin to correct. Here we notice the absence of the quality factor in our portfolio. This was a deliberate choice on our end. Our research showed that its characteristics were already captured by our other factors. Low volatility reflects balance sheet resilience, and value penalizes weak capital structures, making a dedicated quality factor redundant. Our cost-benefit analysis was clear. Backtests showed that quality factor added very few basis points of alpha while unfavorably increasing portfolio turnover. To maximize efficiency and deliver better risk-adjusted returns, we made the data-driven decision to exclude the quality factor. Our decision to focus on a targeted set of factors finds strong academic support as well. It aligns with the findings in the seminal paper 4-Factor Models in Indian Equities Market by Professors Sobesh Agarwal, Joshi Jacob, and Jayant Verma, which established a benchmark for multi-factor analysis in India as a follow-up to the Pharma French factor model. Some of these professors we were able to get guidance on a participation in this Olympiad as well. Finally, talking about our balancing weighing methodology, we used a composite factor score multiplied by the market cap. This hybrid approach is key to the portfolio because it ensures we tilt towards stocks with strongest factor characteristics while also favoring larger and more liquid companies. This enhances stability, ensures a strategy is scalable. Everything is brought together through a disciplined quarterly rebalancing schedule. This keeps our factor signal fresh while carefully managing transaction costs and turnover, ensuring our strategy remains aligned with its long-term goals. Our final strategy wasn't picked at random. It's a result of rigorous systematic research. We conducted an extensive grid research, backtesting all permutations of different factors and parameters, and also weighing methodologies to arrive at the most robust and consistent model. During this process, we analyzed inter-factor correlations, and again to mention, we found that quality had a very high correlation with low volatility and value. For example, a low volatility company often has a strong balance sheet, a key trait of quality, including it was redundant, and our backtest showed that it added minimum value while increasing turnover. Therefore, we dropped quality, which helps us create a more efficient portfolio with distinct and complementary return drivers. For an asset mix, once the equity portfolio is decided, we didn't just guess the numbers. We used modern portfolio theory to determine the optimal asset allocation. We ran optimizations to find the portfolio on the efficient frontier that maximized the Sharper ratio, which is also known as a risk-adjusted return parameter. However, the numbers were only a part of the story. We tailored this optimal mix to target our investors as defined in our mission. A long-term investor with a moderate risk tolerance who seeks steady, inflation-beating growth and wants to avoid steep losses. That's why our allocation of 53% equity portfolio, 32% gold index and 15% debt is so powerful to our investor base. The significant allocation to gold and debt acts as a powerful buffer, historically cutting max drawdowns by nearly 20 to 30%, which directly addresses our clients' need for capital protection and resilience. This all ties into our quarterly rebalancing discipline. Why quarterly? Because it strikes the perfect balance. It's frequent enough to ensure our factor signals remain potent and true to the strategy, but not so frequent that we erode gains through excessive transaction costs and taxes. This disciplined rhythm is crucial for achieving the consistent long-term growth and outcomes that our investors expect from us.
We ensure that the mutual fund strictly follows SEBI's regulation. Our fund maintains strict portfolio diversification with no more than 50% of our equity portfolio in a single stock, helping us managing concentration risk. The portfolio structure also aligns with SEBI's hybrid configuration, ensuring right balance across asset classes. Our factor weighing methodology ensures compliance with SEBI's liquidity norms. We also follow SEBI's reporting standards with quarterly and annual reporting of our performance, risk, and holdings. Regular audits and internal reviews are conducted to maintain full transparency. We monitor the fund's exposure across sectors and asset classes on a daily basis, ensuring compliance with SEBI limits. In addition, we run stress tests in various extreme scenarios to make sure that our portfolio is resilient both in bull and bear markets. Our portfolio has delivered a CAGR of approximately 20%, consistently outperforming the market. On a risk-adjusted basis, the Sharpe ratio of approximately 1, shows strong returns for each unit of risk taken, while the Sortino ratio of 1.66 highlights the minimized downside risk. We consistently track volatility and drawdowns with a relatively low volatility of approximately 11% and a maximum drawdown of negative 28%. Our portfolio has been more stable compared to the benchmarks, proving its ability to limit losses during slowdowns. While ensuring we are compliant with SEBI norms, maintaining transparency, and achieving the right balance across asset classes, our fund has been able to deliver superior returns and lower risk, demonstrating the strength of the approach.
Now, having talked about our static allocation strategy across the asset classes, let's talk about our dynamic allocation strategy. While our static allocation model is incredibly robust in itself, we have also developed an alternative, more adaptive strategy, a macro regime-based dynamic allocation. The rationale is very simple. Asset classes behave differently depending on the prevailing monetary policy environment. This strategy allows our portfolio to be proactive and adaptive, systematically aligning our investments with the direction of the economy rather than holding a fixed mix across asset classes through all conditions. Here's how it works. So basically, at the start of each quarter, which is a rebalance frequency, we use a simple rule-based framework to identify the economic regime that is prevalent based on the RBI's repo rate. We look at two things. Number one, level. Is the repo rate above or below its 3-year average? Number two, the trend. has it been rising or falling basis the last few quarters. This gives us 4 distinct regimes, each with a predetermined optimal asset allocation basis the modern portfolio theory again. So the number 1 regime is the easing environment with low and falling rates. We position for expansion with as high as 72% allocation to equity. Next, we have a recovering phase in which rates are rising from a low base. Here, we maintain a balanced growth approach at 67% equity. Next, in the tightening economic regime, contractionary phase, we become more defensive, reducing equity and tilting towards more of gold. And finally, when rates are peaking and starting to fall, we shift to a highly defensive capital preservation mode with as high as 91% in debt. This portfolio is again then rebalanced to match the regime's target at each quarter. The benefit of this dynamic approach are clear from the performance metrics as listed in the slides. This strategy achieves a CAGR of 16.19% with a Sharpe ratio of 1.1, outperforming the static benchmark. The outstanding Sortino ratio of 2 highlights its superior downside protection, which is a key consideration of an investor base. Furthermore, its maximum drawdown is remarkably low at 14.52%, less than even the half of the benchmark, showcasing its exceptional capital preservation during downturns. This demonstrates that by intelligently adapting to the macro-based environment, we can further enhance the risk-adjusted returns for our investors. For once interested in the deeper look at the quantitative analysis that we have done, the detailed calculations that underpin these results are available in the appendix and the attached Excel worksheet. There we will find the complete regime analysis, the efficient frontier optimization models used to determine our static and dynamic asset allocation strategies.
Moving on to our portfolio attribution report, the highlight of our current strategy is the static allocation that we have between different asset classes, which is equity, gold and debt. In terms of performance, our portfolio has constantly delivered a CAGR of around 20%, which is significantly higher than the benchmark 13.06%. This outperformance explains that our static allocation is not only generating strong returns, but also provides consistent growth without the need for making constant adjustments. Looking ahead, we also plan to incorporate a dynamic allocation. While the static allocation has worked very well for us, the dynamic allocation will help us adapt to changing macroeconomic conditions and change the attribution in different asset classes based on changing interest rates and market condition. This will help us enhance our risks and returns better and also make our strategy more robust. In terms of industrial distribution, our portfolio is well diversified with exposure across different sectors, both financial and non-financial. This ensures that we are not overly reliant on one sector. We try to maximize our returns while also avoiding sector-specific risks. Our investment process is built on 6 key steps, ensuring a disciplined, data-driven approach that helps us deliver consistent returns while managing risk very efficiently. We began with screening, where we analyze a broad universe of assets based on the criteria, that is momentum, value and volatility, to identify high potential stocks. After this, we move on to selection, where we dive deep into the company fundamentals, evaluating factors like valuation and growth potential to ensure that they align with our long-term objectives. Once selected, then we focus on our allocation between different asset classes, which is equity, gold and debt, to balance risk and return. Then the portfolio is rebalanced regularly to ensure that efficiency, minimizing market impact through strategies. The execution strategy also focuses on algorithmic rule-based trading to ensure precision and efficiency. We use a volume-weighted average price strategy to minimize trading costs and ensure that purchases are made at the best possible price without disrupting the market. Rebalancing is done quarterly, keeping transaction costs in check while optimizing the portfolio's exposure to the right asset classes. Our execution ensures optimal efficiency, reducing market impact and spillage, resulting in lower overall execution cost while adhering to strategic objectives. In addition to strong execution, we also focus on tax efficiency. For example, if an investor had invested 10 lakhs in our portfolio, over 5 years it would have grown to 22.86 lakhs post-tax as compared to the benchmark 17.38 lakhs post-tax. This tax-efficient approach minimizes the capital gain taxes that the investor has to pay and ensures that the investor can retain more of their returns. Our strategy combines a disciplined asset selection, cost-effective execution and quarterly rebalancing, all of it along with the focus on tax efficiency, delivering strong returns while effectively managing risks and costs.
From the very onset of the fund, we believe that we are not here to sell returns. We are here to deliver confidence. because people do not abandon funds for a few percentage lower CAGR. They leave when the downturn starts, losses hit, and panic begins. This product has been designed so that money not only flows in but also stays, because compounding only works when the capital remains committed for the long term. This historically, traditionally active funds often promise outperformance, but this often comes with higher risk, higher exposure, and higher chances of volatility. Passive funds are simple and low cost, but they come with concentration risk and full exposure to market swings. Balanced advantage funds promise safety, but their asset shifts often feel like a black box, creating confusion and mistrust. We, however, stand apart. This fund is transparent, rule-based, and hybrid by design, and the message is clear. We want equity exposure without the panic. For our investor profile, we have three major segments. For Tier 1 salaried professionals, the focus lies on convenience and clarity. For Tier 2 and Tier 3 savers, the emphasis is on safety and stability. For HNIs, funds and RIAs, the emphasis is on sophistication and transparency, supported by our partner network and audit-ready factor sheets that provide clarity and proof. When we talk about outcomes, we do not simply quote the CAGR, because that number alone does not reflect the real experience. What matters is resilience. The market fell 34%. This fund fell less and recovered faster, which meant long-term goals stayed on track while others derailed. This is why the focus is on risk-adjusted returns. A Sortino ratio nearly double the benchmark, a Calmer ratio almost 4 times higher. We provide results that are consistently strong across cycles. The way growth is built is also deliberate and disciplined. First, credibility is established through a pilot with HNIs and corporates. So early AUM anchors NAV stability and builds confidence. Second, distribution network is mobilized by ensuring every distributor and RIA can explain the philosophy with audit-ready factor sheets and SIP cases. The story of discipline and transparency is delivered consistently. Finally, the fund expands nationally to targeted digital campaigns for Tier 1 professionals, vernacular campaigns for Tier 2 and Tier 3 towns, and employer payroll SIP tie-ups that lock in recurring distribution. The AUM targets are also realistic and achievable, which makes them credible. The goal is 50 CR at launch and 150 CR in the first phase. And these numbers are grounded in the existing partner network, payroll tie-ups, and digital onboarding pipeline already in place. Thus, this fund is not designed to chase the highest peaks. It is designed to deliver the smoothest journey. Where active funds rely on managers, this fund relies on process. Where balanced arbitrage fund confuses with opacity, this fund measures with clarity. Where index funds leave portfolios fully exposed to cycles, this design cushions the flows with a hybrid smart beta approach. The promise is simple, SIP compounding that works like clockwork, steady, rule-based, and always aligned to long-term goals. That is how trust is built, that is how adoption lasts, and that is how this fund becomes a brand that people can believe in and stay for the long term.
We analyze various scenarios and believe that our fund actually performs across different market phases. In bulls, winners run with a 15% cap and quarterly trims restore the 53, 32 and 15% mix. In bears, 32% gold and 15% debt provides a ballast and low volatility dampens. Clean execution comes from the composite into market cap weights, liquidity screens, and the caps that we've put. Bottom line, we participate on the way up, stay composed on the way down with rules and not opinions. To conclude, our investment approach is deep rooted in our belief. Rules first, zero drift, long-term wealth creation for our Indian clients. Thank you so much.
Thank you for your elaborate presentation. I was just looking at the maximum downside, which was 28%, and the benchmark was, 36%. Either of it won't please a conservative investor. Did you really revisit it at any time?
Yeah.
Because your 28% maximum drawdown, and with all the freedom to have the flexibility of allocation, changing your portfolio, altering, ignoring quality for some other thing, making all this choice, it does not translate into a great protection.
So basically, this is the max drawdown possible over the entire investment horizon. It is not the drawdown of a single calendar year. So the drawdown that we have calculated is actually at the lowest point, if at the highest point if you had calculated, invested in the portfolio and exited at the lowest possible, what is the maximum possible drawdown risk that you could have faced. So that is this number. So it is primarily during the period of 2008 crisis. And so to counter this and to this is not the drawdown of a single year. I'm saying that again. And to counter this and to work on this, then we shifted to this dynamic portfolio asset allocation, which significantly reduces our maximum drawdown, like the whole calendar year return, even during the 2008 crisis and the COVID period, were positive on this dynamic asset allocation. So we countered that thing that was seen as a challenge to us also. Therefore, by we moved to this dynamic asset allocation.
You have shown performance on 3 slides. So there was first slide where 51% was the drawdown, and then some other drawdown was there. So I was just wondering, in this it is negative 51%. Previous one. You go to the previous slide, yeah.
Yeah, I can explain this one. So we have equity portfolio separate, then the gold index, and then the debt index. And based on these 3 assets, we allocate our funds basis the.
So here, if you look at the hybrid portfolio, it is negative 28% max drawdown, and in that slide you are showing 14%. So I'm just wondering.
So this is the difference of the static. So this hybrid benchmark, here it shows the minus 34.37 max drawdown, which is consistent with the other slide. The Nifty 500 TRA index, total return index, shows a max drawdown of minus 63.71%, and this 28.37 is for the static portfolio allocation, which is consistent with this slide, 28.37.
Okay.
And the next one that you might have confused with, this 14.52, is the max drawdown possible with the dynamic asset allocation basis the macro regime.
And then there is one more slide also on the performance, the last one.
Marketing one, yeah.
Next, you can, this one.
This is with respect to the static, because our idea was that since our investor base is new and this is the first AMC product that we are launching, we will start with the static dynamic allocation so that it is easier for the investors to understand.
In the first, you are going to do the static one.
Yeah, and once our reputation is built in the market, we will launch the dynamic asset allocations fund, which once our trust is built in the market.
Okay. One more question. I think you have not capped the Z-score. There is no capping or flooring done on that.
Yeah.
Generally, outliers can significantly tilt towards a particular factor or certain stocks get selected.
Yeah.
So, if you have any observation or rationale on that.
Yeah, so basically we did have a rationale on this. We did not cap the Z-scores in order to allow the stocks with exceptionally strong factor to fully express themselves in the potential of the portfolio. And the idea was that this rationale of not capping the Z-score was based on 2 primary ideas. Number one, for higher convention for winners to showcase their performance in the overall portfolio. And number 2, at the portfolio level, we capped the stock weight at a maximum of 15% per security, and that is in the equity portfolio. For the overall portfolio, since the equity portfolio is just the 53% of the total portfolio, that comes out around 7.5% cap on each security. Plus, we are also having a very high weight on the low volatility, which in itself ensures that if the Z-score cap is very high on the let's say the momentum factor, then it is generally low on the lower end on the low volatility factor, and hence the composite Z-score comes out in a significant range only. So, and to further investigate in this issue, we checked the year to year, calendar year, and rolling 1 year and rolling 3 months and rolling 6 months and rolling 3-year performances, and we found that at none of the times our asset allocation on particular index crossed even 5 to 6%. So that way we thought we are hedged on this risk.
Okay. One more point, generally value factor has underperformed vis-a-vis all other factors. And you said that quality and low volatility has a higher correlation, and that is why you have not selected quality. But within quality, you have several parameters, like lending companies will have a different quality parameter, and non-lending businesses will have a different quality parameter, and the correlation, once you have a different parameters, that also can change.
Correct.
And quality probably is a extremely important factor or a characteristic of any strong quality business. So completely avoiding a quality parameter just by suggesting that it has a higher correlation with low volatility. I mean, so I was just wondering on that. Why? What was anything more beyond that?
Yeah, certainly. So basically, as you mentioned, quality is a very important factor looking when looked at standalone factor for the portfolio allocation. So in quality, the best parameters that we found was that within the fin lending segment of the businesses, the return on equity was found as the highest, most important factor. Within financial non-lending, again return on equity was very important, and within fin lending, equity to total capital was being found as the most optimal portfolio. We again did the grid search and allocated weightages differently across the business risk, and like used another factors also like the ROC and the operating cash flows to EBITDA, all those things. We saw the performance of these standalone factors as in like just the quality factor, what is the performance of the portfolio, just the wall. You are absolutely correct. The quality one outperforms the value one. Value one generally does not, standalone does not give the highest risk adjusted return or the Sharpe ratio. But when you include both these factors, so we did a grid research by allocating in the increments of 5% weightages to each of the factors. In that case, since the correlation of the quality with the value and the low volatility is very high, we ignoring the quality in place of value outperforms the overall portfolio. Hence, we use this approach. And this approach is also academically backed by the recent paper that was conducted on the Indian markets as an extension of the Pharma French model, in which it was similar result was found. So we got a more confidence on our approach and result.
But Pharma French is a very different,
Very different
so it's a long short kind of a model. Well,
Correct.
this is there is no shorting which is done here.
Correct.
Okay. And
But the paper that I am referencing
yeah.
is on Indian markets by Professor Joshi Jacob, and it is on the Indian markets where they just analyze the importance of each factor and how one factor already incorporates the value suggested by the other factor in the Indian equity market from the period of 2001 to 2015.
Fine. And one more question. You said that you are going to do a staggered ordering as far as your execution is concerned to get a best VWAP.
Correct.
So how did you back test that?
So basically, I have some prior experience as an HFT trader. So I have seen the order books. I have worked on the tick by tick data. So how we used to do is that basis the volume of the transaction volumes of that security, we can analyze what would be the market impact of the position that we are supposed to take in that equity basis a portfolio, and based on that we can stagger the orders, and we can determine like if 80% of the
I understand that you can do that, but when you are doing a back testing, I don't think you would be in a position to generate that.
Yeah, in the smart beta platform that was not possible. So what we did is we took the average of the beta spread in the Nifty 500 indices. That gives us the cost of the hitting the market, the beta spread at the level 0 to level 0, and we use that as a like rough computation of the basis points that will lose on the return that the smart beta is generating. That came around the 60 to 95 basis points. Since the balancing is on the quarterly level, 60 to 95 basis points over a annualized return would be the cost of execution.
And can you tell about your expense ratio and whether you incorporated that into your back testing or not?
So in the smart beta platform directly you will
So we did not account for expense ratio on the smart beta platform, primarily because what we aimed at doing was in the initial stages we wanted to look at how we can optimize the portfolio and get to our best return. So considering that we are a hybrid fund, our maximum expense ratio would be capped at 1%, and the impact that it would have on the overall CAGR or on the overall risk adjusted return would be very minimal. So initially we wanted to first stabilize our portfolio by optimizing the return and understanding how each of the factors play. So because of this we did not factor our expense ratio in the back testing, but we also understood based on our computations that the impact would be minimal because our expense ratio would be very less, considering that most of the work is done by the research team and we don't have a lot of cost. Expense ratio is very minimal. So the impact that it would have on our performance metrics would be very minimal.
And on the tax component, by having 65% in equity, there can be a huge savings in terms of tax. So, any thoughts on that? Your I think is classified, would be classified under a debt category, not as a multi-asset allocation equity category. It will follow the taxation of a debt category.
Yes,
So you didn't think about that while creating the portfolios, or did any back testing on that?
So we backtested the portfolio where our portfolio would get the benefit of the tax, and we just simply compared the after tax returns of the tax benefit that we would get in the other portfolio and the tax benefit that we are losing on this portfolio. We found the benefit more here, so we still went ahead with higher taxes in this portfolio.
The tax benefit was very minimal, so we felt that having a 53% weight towards equity still gave us a better return despite having a marginally higher tax rate as compared to a 65% equity allocation.
Yeah, so the intellectual underpinning of this entire exercise is Joshi's paper, right? Looks like, to a great extent. And obviously, Jayant has been saying a lot of this stuff for a very long time. A couple of questions, because it's, if you look at that paper, it says size, value, momentum. At the end of the day, that's his underpinning, right? If I'm not mistaken. But there's also, I think, somewhere talked about the behavioral characteristics, overconfidence and this and that. So where that did get reflected in this presentation somewhere. So I couldn't see that. Just an observation, right? Question I had was, one objection I had to that approach was that, factor timing is not merely a function of economic cycles. It is also a function of valuation cycles. And valuation cycles don't get reflected in the model that you guys have built. And I think, you could land up in trouble because valuations don't follow economic cycles very, very often in India, right? And that's where this model could fail. I know you need to test for that at some point of time. That was one. The second was that, have you actually examined this question of dynamic adjustment of factor allocation against, and what value it adds against a buy and hold kind of factor allocation? I was just wondering, did we do that?
Can you slightly explain what do you mean by buy and hold asset allocation?
Right. At the end of the day, when you say dynamic, every time a factor price changes, you are reallocating. That's my understanding.
No. We are.
So you don't bring in factor price at all into this.
We rebalance only at quarterly level.
Okay.
And at quarterly level, we first decide the asset allocation basis.
Because dynamic normally refers to a factor price change and reallocating when there is a factor price change. So,
no.
So
we are not
I was, and the last thing I wanted to ask you was, did you look at, given that momentum has got such a huge weight in your entire factor allocation, did you look at kurtosis or skewness or something like that when you looked at this analysis? Did you look at that? Because you could land up with what they call, I think, leptokurtosis or whatever it is, huge amounts in drawdowns, of the normal distribution. Did you look at that?
So basically, I will address all the questions that you have mentioned one by one. I will try to address some of them.
Right.
So basically, starting with the paper that we have referenced, we absolutely agree to the fact that there were various biases that the paper talks about, the behavioral biases that investors exhibit in the markets, like the overconfidence bias or post-result bias. All those biases have been talked about. But since this is a quantitative-based model, rule-based model, it was very hard on our part to account for those things. And since our rebalancing is at quarterly level, it kind of addresses that point because the results might show in that timeline only, the results effect might show on that timelines only, but we have not statistically and regressively tested those things, the biases. Second, your question was on the dynamic asset allocation. So we are not dynamically changing the NAV values or adjusting the portfolio on a daily end of the NAV values. We are just deciding the asset allocation dynamically at each quarter rebalancing level. Once the asset allocation is decided, then we, based on our factors, we decide the equity portfolio, gold index and debt index and take the positions and rebalance the portfolio. That ensures that churn rate is minimal, transaction costs are within in line and expectations. Your third question was?
Major issue on the fact that you are using economic cycles and not valuation cycles.
Correct, correct. Yeah, so thank you for reiterating the question. So your question that the valuation cycles might not be concurrent with the economic cycles. We completely agree to that fact. But the fact that we have also included a value factor in our portfolio slightly addresses that question. And also the fact that we have to remain invested in the market because our customers are also doing SIP. So we can't do something like that. We take funds out of that equity fund during very high valuations and can like completely switch to a debt fund or something like that. So we can't address that phenomena directly since we can't change the market. Like if Indian market is overvalued compared to the Chinese market basis the PE ratios or something of that sort, we can't completely change the equity portfolio or shift the equity portfolio. So in this approach, since our fund is restricted to the Indian markets, the valuation cycle, we can't address that directly. But yes, that is a very good point. We can explore it as a more allocation to the debt or the gold portfolio in cycles of very high valuations. But we have not considered that. So we will see that and explore that as the next possibility. Your final question was on the skewness and the kurtosis of the correct, correct.
Momentum being such a large part of your factor.
Correct. So momentum is right now in the 50% weightage of our equity portfolio, and equity portfolio is the 50% weightage of our overall portfolio. So momentum comes around like 25% weight, and given that the momentum additionally has been capped by 15% weightages on stocks and capped by the low volatility, and momentum is scaled by the volatility also. But again, it is true, I did like deploy the distribution of the momentum to check for the if it satisfies the normal criteria of the kurtosis greater than 3 and all those things. I strictly don't remember the exact numbers, but we do have that analysis somewhere in our docs. I can find out and tell you, but it was not perfectly normal distribution. There was bias, and since the returns are log normally distributed, it was skewed positive as long as I remember, but the bias was not so hard that we can completely ignore the...
You know, if debt and gold do not buffer, you know, what you will happen is that this momentum factor will not, in a drawdown, will impact you very, very severely.
Correct. And also one observation that we noticed that in very high drawdowns or very extreme events, the correlations among the asset classes and among the portfolios also become very high. So the diversification benefit loses on that part also. Most of the securities behave similar only, irrespective of the quality factor or the momentum factor in extreme scenarios. Thank you. Any more questions? Thank you so much.
Another stellar pitch. Smart work using the efficient frontier to balance both the upside and downside of your portfolio performance.
Well, that's 3 back-to-back presentations. I think our energy levels need to be rebalanced with a small tea break.
Agreed. So let's take a quick 15-minute break before we head into the second round of presentations. More exciting pitches are coming soon, so please be back by 11:45 a.m. Tea is served next door in the Orchid Hall too.
Hi everyone, request you all to please settle down. We'll be starting in a few minutes. Hello everyone, request you all to please settle down. Welcome back. I hope we have all successfully rebalanced our energy levels and are ready to take on the next set of presentations.
With that energy, please welcome from the Indian School of Business, Hyderabad, Team Factorial, led by Akshit Daga, joined by Akriti Sogani, Ishana Kaul, Vasu Verma, and Nikhil John.
Good morning, everyone. In the next 20 minutes, Team Factorial is going to walk you through the opportunity that lies in the fast growing Indian mutual fund industry. Why a multi asset factor based approach is unique to India, and how our fund, how we deliver a very consistent lower drawdown and adjusted returns through our multi asset fund. The foundation of our work is simple: research, evidence, and disciplined implementation. This is what shapes our philosophy and drives our performance. India's mutual fund industry is expanding fast with an AUM of 77 lakh crore. The hybrid and multi-asset category has an opportunity of nearly 10 lakh crores. A 0.25% market share would result in a 2,500 crore scale. Our vision is transparent, evidence-based funding. With a strong team across strategy, compliance, and execution, we're not just launching a fund, we're building a disciplined, long-term wealth platform. Our philosophy is simple: turning decades of research into reliable returns. We systematically apply value, quality, momentum, and low volatility. No guesswork involved, just rules. We score stocks using Z-score, build composites, and rebalance monthly across the top 50 stocks. An allocation of 50% equity, 25% debt, and 25% gold results in growth, stability, and hedging. Every choice is tested in Indian-specific shocks, be it demonetization, NBFC, COVID, or the global financial crisis, ensuring consistency and reliance. In short, our research guides the design, evidence validates it, and implementation delivers it. Our scheme is classified as an open-ended multi-asset allocation fund, and as per SEBI guidelines, such funds require at least an investment of 10% across each asset category. We not only meet this requirement, we go a little further with a 50-25-25% allocation. This ensures that the scheme is fully compliant while delivering balance. Our SEBI's riskometer, it is rated as a high risk category, which is aligned with our benchmark as well. In short, regulation defines the structure and we implement it with evidence-based discipline. As you can see in this slide, historically, no asset class has outperformed the other consistently. Sometimes equity outperforms and provides outsized returns, but then crashes. While other years, gold shines, especially in times of crisis. That acts like a cushion when the assets with higher risks struggle. On the screen, you see the data. Year after year, there has been no one consistent leader. The leadership keeps changing. It's all evidence drawn from decades of market research and including India's own market cycles. So why does combining them work? The answer lies in correlation. Equity and debt move in opposite directions. Debt remains largely uncorrelated with both. Like counterweights, these dynamics stabilize the portfolio, smoothing compounding across cycles.
So just as no single asset class outperforms every year, similarly no single factor dominates across cycles. There will be years when momentum will lead, capturing the trending markets. Other times, value will shine as fundamentals reassert themselves. In downturns, low volatility takes the lead by protecting capital, and through it all, quality provides steady resilience. This slide shows our research insight, which is that the factor leadership keeps rotating. Clearly, momentum gives the best return, value is most volatile, and low volatility gives the best risk adjusted returns. But depending on any one factor alone will expose our investors to unnecessary risk. All of this sounds good, but what about the evidence? So here we go. When we blended all factors together and tested them across Indian market cycles, from bull runs to crisis, the results were clear. The combined portfolio delivered smoother returns, lower drawdowns, and more consistent performance than any single factor approach. This balance of styles meant that when one lagged, others stepped up, ensuring investors stay invested with confidence. And how did we implement this? Well, we don't overweight or gamble on a single factor. Instead, we allocate equally, 25% each. Our tests showed that this simple, equal weighted approach produced the strongest CAGR and risk adjusted returns. At the stock level, we cap exposure at 5%. That way, no single company dominates performance, but there's still enough room for us to benefit from the winners. And at the portfolio level, we stop at 50 stocks. Why is that? Because our testing showed that beyond 50 names, diversification benefits start to plateau. This number provides both breadth for safety and conviction for alpha. So what you see is not a hunch, not a story, but a systematic design. Our research shows that factors work but in rotation. Our evidence proves that combining them provides consistent gains. And lastly, our implementation ensures that it's delivered with a discipline suited for Indian market. This blend of diversification and discipline weighting is what makes our portfolio robust, resilient, and truly all-weather.
Now talking about how we talk about all the parameters in each of the factors. So this is not a guesswork. This was guided by academic research, and we had two questions in mind, and we studied around hundreds of research papers across decades of academic and practitioners with two questions. The first one being which parameter in each factor will deliver the most, and second, which one can be modified for the Indian context. So starting with momentum, we studied Jagdish and Titman's 1993 seminal paper, which discusses that the last 6 to 12 month rolling returns generally perform better in the short term. And we tested portfolios from 6 months to 15 months and found that the 12-month portfolio gave the best returns overall. Talking about value, we studied first the pharma French model factors and found that they generally give value trap stocks in India. So then we went to Mohan Ram's G-score, which is a combination of 7 composite things. Post looking at the 7 composite things and all the factors that we were given on the Smart Beta platform, we selected these 5, which are book value yield, earning yield, EPS growth to medium, dividend yield, OCF to EV. Then moving on to quality. Similar to Mohan Ram's G-score, we have Petrovsky's F-score, which studies the company on 3 parameters: profitability, liquidity, and growth. In each of these 3 parameters, we selected around 9 parameters, which delivers on each of these for profitability, ROA, ROE, for liquidity, FCFF, to NOPAT, and interest coverage, for growth, sustainable growth rates, EPS growth median, and equity total cap. Last but not the least, I think probably the most important one, low volatility, because we are answering to an investor base which wants that. We studied Blitz paper, which studied the low volatility from 12 to 36 months. Again, we backtested 3 portfolios, 12, 24, and 36 months on daily SD, and found that 36 SD performs the best. So we have taken the best of all the 4, all the academic research that we have done, and catered that to an Indian context.
We are rebalancing our portfolio on monthly basis. The logic for monthly rebalancing is sound.
Market moves quickly and frequent adjustments capture the signal better. But in practice, these frequency can act as a bottleneck, and hence the operational frictions, churn, execution cost can eat into the returns if not handled carefully. Vanguard's research show that for Indian stock, the monthly rebalancing cost is 25 basis points higher than biannually. However, such costs don't match the return when we talk about factor investing. That's why we ran the data. And our backtest proved that the monthly rebalancing is not just manageable, it's optimal. Our CAGR climbed to 23.7%. Sharp and Sortino improved significantly. Drawdowns shrink. And more importantly, our monthly churn actually reduces. Only about 8 stock changes on average basis compared to 13 for quarterly and 28 for semi-annually. On cost, monthly adjustments remain negligible, under 0.5%, which we'll discuss in detail in our implementation phase. So monthly rebalancing isn't just opinion, it's evidence guiding disciplined implementation.
Next, we would like to look at the performance metrics. And we have looked at 5 metrics against the benchmark of 50, 25, 25 equity, debt, and gold. That was a benchmark. And the 5 performance metrics, we ranked them in order. And the first one is maximum drawdown. Because, here we try to cap the maximum drawdown at 30% or below. Because our inherent belief is that if a retail investor who looks at a long-term SIP plan, if that retail investor, he or she looks at, say, a maximum drawdown of more than that, then the disciplined investment might break and he or she might withdraw from the stock market. So we would like to prioritize that first. And then we looked at Sortino ratio, which gives like the return on downward volatility. Because why? We believe that investors are more afraid about downward volatility than upward volatility. So we try to cap it at least 1.3 Sortino. And the next is volatility, because every investor, I mean, especially the retail investor, would like to have less volatility in his or her portfolio. And the benchmark volatility was 10%, so we are keeping a target of below that. Next is Sharpe ratio, which adjusts for both downward and upward volatility, and here we are capping it at least 0.8. And last but not the least, the CAGR. Here we would like to have a CAGR of at least 13%, which is the average historical equity market premium of Indian market, and this also ensures that we consistently beat inflation. So if you look at the backtested portfolio and vis-a-vis the benchmark, we see that in the previous, all the 5 performance metrics, we outperform the benchmark. And if you see, the max drawdown is 23% versus the 34% of the benchmark. And even Sharpe and Sortino are all like more than twice of what the benchmark is. And if we, and our analysis includes all the global financial crisis and all the, and if you see in the last 20 years of data, we have consistently outperformed 17 out of the 20 years. And so if we compare the rolling returns, here what we can see is that consistently we've been able to beat the benchmark, irrespective of the benchmark period.
Now comes the very important part, true to label. We want the investors to get what they sign up for. When we say the strategy is true to label, it means that all the factors that we have kept, they are actually the portfolio characteristic. Each of the company in our portfolio outperforms the benchmark on all of the parameters that we have given. For example, ROA, free cash flow to NOPAT, EPS growth, dividend yield, all of them are back. Here's the story. Our alpha is coming from exactly the signal we have designed it for. It's not accidental. And for investor, that is all that matters. Coming on to the next important element, portfolio implementation. We have bucketed this into 4 elements: liquidity, cost, broker, and nobertness. We want liquidity to be less than 10% of the average daily volume, and we also want to stress test this so that even if the annual AUM doubles, we are able to maintain it. the cost will be explicit and implicit. Since we are rebalancing it on a monthly basis, we want the implicit cost to be the state of the art so that we don't overshoot on the cost angle. And we will do that via a series of brokers. Typically, a large fund has 20 to 30 brokers. We'll use that and give them VWAP and TWAP algorithm. Also use liquidity access tools and smart order routing so that we don't give in signals when we enter the position as well as when we exit the position. And robustness, this is the critical factor. We want the feedback loop, and we do that by transaction cost analysis pre and post we have entered something.
Now, let's look at the investor's lens. Since equity allocation is under 65%, which is the required criteria under the Income Tax Act 1961, our fund is classified as non-equity oriented. That means the long-term capital gains after 24 months are taxed at flat rate of 12.5%, whereas the short-term capital gains, on the other hand, will be taxed at the investor's slab rate. The advantage, redemption-based taxation. The internal rebalancing does not trigger any tax. Our current allocation of 50, 25, 25 in equity, debt and gold also makes sense as it gives the highest Sharpe and Sortino ratio while reducing the drawdown significantly. If we would have increased our equity weight, our Sharpe and Sortino would have reduced and drawdown would have increased. So our focus is on risk-adjusted returns and stability and not just chasing tax advantage. Let's just say that the investor did want the diversification that we offer and try to replicate our allocation by themselves. That is, buying separately equity funds, debt funds, and gold funds. So in that case, they would face multiple tax regimes, multiple holding periods, multiple taxable events. Our fund simplifies everything. One product, one regime, and simple, clearly defined 24 months criteria. No tax leakage from internal rebalancing. The benefits are threefold: diversification, convenience and efficiency, all in single wrapper.
So this slide brings together the USP of our fund and the investors it is built for. Our secret recipe is a research-backed multi-factor strategy that results in portfolios with lower drawdowns and faster recoveries. In our back-tested data, the maximum drawdown was only 23.4% compared to 34.4% for the benchmark. That gap marks a huge difference for investors because protecting capital in downturns is what builds the confidence to stay invested. We also emphasize on superior SIP performance. Our backtests show consistently profitable outcomes, with SIPs delivering smoother compounding and positive returns. On top of that, our balanced multi-asset mix, 50% equity, 25% debt, 25% gold, protects against inflation and creates stability across cycles. But who is this really for? It's for Ramesh, the long-term moderate risk investor. It's for Anjali, who is transitioning from traditional savings like FDs into financial assets. It's for Mr. Singh, an SIP-focused retail investor who is planning his early retirement. And for the Guptas, from Tier 2 and Tier 3 cities, who are seeking a trustworthy, reputed partner to guide their family's wealth. In short, it's a fund that doesn't just look good on paper. It's built to match the real needs of real investors. So that was the essence of a fund, the recipe, the outcomes, and the investors that we built for. But behind the numbers and the design, what really holds this together is our ethos. First, consistency over quick wins. Second, investor-centric values. And third, apologies for that. Okay. Okay. And third, wait. Okay, can I start? Yeah. I'll just start with my ethos slide again. So, okay, first, consistency over quick wins. Second, investor-centric values. And third, research over speculation. Basically, every decision is driven by evidence, not emotion. This ethos is what ensures trust, discipline, and resilience in everything we deliver. Our go-to-market strategy is not only about distribution, it's also about building the right habits in investors. We know that today investor sentiment around factor investing in India is still cautious. That's why a structure of lower drawdowns and smoother recoveries is critical. It gives investors the confidence to stay invested, helping them build the habit of long-term discipline. Now, the other big lever is distribution. NJ's network is one of the strongest in the country, trusted by lakhs of investors and spanning metros to tier 2, 3 cities. We will leverage this backbone to accelerate our reach. This ensures scale and credibility from day one. And for us, success metrics is not just about AUM numbers. It's also about SIP stickiness and investor retention. Because only when investors stay with us do they truly benefit from the power of compounding. So, across our phases, building foundation, scaling, and optimization, the goal is simple: to make factor investing accessible, trusted, and habit forming for Indian investors. So while this fund is our starting point, our vision is much broader. Over time, we want to build a full suite of life stage solutions that can support investors across their entire journey, which means retirement funds, children's education funds, ELSS tax savers, and simple passive multi-asset allocators. The important point is this: every future product will carry the same DNA: research-driven design, evidence-backed validation, and disciplined implementation. So as investor needs evolve, we'll be right there alongside them, offering solutions that remain consistent, reliable, and trusted. Thank you, and now we're open for some questions.
Excellent presentation. I wanted to ask you one question, that you have selected 25% in all the factors. While your data was showing that when you have only momentum and quality, that was generating 21% return, while this was 15%, and even the drawdown is lesser, 13.4% vis-a-vis 16.2. Then why have you gone for equal weight? Because major of your drawdown which you want to balance will come from that gold exposure of 25% and debt exposure of 25%. So I was just wondering why you have taken an equal factor for the equity component, and yeah.
Apologies. Actually, as you can see, the Sortino and Sharp ratio are also in percentage. So this data is wrong. I mean, this slide, we have a typo in this slide. Actually, although the CAGR for momentum plus quality is not more than, I have the data, I can tell you the data, but we had a typo. The Sharp ratio for momentum plus quality is actually 0.8 and Sortino is around 1.1. For equal weightage, the Sharp ratio is 1 for equal factor and Sortino is 1.6. So that's why the confusion, and each of these factors do in fact produce a better CAGR and lower drawdown versus to only momentum and quality and momentum, quality and value. We can share that data with you.
Momentum and quality, I guess, will have a better CAGR.
Yeah, they will have a better CAGR but more drawdown. And when you combine that with debt and equity, overall the Sharp ratio and the Sortino ratio that you get will be lower for momentum plus quality and better for all the equal weightages because of the correlations and all the nitty-gritties that go into that. Again, apologies for the wrong data on this slide.
Fine. Another question was that for a SIP investor, you are suggesting this multi-asset allocation. Generally, in an SIP, one would invest into pure equity fund because the rupee cost averaging take place every month. So why, what was the rationale behind that?
So the rationale is simple. Multi-asset fund gave us the least drawdown. I mean 23%, we're talking about 23%. If we go by only equity, our drawdown will be much more. It will be somewhere close to 47%. Again, we've not highlighted it here, but I think you can see it here. 46% was a drawdown for only equity. So if you went ahead with that.
I understand from a lump sum perspective, but when you are investing in an SIP every month you are investing, so automatically you are getting that market volatility captured in that. It reduces the risk as you buy more units when the markets fall.
The only rationale was that it was not in the pursuit of whatever the case problem was given. Whenever we tried to do that, we went out of basically, we did try to make it more equity oriented, to 65-70%, but there again, we were shooting down on our drawdown target by more than 30%. So that is the only rationale we have for not choosing.
Okay, fine, fair enough. I'm okay.
I had one question. I think you said somewhere about diversification benefits flatten after 50 stocks, right? So is that what Markowitz has said? He said something very different, I thought, right?
Yeah.
Because
so
50, from if you read Markowitz, he seems to suggest that if you move from 20 stocks to 40 stocks, you get 3% diversification benefit, yeah?
Yeah.
So why 50 stocks? I mean, you were trying to saying that it flattens after 50 stocks. Is that a scientific sort of statement that you made, or just that you wanted to use 50 stocks?
So it's very true. I mean, Markowitz did say that you increase it, but here the
No,
rationale.
he says that beyond a particular point, diversification doesn't work. I mean, why 50? Why not 20?
Why 50?
That's my only
Because,
simple question.
Twofold answer. First, we were seeing that the Sharpe ratio is going to flatten at 0.78. You see 35 stocks and 50 stocks. The Sharpe ratio is getting at a 0.78. And second, if you are getting an equal risk adjusted return of 0.78, then we went to the churn of the stock. So if 75 stocks was giving us a churn of 15, so that's where we want to optimize the implementation part of it. Because overall, when you see the return and cost analysis, 50 stocks was giving us a better return. We would have loved to kept even below 50, but again, 50 was the sweet spot that we could optimize for.
Okay. The second question I wanted to ask is that you had told us about this monthly rebalancing and the costs associated with a monthly rebalancing. I didn't quite get that.
So I'll just run you through the calculations once.
Yeah.
So this is where I think the cost angle also we have mentioned in the column number 3. So we looked at 3 things. The first one was the explicit cost, your STT and brokerage. That will be 30 bips per round transaction. So if you see the churn.
So if you move from a quarterly to a monthly sort of rebalancing, you are getting 30 bips more expenses.
Yes.
Okay, so that takes away from alpha, no?
Yeah.
So what is the advantage that you are getting away from that take away from alpha? That is what I wanted to understand.
So you see the monthly gives you an CAGR of 24. Your quarterly gives a CAGR of 20.72. So we have a break even of like 250 bips. So even if you take 75 bips, that was the calculation was coming to, we are still getting a alpha of 175 bips. So that was our rationale, and we did an annualized calculation. So monthly 8 into 12, 96 times, and quarterly you'll get some 50. That's a 25 bips ka alpha. And then the implicit cost of managing it monthly from Vanguard's research, it was 25 bips more. So combined 25 and 25, 50 to 75 bips is what we are projecting. And we have, like I said, we have liquidity, cost, broker and robustness in place to ensure that we don't shoot beyond 75 bips. That's our target.
Yes, I had one last question. Why did you use this free cash flow to NOPAT?
Yeah, so that one, even in our team also, me and Nikhil were discussing, like we should not or we should. But we wanted accruals to be important. So we wanted financial prudence of a company. and you get a financial prudence of a company by how much cash it is generating versus how much profit is had. And from the given indicators we had, this one represented the closest to what we were looking at. And FCC to NOPAT was taken only because we wanted that quality angle that, okay, this business is able to generate cash and not accruals. And that is coming from our research of Petrosky F scores, because their leverage was a very important part, margins and leverage, and we wanted to ensure that we are in line because that has paid dividends to funds in USA. Similar results have been replicated in India, and yeah, that was the rationale, the accrual part of it.
No, I quite agree with you. I think free cash flow is actually the most important thing you should look at. I just want to know, why did you guys take it? Yeah, thanks.
Thank you so much.
Apologies to the team for the inconvenience caused. However, despite that, your presentation was quite confident, and what stood out was the simplicity and how well aligned your responses were throughout. So, sorry for that. Up next, from Pandit Dindayal Energy University, Team Brain, led by Dakshil Kumar Patel with Pooja Modi, Sachin Chabria, Parthiv Patel, and Prachi Patel.
Hello. So good afternoon, judges and fellow participants present here. So yesterday we had a visit at NJ Investment, and I found a wonderful quote that was said by Warren Buffett. It's far better to invest in a good company at a fair value than fair company at a good value. So with this wisdom, let's continue with the presentation. We are Team Brain, and today we proudly present you our flagship product, Brain FlexiCap Fund. As the name suggests, it's not a traditional equity fund wherein it's invested into a single market segment, but instead it's a dynamic equity fund wherein it's invested into large cap, mid cap, and small cap companies with the agility to adapt to the market conditions. So you might be wondering, why Brain? So our philosophy is not just to chase returns, but instead it's to use brain power, that is data, research analysis, and disciplined decision making, which will benefit us in the long run. So over the next 20 minutes, our team will be walking you through the philosophy, marketing positioning, investment strategy, and future outlook. I myself, Parthiv Patel, CEO, responsible strategic leadership and ensures that all the resources are aligned with the vision and mission. Next is Dakshil Patel, our CIO, the architect of the investment strategy, implements research-driven decisions. Next is Sachin Chabaria, our CFO, builds the financial backbones and implements risk and control. Next is Pooja Modi, our CMO, the voice of our brand and helps us connect to investors across India. Last is Prachi Patel, our CCO, safeguards compliances and ensures that we meet all the SEBI regulations and upholds transparency to the clients. Next. So in India, not many of the population are aware about the investment options that are available. Many of them still have a habit of savings and putting that money into FDs. So our vision is clear to provide them with a better investment solution for their financial freedom. So rule-based businesses are new in India and highly adapted by the Western coast. So our mission is to be India's most trusted name in rule-based investing. So we have chosen three core principles, that is quality-focused investing. In our research, we have found out that strong fundamental companies have given long-term benefit, and hence quality is one of the core factors. Next is research-driven agility. As we all know that data analysis and research is the new oil, we also believe in that research-driven decision will be benefited. Last is smart beta discipline. In our day-to-day life, we get emotional and make decision, and that turns out to be a mistake. And having one mindset will always be a biased decision. Hence, with the help of smart beta, we'll be avoiding this mistake and doing rule-based investment. Next. So our investment objective is mainly focused on core strategy, that is quality at reasonable price. So the equity stock selection is done on the basis of strong fundamentals at fair value. Next is risk management. To give you stability, we'll be providing lower volatility and to give you minimum drawdown as much as we can. Third, our goal is clear, to beat inflation by 3 to 4% while giving you consistent risk-adjusted returns. Fourth, we have adapted to long-term investment horizon, giving you equity exposure as a tool for your wealth creation. Last, investment style. Our investment style is simple, rule-based and multi-factor, combining systematic rigor and diversification in multiple factor, enhancing performance. Further slides will be continued by our CIO, Dakshil.
Thank you, sir. Now let's discuss why FlexiCap over the other schemes, because FlexiCap fund offers the freedom to invest in the large cap, mid cap and the small cap categories without any rigid limits, and this approach allows us to dynamically allocate our funds to the best opportunities. We select a FlexiCap based on the three parameters. First one is the market acceptance. With the highest AUM of 4.9 lakh crore in the equity categories, FlexiCap is widely trusted and the acceptable in the India. And second one is the reasonable returns. Historical data says that FlexiCap fund gave the higher returns as compared to the large cap, multi cap and the hybrid fund. It is shows the perfect blend of growth and stability. It makes a winning formula for the wealth creation. The third one is the market agility. Our FlexiCap structure offers to shift across the large cap, mid cap and the small cap category with the best risk adjusted opportunities. It is not about the chasing the trends, but it is about the systematic rebalancing as per our QAP methodology. Let me walk you through our portfolio construction strategy, which forms our backbone of our QAP strategy. Our weightage methodology follows index-based market capitalization, which ensures tradability, liquidity and the benchmarking relevance. For rebalancing, we choose a 6-month period because of markets are the dynamic and we cannot afford a high, and due to the some factors, short-term factors or the some bad quarterly results, stock may underperform, and that this semi-annual approach captures the best changes. Our backtesting period runs from 2011 to 2025, which and excluding the 2007 and 8 crisis, which helps us to ensure focus on the stability and market normalization. Our stock universe follows from 1 to 500, which perfectly give a full market spectrum, and our 60 stock portfolio gives ensures the diversification, and this long tail portfolio avoids over concentration while the focusing on the value parameters. Next, let me break down our factor allocation, which represents the heart of our QAP strategy. The first one is we added 45% to the quality parameters, which here we focus is on the companies with a steady earning growth, high return on equity and sensible dividend policies. We added 35% to the value parameters, as here we focus is on the EPS against the PE ratio and the book value yield. It helps us to find the undervalued and the quality stocks at a reasonable price. We added 15% to the low volatility, As a new player in the industry, we cannot afford a high volatility to our investors. It helps to reduce the portfolio swings. Finally, the 5% goes to the momentum as a it is not about the chasing the momentum trends, but it is about the tactical allocation to uplift our portfolio performance, while systematic trends aligns with the quality and the value factors, while promoting equity as an asset class. Further slides will be continued by Sachin, our CFO.
Thank you, Dakshit. Let me walk you through the backbone of our investing strategy, the 5 key parameters of our portfolio. Starting with the quality parameters, the first is the EPS growth median. It forms a foundation of identifying the companies with a consistent earning momentum. Rather than chasing one of the spikes, we focus on the business who have been having a sustainable growth patterns. Second, we will have a look into the ROE, which is return on equity. It is a measure of management excellence. So businesses that have been generating superior returns on the shareholders' capital, often with a resource utilization and a disciplined asset allocation. The third is the dividend payout ratio. It might seem to be traditional, but it serves a crucial purpose. It signals the mature businesses with the stable cash flows and disciplined capital allocation. Here we will look into the value parameters. The first is the EPS growth median to P. It is where our value discipline comes into the place. So this ensures that we don't overpay for the growth companies. Many growth companies are typically trade at the unsustainable valuation, but this matrix allows us to invest at quality at reasonable prices. Next, we will have the look into the book value yield. It acts as downside protection. The reason behind choosing this parameter for our selection process was that there are cases where the PE ratio might get upscale or downscale due to temporary earning fluctuation. But this parameters allows us to get the fair value of the stock we have been investing into it. So the 5 parameters work together systematically, removing the emotional bias and making sure that the backtesting is done with the quantitative evidence rather than the market sentiments. Next slide. So here we will have a look into how our rule-based methodology has translated into the key performance metrics of our portfolio. So our portfolio delivered a CAGR of 15.74% compared to Nifty 500 and Nifty 200 Quality 30 as a tier 2 benchmark, generating an alpha of 4.5% with a volatility at 17.34%. This ensures we just don't deliver the returns, but we deliver them with a low volatility. Next, we will have a look into the Sortino and Sharpe ratio. So our Sortino ratio is 0.99, which is quite impressive compared to the other 2 benchmark, wherein it focuses on the downside protection. So the companies who have been generating sustainable earnings of the company have a good amount of Sortino ratio. And the third is the Sharpe ratio. Our Sharpe ratio is 0.61 compared to the Nifty 500 is 0.32. It tells the complete story. So it's all about the risk-adjusted return the portfolio has been delivering to its investors. So it's not just about getting the returns, but it's about delivering them efficiently. And finally, we will have a look into the max drawdown. It tells about what's the worst peak to trough decline a portfolio ever seen in its history, wherein the Nifty 500 stands at negative 38.3%, Nifty 200 Quality 30 at 29.51%, but ours stands at just 26.28%. This shows how resilient our portfolio is during the market downturns. So the stock selection of the parameters results that it's not about generating the alpha to the investors. It's about to generate with low volatility, maximum capital protection during the downturn, and to have the investors' interest into it. Next slide, please. So here we will have a industry allocation of our portfolio, wherein we allocated into 10 plus industries, ensuring to invest in all the growing sectors of Indian market. Next slide. So let us have a look into the rolling back performance of our portfolio compared to the Nifty 500 and Nifty 200. As you can see that we have outperformed in all of the years. So this is all about that we as our AMC doesn't just generate the alpha, but we provide them a quality stocks at reasonable prices with a low volatility and a maximum wealth wealth generation of our investors. Further slides will be continued by our CMO Pooja.
So our major focus is on the age group of 25 to 55. This is the earning age group. They are open to equities and are looking for better returns than traditional savings. Our reach is in pan-India, but we are majorly focusing on tier 2 and tier 3 cities. Why? Because even if the financial literacy is still growing in these cities, the mutual fund penetration is still low. These are the cities where lower and middle income class groups reside, who are open to SIPs and equities. Our aim is not just to grab this opportunity, but to target a maximum retail market and spread awareness about how equities can be a good wealth creators, especially when compared to traditional FDs and fixed incomes. So for that, we have digital platforms for tech-savvy people and young professionals who are looking for seamless investment experience while investing. Then we would do a partnership with regional advisors, national distributors, and mutual fund distributors to build a trust between local partnerships and digital convenience. Then for mass affluent segment, we have bank integration so that the investors can easily invest through their trusted banks for payments and SIPs. We have direct distribution for informed investors. This is the cost-effective value-focused proposition. Last, we have SEBI-mandated investment awareness drive for lower and middle income class groups so that they can be educated for their investments. So our unique differentiator is a blend of traditional financial analysis with scientific approach. So for that we have first equity advocacy, where we would promote equity as asset class which generates a philosophy, that is quality at reasonable price philosophy. This can also be recorded in our track of 4.5% alpha across first, third, fifth, and even for 10 years of holding period. This is coupled with our long hold philosophy, which says that we emphasize our investors to stay invested for 10 to 15 years to unlock the full power of compounding and rupee cost averaging. Next. So this is our future product launch roadmap. After launching our FlexiCap fund, we would focus on multi-cap fund and market cap based funds and thematic funds where we focus on themes like value, quality, momentum, etc. In phase 2, we would focus on portfolio management services. So our strategy is backed by core philosophy delivered with discipline, transparency, agility, and technology-driven strategies. Now, I would like to hand it over to Prachi, our CCO.
Thank you, Pooja. So now I am talking about the maximizing the tax efficiency for our investor. As we operate, our portfolio operates within the guidelines and the SEBI's mutual fund regulations. So which optimizing the tax efficiency for our investor, and we are strictly adhered to the SEBI's guideline as we want to promote equity as an our asset class. Our investors are taxed based on the equity taxation, which is 12.5% plus S, which is much better than the fixed income taxation, because in fixed income taxation, investor tax according to the different tax slab rate. So here's our semi-annual rebalancing comes in. So we review our portfolio at average 6 months. So the underperforming stocks are removed and replaced. We don't only focus on the underperforming stocks, we only review our portfolio. So the qualifying stocks are keep in our portfolio. So compliance is not just about the following the rules and the regulations. We are strictly adhered to the SEBI's regulation. As we follow the SEBI FlexiCap rule, we transparently benchmark ourselves against the Nifty 500 TRI and the Nifty 200 quality index. We follow a SEBI sectoral exposure limit. So not any particular sector is a dominate our portfolio. Every rebalance we keep at every 6 months. So all the details are documented in a detail. So this our approach is a systemic discipline and the compliance with the SEBI's code of conduct. So these two slides represent our actual portfolio composition, where most of the stocks are below 1% positions. Here we follow the long tail allocation strategy. So our approach is our approach is rooted in a bottom-up stock selection. So here we manage the risk management. We don't just want only investors, we want long-term partners in India's growth story. Thank you for this opportunity to present our NFO strategy. We hope our approach reflects both innovation and the responsibility in meets India's investment need. Thank you.
I was curious to know about, this book value yield, yield on book value. How different it is? Because you said that the earnings could be volatile and temporarily down, and where it could be misleading. How yield on book value will be different?
So, sir, basically the reason for taking the book value yield was that to get the fair value. So there may be a possibility that the earnings may got fluctuated of the companies due to some quarterly or this yearly earnings. So there may be a question that if a stock is having a ROE of 20%, let's say example, but its PE ratio gets for 50%, while the industry average is 30x. So here we get the book value yield where the valuation takes into the place. So that's why the
Shashi, are you able to decode it? No, I don't get it. Book value yield as compared to earnings yield, how different it is? I'm just rephrasing the question.
So, like there may be a possibility a stock may got overvalued, but to curb that down, book value will just help us to what's the fair value. So at the right time, at the right place, we just get into it. So that's why the book value yield has been taken.
You have selected the flexi cap strategy where we have said that the maximum drawdown should not be more than 40%. And when you have taken the back testing, you have ignored the period of full volatility. So you started from 2011. So 2008 and 9, if you probably back test, then the strategy will have a more than a 40% drawdown, because in only 1 year the equity market had corrected more than 50%, and these are the times when such drawdowns will happen, and that's where that protection is required. So what was that rationale of doing the back testing from 2011?
So basically the 2008-9 were the global crisis. So generally if a market gets this kind of any situations, it may take 12 to 15 months as a recovery period. So post 2010 and 2009 were the years that got the recovery, and 2011 was the year where the steady returns have been generated. The market corrections has been came. So for that reason we have taken the 2011 to 2025 benchmark.
One more question. What was the basis of having your portfolio spread over 60 stocks?
So basically the methodology for taking 60 stock was there to generate the more alpha. To make it more concentric, the alpha will get the more generation.
How did you arrive at it? 60.
So 60 stocks was that there may be a possibility that while having it to 120 stocks, 100 stocks we have back tested, the reason of getting a lower alpha was that the diversification that we have done in the risk stocks. We might agree that we have a concentration stocks into 3 to 4 industries comprising of more than 50-55%, but that's the industry where if as an equity fund I just need more alpha compared to the other funds. That's why we have taken the 60 stocks.
For the purpose of portfolio weightages, you have taken free float market cap. Now generally in a flexi cap fund, I mean if you take free float market cap, it will be a kind of a large cap fund only. The stocks can be varied across various caps, but the percentage exposure will be largely large cap. So what was the thought behind keeping free float market cap as a weighing methodology?
So sir, it was that for the large cap the dividends was the reason, and secondly we have also taken the long tail approach. where the small cap stocks have been also taken, because there might be a possibility of the correction that may get into the small and mid cap also. I agree with you that in the 60 stocks there will be a market free for the higher concentration among the large cap stocks, but there is long tail approach which helps to generate the alpha.
Okay, fine. And my last question is that in landing companies, in the quality factor, you have taken dividend payout. Generally, landing companies, their raw material is cash, so they'll be borrowing. So many companies, those who may not be paying dividends, still continue to be quality.
So for that, we have just taken the other two parameters, ROE and EPS growth median, because if companies are not paying the dividend, but they are just taking their cash into the retained earnings, it will help to grow their business more into sustainable. So to manage it out, we have taken the other two parameters for the quality to balance it out.
Yeah, just a few questions. This market cap weighting, right? So do you intend to have any kind of limits, like large cap, just taking off from his question, large cap, mid cap and small cap, saying that this portfolio will not have more than this percentage in small cap, this percentage in mid cap, this percentage in large cap? Well, because if I go back to that portfolio, I'm not able to go to the previous page. Yeah, I'm not able to actually understand, this weighting, it's 9%, I think, right? It can't be 0.0. No, okay. This is where it starts from.
So here
okay, I didn't see this page.
Yeah.
Sorry. Yeah. Okay. So he's right actually. So that 40% of this portfolio is actually in large cap. But more importantly, you got a significant concentration risk in this portfolio, isn't it? Because look at JSW is 18%, Infosys is 15%, Power Grid is 14%. How do you address concentration risk in this kind of a portfolio?
So sir, basically you have taken in the 40% of the criteria, we have a different kind of industry into it. So on the previous slide, the consumables.
So you have an industry limit also?
Yes. Not we have make any industrial limits, but in the
a sector limit. Do you have a sector limit?
Yeah, sector limit.
But even then you seem to have concentration risk, no? Because 18% in a single stock. Does the, your SEBI regulations allow permit?
Sir, basically as per the SEBI compliance, if the stock may get above the 10% weightage, within the 30 days of the launch of it, we just need to rebalance it. And if the 30 days doesn't permit it, another extension of 30 days has been given by the SEBI. And if
so, how will you rebalance this? So I was not able to get around that. So go back to that portfolio.
Right.
Because you would be spending half your time trying to rebalance. There's a cost of rebalancing also, no?
Yes, sir.
Which will take away from alpha.
So basically we will make sure that to rebalance the concentration into the long tail approach, where another 30 stocks have been having a smaller percentage.
Okay, but how will you do that? Where does your factor come in when you're rebalancing that? I wanted to understand that. Okay,
Sir,
so it's okay. I presume you figured out how you want to do it. The second question I wanted to ask you was that, this maximum drawdown, the MDD, right, is going to be a function of your portfolio allocation. So with this kind of a portfolio, as you keep rebalancing, your MDD will also keep changing, no?
But so the rebalance will only work for the stocks who have been not performing. So we have taken the semi-annually rebalancing
No, but
period.
you have to rebalance just to get into your
I agree with you,
stock limits, no? And the third question, just taking away from where Dhirendra left off in terms of that book value yield, two other things. So in your value, I didn't see PE. So you didn't think that low PE, PE was a factor for value. You just use book value, if I remember, for non-finance companies.
Yes, sir.
So any particular reason why you didn't use PE? Because most of these factor portfolios tend to use both book value and PE. So any reason why you dropped PE?
So we not into the book value, but we use it into EPS median against the PE. So wherein we just compare the PE with the earnings of the share. So that's where we use our PE ratio, not in the book.
Okay, so you just didn't use PE, you used EPS growth
Against the
median to PE.
Yeah.
And can you just explain what that means? Because again, just like the previous one, I was not able to get my head around that.
So EPS to B is like the value discipline where it helps us to identify.
So EPS growth median to PE, so what does that mean? Just explain that to me. What do you mean by that?
So,
That ratio?
so if the companies who have been generating a higher returns, let's assume, and compared to the PE ratio which has been trading in the market,
So
that's
PE I thought was price to earnings,
Price
right?
to
So you got price on the numerator, earnings on the denominator. And then you got something, you're dividing that, something with that, right? What is that? You're dividing EPS growth.
Yes.
Which is again earnings.
Yes.
Okay. So I am a little confused about that ratio, but I mean, maybe you can explain that offline to me sometime. And the last thing is why ROE? Because I've seen everybody, all of you guys using ROE, and I've always been a champion of ROIC. So I wonder why we continue to use ROE. Any particular reasons why you guys use ROE?
So as an equity AMC, we are more focused on the earnings and the return that been generated.
But at the end of the day, it is stock selection, no?
Yeah.
Portfolio construction is about stock selection. So isn't ROIC a better way of stock selection than ROE?
But sir, to get a more alpha, you just need to focus on ROE compared to ROIC.
Okay. ठीक है. That's all I have.
Thank you, sir.
Wow, out of all 8 finalists, this was the only team with an equity portfolio.
At a time when multi-asset allocation funds are the hotcake in the market, you guys still managed to deliver similar returns with a quality-focused portfolio, so that's really great.
Moving on to our next team, Team Cashinova from the Indian Institute of Management, Vishakhapatnam, led by Darshan Katwa, with Aditya Kumar, Rachit Porwal, Dhyai Desai, and Nirghanshu Debarma.
Hello, good afternoon everyone. Cashinova is built on the idea of bringing stability, trust, and long-term wealth creation through a disciplined, rule-based approach to investing. So our leadership team consists of Dhyai Desai as CEO, Aditya Kumar as CIO, Darshan Katwa as CMO, Niranshu Debarma as CEO, and myself Rachit Porwal as CFO. So our vision is to lead in wealth creation with investor value at the forefront while nurturing trust, excellence, and lasting benefits for all stakeholders. Because we want to stand for consistency over hype. Our goal is not chasing fads or short-term outperformance, but creating wealth steadily while caring for every stakeholder involved, be it investors, partners, and the whole ecosystem. So coming to our mission, we empower investors through transparent, data-led investing that removes biases and builds trust. We use clear rules and visible data so decisions stay consistent and investors know exactly how their money is being managed. Second is to promote financial literacy and informed decision making through simple, relatable communication. We translate complex ideas into plain language, helping investors stay disciplined and confident through cycles. Thirdly, we innovate and refine strategies to stay resilient in changing markets. We backtest, we monitor and improve our models regularly, preserving stability while adapting to new conditions. We foster talent and nurture a culture that inspires innovation, growth, and accountability. We empower our people with ownership and clear matrices, so execution stays sharp and investor outcomes improve. We support financial growth and stability within society. We build products and education that encourage long-term saving, responsible risk, and healthier financial habits. So our investment philosophy is built on 6 guiding pillars that ensures we remain true to our vision. Firstly, we follow a clear rule-based process because discipline, not discretion, is what keeps portfolio consistent across cycles. Second, we believe in evidence over emotion. Markets may move with sentiment, but our approach relies only on data-backed insights and time-tested models. Third, our core objective is risk-conscious wealth creation. We don't just aim for growth, but for growth that comes with stability and controlled volatility. Fourth, we operate with an investor-first mindset. Every decision, from stock selection to rebalancing, is aligned to protect and grow our investors' capital. Fifth, our focus is on consistent inflation-beating returns. Compounding steadily over time matters more than chasing short-term highs that rarely sustain. Finally, transparency builds trust. By being fully rules-based and data-driven, we ensure clarity and accountability in everything we look. As we have discussed our fund's vision, mission, and investment philosophy, I now invite our CIO to discuss about the fund scheme details.
Thank you. So before we dive into the technicals of stock selection and weighting, let me first clarify the regulatory foundation of our scheme. We have chosen the hybrid category under SEBI scheme classification, specifically in the multi-asset allocation fund. Why this subcategory? Because SEBI has clearly defined that any fund under the head must invest at least in 3 asset classes with a minimum allocation of 10% in each. This ensures built-in diversification and protection against overexposure to one asset. Now in terms of compliance, our portfolio has been constructed with a static 60:20:20 allocation that has an 60% equity, 20% debt and 20% gold. This not only satisfies SEBI's 10% minimum requirement across 3 classes, but also aligns directly with our philosophy of balancing growth with safety. Equity at 60% gives us strong growth participation in India's economy. Debt at 20% provides predictability, income and stability. Gold at 20% acts as a natural hedge against volatility and inflation. By maintaining this structure, we are not only SEBI compliant, but we are also demonstrating the discipline. We are not chasing short-term market movements. We are creating a framework that offers clarity, transparency and consistency. Now let me walk you through the equity side of our portfolio, which forms 60% of the overall allocation. To begin with, our investment universe is restricted to the top 300 listed companies by market cap. Why? Because beyond this range, liquidity reduces significantly, making entry and exit difficult. By focusing on the top 300, we ensure that our portfolio remains both practical to execute and efficient to manage. Within this universe, stock selection is entirely rule-based through a multi-factor model. We have deliberately chosen 3 complementary factors that together balance growth, safety and quality. First is momentum, which is 35%. This is our dominant factor. It identifies stocks that are already outperforming, capturing upward price versus trends and ensuring the portfolio participates in the market rallies. Low volatility is 20%. This acts as a stabilizer. It helps control drawdowns and ensures capital protection, particularly in turbulent market phases like COVID. Quality is 5%. Finally, we add a filter of strong fundamentals, company with robust cash flows, stable earnings, and sound balance sheets. This ensures we avoid structurally weak names. This factor blends allow us to strike the right balance. Momentum gives us upside participation. Low volatility ensures downward protection, and quality ensures long-term resilience. In short, this methodology creates an equity portfolio that is not only data-driven, but also practical, resilient, and fully aligned with our philosophy of delivering consistent risk-adjusted returns. Our entire framework, from factor selection Two asset allocation is built to directly align with our investment objectives of delivering consistent risk-adjusted inflation-bearing returns. First, low volatility is our anchor factor. It reduces downside risk and ensures that during volatile markets, our portfolio remains resilient and protects investors' confidence. Second is the quality that ensures we select fundamentally strong businesses, companies with robust cash flows, stable earnings, and long-term growth potential. This makes the portfolio structurally sound and durable across cycles. Third is the momentum, which plays a tactical role. It captures stock with upward price resistance, allowing us to participate in rallies and not miss out market upswings. And finally, the multi-asset allocation of equity, debt, and gold smoothens the return trajectory. Equity provides growth, debt ensures stability, and gold acts as a hedge during global uncertainties. Together, these choices are not standalone. They work as an integrated system to deliver what our investors truly want, which is steady compounding, reduced volatility, and confidence that their money is working for them, not against them. Our scheme has been designed to strictly comply with SEBI product categorization norms while maintaining internal safeguards for transparency and investors' protection. First is the category compliance. We fall strictly under the multi-asset allocation model with exposure to equity, debt, and gold, maintaining a minimum of 10% in each, while also allowing flexibility in adjusting allocations and ensuring sector-wise diversification. Second is the benchmarking compliance. We follow SEBI's mandated two-tier TRI-based benchmark structure, which ensures that our fund performance is always compared fairly and transparently. Third, disclosure compliance. We adhere to SEBI disclosure framework, including the riskometer, portfolio details, and strategy disclosure. Beyond regulatory norms, we have added internal safeguards, such as restricting equity to the top 300 companies for liquidity and applying a rule-based stock selection methodology to enhance transparency and implementability. Finally, rebalancing compliance. Our scheme is rebalanced semi-annually to align with strategic weights, and in case of passive breaches, adjustments are made within 30 days, as per SEBI guidelines. This ensures regulatory discipline while maintaining portfolio stability for investors. In short, every element from allocation to benchmarking to disclosures and rebalancing has been structured to reflect both compliance and credibility, so investors know they are in safe hands. Now they will take over the presentation.
So, talking about the important ratios that we have considered, the KPIs for our portfolio are Sharpe ratio, Sortino, CAGR, and max drawdown. Talking about Sharpe and Sortino, the Sharpe ratio was around 0.68 for our portfolio as compared to the risk-free rate, and Sortino was coming out to be around 1.05. Talking about the CAGR for SIP performance, it was around 13.71% at a 10-year annualized returns. Talking about the max drawdown, which came around the COVID time period, which was the most stressed time period, considering the 10-year horizon that we have taken for our investment, was around 16%. Talking about staying true to our investment philosophy, our motive was risk-conscious wealth creation. And how do we maintain that? We maintain that by capital preservation, as you will see in the next slides, how our portfolio has performing in respect to our benchmarks that we have selected, and not deviating much from the rules-based investing across various market cycles, and remain true to our philosophy, as well as generate excess returns for the investors seeking wealth creation. So, as we can see, comparing the tier one index, which is Nifty TRI index, the volatility for the index is around 16.29%. However, the volatility for our portfolio was around 7.1% only, which is around 52% lower than the benchmark portfolio. Talking about March 2020, our portfolio fell by 16.1%, which was the max drawdown seen by our portfolio. The reason for selecting a 10-year horizon for our portfolio was that we believe that in a 10-year period, there is a market cycle which is already been repeated, and there are a lot of fundamental changes which are already taken into factor in a 10-period horizon. However, if we go a lot backdated a lot back at a later date, then it does not involve a lot of fundamental changes that have happened in the economy and markets at large. Talking about the tier two benchmark that we have selected equity, debt, and gold at a 50, 25, 25 as a hybrid benchmark. Our performance in that respect also is quite outstanding. So that is that. Talking about the factor-driven stock selection, we have taken 20% weightage to low volatility, 35% weightage to momentum, and 5% weightage to quality. Low volatility and quality are complementing factors, and so we basically had a portfolio created to test whether there is a correlation between these two parameters, these two factors, and there was a high correlation, and that is why we have included those. Apart from talking about the factors we have included, particularly in quality, we have included for non-financial companies, we have included ROIC, operating cash flow by EBITDA ratio, and ROE, which is the return on equity for non-financial companies. For financial lending companies, we have taken equity to total capital at 60% weightage, and ROA, that is return on assets, at 40% weightage. Talking about the investors' tax implications, as we are not classified as an equity portfolio, our investors are taxed at long-term capital gains tax, that is 12.5%, considering much lower tax rate as compared to debt portfolio or an equity-oriented portfolio. The debt portfolio is usually charged at investors' tax slab, which goes as high as 30%, and equity-oriented portfolio, which has two categories, short-term as well as long-term. Now, taking forward, Darshan will continue.
So our scheme is built with a very clear target audience in mind. We are focusing on retail investors with a steady monthly income who are comfortable investing through SIPs. These investors are not chasing speculative highs. They want a blend of growth and safety. What they seek is consistent long-term wealth creation without the stress of extreme volatility. This fund resonates especially with individuals who value stability, discipline, and peace of mind in their financial journey. In simple words, it's for the everyday earner who wants their money to work hard, but in a safe and steady way. What truly sets our scheme apart are four core strands. First, rule-based discipline. Every investment decision is driven by a 100% quantitative framework. This completely eliminates human biases and emotions and ensures objectivity and consistency. Second, consistency over cycles. Our strategy is designed to weather different market phases. Even during stress events like COVID-19, the portfolio showed lower volatility and controlled drawdowns, proving its resilience. Third, the balanced asset mix with a 60-20-20 allocation across equity, debt, and gold. This structure ensures that we capture equity-led growth, maintain stability through debt, and hedge risk with gold. And finally, proof-backed results. Our back tests show the portfolio delivered 52% lower volatility and over 50% better drawdown control compared to the benchmark. That means investors get a smoother journey without compromising on returns. So in essence, our USP lies in offering investors the rare combination of discipline, resilience, balance, and proof. Our communication philosophy is built on simplicity and trust. We call our story investing that feels right, because at the end of the day, investors don't want jargon or noise. They want confidence and peace of mind. So instead of overwhelming them with complex models, we translate our quantitative strategies into clear, relatable, and simple messages that show how their wealth can grow steadily without unnecessary risk. We focus on trust, clarity, and long-term compounding rather than short-term hype. This ensures that our investors not only understand what we do, but also feel aligned with our disciplined, risk-conscious approach. In short, our communication narrative is not about selling a product, but about building a relationship of trust that lasts throughout every market cycle. Our go-to-market strategy, blends trust, accessibility, and personal connection. We begin with an on-ground presence through investor awareness programs, community events, and collaboration with our trusted distributors. This allows us to meet investors where they are and build credibility face to face. At the same time, we strengthen our digital connect with bite-sized explainers, educational videos, and simplified fact sheets designed for the retail investor. The idea is to demystify investing and make it feel approachable. And most importantly, we believe in personal engagement. For us, it's not just about returns, it's about understanding life goals like retirement, children's education, or financial security, and aligning our solution to them. In short, our GTM ensures we are visible on the ground, accessible online, and always connected to investors' real needs. Our vision doesn't stop at one scheme. We want to gradually build a product suite that stays true to our philosophy and rules-based, risk-conscious investing. First, we will launch factor-dominant equity funds, which are smart beta offerings built on low volatility, quality, and momentum. These are designed for investors seeking equity exposures with sharper risk control. Second, we plan life cycle hybrid funds tailored to different life stages, whether it's a wealth building in the early career phase, balancing growth and safety in mid-career, or prioritizing stability and income closer to retirement. And third, we aim to introduce passive plus quant funds, low-cost equity funds enhanced with disciplined factor overlays, providing investors with an accessible yet risk-adjusted solution. Each of these offerings builds on the same promise: clarity, consistency, and trust, while adapting to evolving investor needs. To conclude this roadmap, every step we have laid out is aligned with our larger vision to be the most trusted partner in wealth creation. Our focus remains on delivering consistency, reliability, and clarity, while ensuring that all our stakeholders, from investors to partners, grow together with us. This is not just a product plan, it's a long-term commitment to building trust and stability in every market cycle. Because at Cash Nova, when it feels right, it grows right. Thank you.
Yeah. In your multi-factor model, momentum, liquidity, and quality just adds up to 60%. What happens to rest?
Right. So it's the effective. So on the portfolio level, it's the effective weightage that we have considered. Equity for us, equity is 60%. So 35 plus 25, 35 plus 20 plus 5, it's totals to 60. Yes, that is only for the equity part.
Yours is a multi-asset allocation fund, and your tier 1 benchmark is Nifty 500
right.
TRI. So I didn't understand that.
Right. So we have from the universe that we have selected Nifty 500 as the universe. Out of that, we have taken out top 300 stocks based on the market capitalization, and that is why we have kept Nifty 500.
No,
Just because
I understand that, but you have kept as you are benchmarking your scheme with Nifty 500, while yours is a multi-asset allocation where only 60% of your exposure will be in equity, and you are benchmarking with 100% equity index.
Right. So that is why we have kept tier 2 benchmark as well, which is more aligned at 50, 25, 25 equity debt is to gold.
And your number of stocks is 60, I guess. 20 from, you have taken each factor differently. Momentum, the number from momentum, you will take 20 stocks from quality, and 20 stocks from low volatility.
No, so at the portfolio level, which as shown in the Smart Beta platform, Test 21, we have given weightage to each of the portfolio, each of the factors, and then we have come to a conclusion. So how we have designed our portfolio is that we created separate portfolios for a momentum factor, one for volatility factor, and then for quality factor. Combining them in the master portfolio, which is the final portfolio, we have given particular weightage to each of those factors. That is all.
So there will be total 60 stocks and 20 from each factor, while the weightages may vary, but that is how you have constructed. How many stocks will be there in your portfolio?
Final portfolio will consist of 20 stocks.
Only 20
yes.
stocks?
Yes, sir.
Okay, fine.
So can you just tell me what was your tier 1 benchmark and tier 2 benchmark? I mean, I'm a little confused on that. So what's your tier 1 benchmark?
Tier 1 benchmark is Nifty 500 and tier 2 is equity debt gold 50 is to 25 is to 25.
Okay, it's an equity debt gold benchmark. Okay, well, I didn't see that in this chart or something. Okay, just a question. You have used low volatility and you've sort of at a 20% weight, right, for equity?
Right.
If I'm correct. So, and you've got 40% of your sort of portfolio in debt.
Sir,
for debt and gold.
Yes, debt and gold. 40%.
So 20% in debt and 20%
Yes.
in
Yes.
gold. Okay. So because I'm just wondering whether you have a crowding effect that reduces returns, because what will happen is that low volatility and debt tend to reinforce each other's. So would it not reduce your returns?
So the logic behind keeping debt is to have a consistent flow of income for the investors in the portfolio. If we take considerable amount of debt, then there will be a lot of consistent cash flow being generated for the investors. So the main logic for keeping debt was that.
Okay, and you in terms of your future products, somewhere you talked about what is it? Again, factor-based equity funds or something like that. How is it very different from this? What is the difference you're talking about?
So we talked about equity dominated fund.
So you have said factor dominant equity funds. So why is it different from this product?
So that basically is a extended version of
It's
this product.
still low vol quality and momentum. So you're still using low vol quality and momentum in this product also, isn't it?
Yes, sir.
So it's just going to be isn't it going to be the same product? I'm just wondering.
No, sir. It is not very different from the product from the current product.
Okay, so you'll have difficulty sending the same product, a similar product again to the same set of investors. Just but it doesn't seem to be pure. I don't know. And the other one is, what is this passive plus quant fund? Can you just educate me on that? Because you say low cost equity fund with disciplined factor overlays for risk adjusted return. So the passive part comes in where? And quant fund, I didn't understand this term, so if you could educate me, I'd be sort of a little bit wiser.
The quant part comes in the rules-based approach that the fund follows.
So how is it different from a factor, the first one, the factor fund?
Probably we'll try to enhance the quantitative parameters or the quantitative factors that we have employed right now, and later on what we'll be including.
Okay, sure, thanks.
Thank you.
That was another wonderful presentation. The way you built your equity portfolio using a unique strategy based on momentum, low volatility and quality factors really stood out. Next up, we have Team Alpha Edge from the Indian School of Business, Mohali, led by Het Chande with Devansh Modi, Devam Gada, Shubham Badoloi and Karan Agarwal.
Good afternoon, everyone. We are Alpha Edge, a team driven by one ethos, rule-based wealth creation. I am Het, the CEO, here along with our entire team. Our mission is clear, which is delivering consistent inflation-beating returns through data and discipline. we stand steadfast on our four core principles: 100% rule based investing, data driven, risk controlled, and utmost transparency. You would ask, why rule based? Because even the smartest fund managers are not immune to biases, chasing recent winners out of recency bias, panicking in downturns due to loss aversion, and holding on to poor bets due to overconfidence. Systems don't tend to get emotional and always stay disciplined. Now, while analyzing the market trend, we realized that this is the right time for launching a smart beta fund because, as you can see, while index funds stand at an AUM of 2.7 lakh CRs, smart beta funds are only a meager 0.3 lakh CRs, but the fastest growing category. Also, looking at US and other dominant economies, momentum, quality, and value have been proven there across decades of data. Now coming to our product is fully SEBI compliant. We maintain 3 asset classes at all times with a fixed 50-25-25 balance in equity, debt, and gold. No single stock is more than 10% of our NAV, and we use only approved instruments with full monthly disclosures. Our benchmark also mirrors this very same allocation. One of the biggest advantages of our product is the tax efficiency that comes with it. Multi-asset allocation funds are taxed at 12.5%, which is similar to equity provided held for more than 2 years. But unlike pure equity, this comes with far more stability because of our 50-25-25 split. Retirees benefit more from post-tax income with less volatility. HNIs can avoid the heavy slab drag on pure debt and gold holdings. And young professionals get more tax-efficient compounding. So in short, Alpha Edge delivers the twin benefit of equity-like taxation with multi-asset stability. Now I'd like to hand over to Karan.
So we have divided our presentation into 5 categories. Let's dive into the first one, the asset allocation. First, understand why do we invest. The primary reason being we want to grow our wealth. The biggest challenge which we faced is how do we build wealth through a more balanced approach, through a more conservative approach. Our strategy is a balance across 3 distinct asset classes. 50% goes into equity, which is our engine for long-term growth. 25% is allocated to debt, providing stability and consistency. 25% is in gold, acting as a powerful hedge against inflation and systemic shocks. This isn't a tactical mix that changes with market sentiment. It's a rule-based, disciplined allocation. We rebalance quarterly, which prevents us from becoming overexposed to any one asset class and ensure we consistently buy low and sell high. To validate this design, we studied how these assets have historically moved together. For equities, we used monthly data from the Nifty 500 try. For debt, we used the 10-year benchmark GSEC. For gold, we used the gold ETF. And we have built a correlation matrix from that history. The blue and the red lines clearly show that for both gold and debt have a consistent negative correlation with equities. When equities fall, these defensive assets tend to rise. This is most dramatic during crises like COVID crash in the early 2020, where you can see the correlation plunged to nearly minus 0.4, providing maximum protection when it was needed the most. Crucially, debt and gold have a very correlation to each other, meaning they act as complementary defenses. This 3-way design is decorrelated and enhances portfolio stability across all market cycles. Let's understand, is this a one-off event or history repeats itself? Let's look at the years when equity markets were hit hard. In 2008, when our equity portfolio saw a significant drop, our debt and gold components delivered strong returns of 17% and 26%, acting as a powerful risk cushion. Again, in 2011, a negative year for equities was offset by a 31% gain in gold. In 2018, a flat year for stocks was supported by positive returns from both debt and gold. This isn't luck, it's the power of non-correlation, creating a more smooth and resilient returns.
Now coming to a QVM model, we have allocated 30% weightage to quality, 30% to value, and 40% to momentum. And we'll speak more about it in the coming slides. So coming to quality, what exactly is quality? quality is owning financially sound companies. Post a lot of research, we have narrowed down 3 key metrics. First is the free cash flow conversion. This basically measures how much of the accounting profit actually turns into cash. Because a company might show paper profits, but only those who consistently convert them to free cash flow are resilient. This helps us capture businesses with real usable earnings that can fund growth or withstand downturns. Second metric being ROIC, which is the return on invested capital. High ROIC means management is deploying resources wisely. And we picked this because it directly reflects operational discipline and long-term sustainable profitability. The last metric being interest coverage, which is EBIT divided by interest. A high interest coverage ensures that company isn't over-leveraged and won't buckle under pressure in crisis years. These help us identify firms that are built to survive shocks and compound steadily. Since the 2008 financial crisis, Indian quality stocks have outperformed consistently, recovering faster in downturns. S&P's research paper on factor investing in India ranked stocks into 5 quintiles, as you can see on the left of the slide, based on any chosen factor. So here, for quality, quintile 1 represents the highest quality companies, while quintile 5 are the lowest on those measures. This chart clearly indicates that quality outperforms both in annualized and risk-adjusted returns, proving the existence of a quality premium. Hence, we can say that quality balances momentum's aggression and provides stability in crisis. With that, I'll hand over to Shubham.
Thank you, Hate. Next, let's move on to the view in our QVM, which is value. Value is basically our mean reversion engine. We look for fundamentally strong companies trading below their intrinsic worth. When sentiments overshoot, price tend to drift back towards fundamentals. Value harvests that rebound. In our mix, it complements momentum's growth tilt and quality stability, and typically helps us most in sideways market or early recovery markets. We keep the signals simple. First, we have the median of 5-year PE divided by the current year PE to catch stocks that are cheaper versus their own history. And next, we have operating cash flow over enterprise value to capture cash yield to all capital providers. Why these, you may ask? They provide price mean reversion, behavioral mispricing like overreactions and loss aversions, and risk premium that compensates patient holders. Going to the same report that Heth had used, Indian evidence show a noisy leadership for pure value. In some periods, the cheapest, that is Q1, has underperformed the prices, that is Q5, and the quintile pattern isn't clear at all. So we cap value at 30% and refine our definitions rather than overweight it. We still include it because value helps us diversify, as it is negatively correlated with other factors. We'll speak about this more in depth later. Passing on to Devam.
Thank you. So now let's talk about the momentum factor. So momentum in simple terms is the tendency of high performing assets to continue their upward trend and recently underperforming assets to continue their downward trend. Now this anomaly has been documented extensively both globally and in India, and it works usually because markets often underreact to new information, hence these trends persist. Now these trends are then reinforced by institutional flows, and finally investors also demand a risk premium due to the additional volatility that these stocks carry. Now we also looked at the analysis conducted by NJ in their momentum factor book, and we found that over longer horizons, the 6-month and 12-month momentum deliver the highest CAGR of about 21% with manageable volatility, but with drawdowns being somewhat higher in the 12-month period. Now the 3-month signal significantly underperforms compared to others, and most importantly, the performance gap between the top and bottom 100 stocks is massive, about 15 to 17% annually. So our takeaway from this is basically that the sweet spot lies in between the 6 to 9 month range, where returns are strong and volatility remains under control. And that's the basis of our design. Now similar to the research on other factors done by S&P, we see that for momentum, the top quintile consistently outperforms the bottom quintile. And secondly, we see that the returns fall steadily from quintile 1 to quintile 5, showing consistency of the signal. And as we discussed earlier, we find 6 to 9 months is our sweet spot, hence we use a 9-month return horizon. We also introduce a 1-month lag, since one of the key risks with momentum is the sharp recoil that can occur when a trending stock reaches its turning point. The second refinement that we made over here is volatility scaling. So we have introduced a 1-month volatility scaling, since without adjustment,
highly volatile stocks would dominate momentum scores, exaggerating these signals. Now finally, in our portfolio construction, we chose to weigh stocks by their momentum scores instead of composites factor scores. The reason for that is that our research clearly shows that momentum is the most reliable indicator of near-term price persistence. Now next, from the same study conducted by S&P, we also looked at correlations between factors along with performance and risk. So while momentum delivers the highest annualized returns of 19%, it also has the highest annualized standard deviation, which means that it is also highly volatile. Now that's where value and quality steps in. So quality delivers the strongest risk-adjusted return at 0.93, cushioning drawdowns. And value acts as a diversification engine since it is negatively correlated with both momentum and quality. Now let's see how our QVM model would construct the portfolio. So first, it would start with the Nifty 500 universe at the top of the funnel. Next, it scores these stocks on momentum, quality, and value, blends them using capped Z-scores, and selects top 45 names with the strongest composite signals. Now once we have these 45 stocks, this model would weigh allocations by momentum score, while quality and value just act as screeners. Now the next step would be that these stocks would be rebalanced quarterly with a 10% cap per stock, ensuring discipline and diversification. Now the final output that comes out of this is a momentum weighted, quality and value screen 45 stock portfolio designed for higher risk adjusted returns.
Thank you. So now that we have explained our portfolio construction methodology, let us analyze how our portfolio actually performed. So if you see on the slide, over the backtest period, the fund compounded at nearly 18% CAGR compared to 12% for the benchmark, and with a visibly smoother path through the stress periods. Now on the left, you see cumulative NAV growth for our fund versus the hybrid benchmark and inflation. Now that gap represents disciplined compounding over time, not discretionary timing. The inflation series is included on the same axis to highlight consistent real return generation. In simple words, 100 rupees invested in our fund grew to about rupees 2200 compared to nearly rupees 900 for the benchmark. Moving on the right, the rolling returns panel shows stability across holding periods, outperforming the benchmark in the longer term. On the left, the sector allocation and return contribution chart decomposes returns across sectors, showing broad alignment rather than concentration in a single theme. Moving ahead, the blue line on the graph on the left side shows top 5 holding share of the equity sleeve. During bull runs, you can see it rises above 35 to 40%, indicating that the model is clustering into high conviction winners. But in volatile or sideways markets, this naturally declines as the breadth increases and exposure is spread more evenly. This dynamic concentration helps capture uptrends while moderating risk in uncertain regimes. Now, this chart over here shows the portfolio breadth, that is how many stocks are really driving performance at each rebalancing period. The data reinforces our inferences from the previous slide by showing the resilience and concentration in high conviction names. And in the bottom table, you could see the integrated multi-factor approach that we have used delivers both superior absolute return and higher Sharpe ratio versus individual sleeves alone. Thus, the factors indeed work better together and not in isolation. Now moving to the widely known risk metrics, so information ratio of 0.25 indicates a moderate active management skill which adds value to the benchmark through real active risk instead of just hugging the index. A tracking error of 10% indicates genuine active management, and through capture ratios, we capture the profile asymmetry. That is, we participate effectively in rising markets while demonstrating defensive characteristics in downside markets. This reinforces our factor construction methodology where momentum enables participation and quality and value reduce drawdown sensitivity. Now, Sharpe ratio, which basically measures the excess returns earned per unit of risk assumed, our fund delivers nearly 2x returns per unit of total risk compared to the benchmark. Again, in case of Sortino, which measures the excess returns generated per unit of the downside risk assumed, our fund provides nearly 2x downside protected payoff versus benchmark. Thus, we don't just generate returns, but we also ensure efficient risk taking. Furthermore, a tenor ratio of 14% indicates that excess returns earned per unit of systematic risk. This complements the Sharpe and Sortino analysis by conditioning on systematic risk rather than total volatility. Moving to the statistical diagnosis, the adjusted R-squared of our model is 86%, which means that the chosen factors, QVM, explain most of the return variations, and the regression beta of 0.82 indicates risk-controlled exposure to market sensitivity. Additionally, our VAR analysis reveals that there is only 1% chance that a fund would lose more than 22% of its value over the next year. And if it does lose, it would lose 25%, which is explained by expected shortfall. This calendar year view shows the breadth and persistent annual outperformance with smaller drawdowns in stress years. And one of the lesser known metrics, omega ratio of 14%, also indicates that the probability weighted upside of our portfolio exceeds the downside by 14%. Thus, every unit of risk that we assume has more potential reward. To summarize, the rolling return charts summarize the fact that timing the market is not as important as staying invested in the fund over long periods. Hence, in terms of NAV growth and risk-adjusted metrics, our fund compounds well steadily and delivers a smoother ride for investors. Now, you would have noticed over the portfolio analysis slides, our fund posted strong risk-adjusted metrics, but one thing that we missed out on is drawdown. So, we'll now analyze drawdown in more details.
So the backtest is just one possible journey from 2006 till today. But of course, the future can look very different from today. And we needed a way to see not just the outcome, but the full range of different possibilities which can occur. And Monte Carlo simulations help us do exactly that. We did a Monte Carlo simulation of 25,000 different unique 10-year paths using historical averages, volatility, correlations, and the geometric Brownian motion assumption. The results? Well, in 96% of them, the portfolio met the objective and comfortably beat inflation by over 4%. The most likely outcome sits at around 17% annualized return. Now, talking about drawdown, the median drawdown across simulations was about 8%. That's very shallow compared to equity-only portfolios, which often see 30 to 50% drawdowns. Even in the worst 95th percentile and the 99th percentile drawdowns, we observed around 14% and 18% drawdowns in those cases. And even in those cases, the portfolio still preserved capital and bounced back because of rebalancing and diversification. On the upside, the best case scenario delivered over 13% CAGR, showing the growth potential of our whole portfolio. So to conclude, this gives us confidence that we're building for not for an uncertain future, taking into account numerous possibilities which can occur.
Quickly moving on to the implementation side of things. So firstly, we have segmented the market into these four segments, four clear personas, which are retired professionals, army veterans, HNI clients, and long-term investors. We have conducted a bit of primary research, which give us details about their SIP investments, lump sum investments, their volatility tolerance, and expected CAGR, and also their time horizon that they're looking to invest in. Using these, we have created the promotion mix, which basically uses digital for reach, FIAs for conversion, and is supported by events and PR. For content, we lean towards education, and for opportunity score, long-term retail investor have the highest, followed by HNI, with a clear niche for army veterans. The most important thing in this slide is the white space map. We have the key insight here is that the y-axis is degree of rule-based transparency and the x-axis is level of diversification. Our fund operates in the topmost quadrant in this graph. That is our position and our moat. It clearly improves on all the other pure equity funds, passive investment indexes, and hybrid balance funds. Moving on to the implementation timeline, month 1 to 3 are set up, 3 to 6 log the QVM model and compliance and finish brand framework, 5 to 10 focus on market education and awareness, 7 to 11 run the pilot, stand up infrastructure, and go to full scale launch. Partnering with RIAs and distributors targeting especially tier 2 and 3 cities. While all of this is going on, we are constantly dedicated to KPI tracking to stay true to our label. On daily execution, we simply mirror the model. Whatever we receive, net inflows or redemptions, is executed as a pro rata basket. As our AUM increases, we cap our daily budget buying in at 10% of the average daily value of the stock, as slippages may exceed post this. Full portfolio rebalancing happens once in a quarter. For non-equities, we use plain vanilla SEBI-permitted instruments such as high liquidity debt and gold ETFs. We charge an expense ratio of 0.5% so that we do not make a dent in the client's pockets either. Our communication, I'm so sorry for going over time, this is our last slide. Just wrapping up. Okay, so that our communication is to educate, to remove emotion, show transparency on factors and SEBI alignment. And further, we would like to end just by saying the three magic words in Gujarat, Bhav Bhagwan che. But for us, we believe that rules Bhagwan che. Thank you. We are open to questions.
Yeah, in the quality and value factor, you have not considered lending companies. Why so?
So mainly for this, I think, so we did several backtesting variations with and without financials. And our thinking behind this was basically that financials form about 40 to 50% of Nifty 500, and in strong upturns, our model would keep on picking them, and there would be a huge sectoral allocation to financials. Secondly, we thought that this sector is very strongly correlated to each stock internally in downturns, which could lead to a breakdown in case of a black swan event. And lastly, a lot of landmark studies, including Pharma French, Barossa, and they have excluded them because the capital structure and accounting is distorted by the factor signals.
Financials will only get selected by way of momentum. That is what I understand. Is my understanding correct? The financial.
The same report which we had used for all the data here. I'm so sorry. Let me just.
No, the data is fine. I'm just asking any banking company which is getting selected in the portfolio, it will be only because of the momentum factor, right? Is my understanding correct, and not quality and value?
No, we are completely excluding financial sector as a whole in our portfolio.
So there is no financial sector.
financial
You have
sector.
not considered even in.
No.
So you have not taken any banking company or a lending
No,
company.
we have not.
Okay, fine. So any logic for that? I mean, the huge weightage in the benchmark.
So the key logic here was that while we were going 40% heavy on momentum, one thing we realized is we wanted to cap the downside because our initial drawdowns were a little bit higher than we wanted. So the key factor here was to limit the financial companies, because when the market is in an uptrend, financials are the one which gives the boom, but they are also the first ones to go bust. And when we did read a lot of research papers, we also found that studies like Deva mentioned, Borelso and Sashi, they also excluded them in their analysis and found out that excluding financial companies gives better downside protection. So this was a key rationale for downside protection, basically.
What was the outcome if you had considered the financials? Can you just share?
The drawdown was more than the benchmark.
Higher, okay, fine.
Just one point to add to that, when we were also looking at value and quality as factors, and within that we were deciding metrics. So when we picked up ROIC and ICR and all these metrics, so there was a table on NJ platform, I remember, where it was mentioned the advisability whether to use financial companies or not, because capital structures may be very different for financials and non-financial companies. So when you use ICR as a metric to screen stocks, then it will be heavily skewed. So even based on that, we decided to not include financials.
Okay. And you have taken a 9-year look back period. These days there is a lot of disruption happening because of AI and other things, and a 9-year look back period is a very long period. Don't you feel so?
Yes, I do agree that a lot of disruptions are happening, but for quality and value, we are only screening our stocks. We are only using them to screen our stocks. Momentum has the highest weightage even in the QVM model, and we even weigh our portfolio, all the stocks in our portfolio using momentum. We are using a 9-year look back period so that we are sure that okay, this is a good company which will do well. This is not this is basically to weed out all the companies.
Yeah, exactly.
For instance, IT businesses have done phenomenally good in the last 9 years, particularly software coding and all, but that may not be the case in future with so many disruptions happening in that sector. So how do you factor that forward looking also?
So that would come under momentum. So these stocks would be picked up by the momentum score and the weightage in momentum score. So for quality and value, we need old, like the companies which are time tested. So that's our division.
Yeah. All right, fine, I'm done.
Just go to that slide where you've done that Monte Carlo simulation. Somewhere I didn't, I mean, what you said and what I saw on the slide, I couldn't correlate. So could you just explain that once again to me?
Sure. So how we model?
So the worst case was 30% drawdown.
Yeah.
With a CAGR of 3.91.
Yes, that's the absolute worst case in the 25,000 different simulations which we did.
In the
Yes.
simulations that you did. Okay. And the best case was a 6% drawdown. Is that what you're saying?
Yeah, correct. Yes.
Okay. Because I'm wondering, because if you look at the best case and the mean, I mean, the sort of, it does seem to look a little skewed, that result. So I was wondering whether that's statistically significant or not. So your mean is not, something like 9% and 17%. So the drawdown looks significantly less, but the CAGR is halved. So I mean, I was wondering whether it's statistically, is there any significance I should read into that? That was one question that I had. The other question is, in these two factors, that's quality and value. In quality, you have used free cash flow to NOPAT, and in value, you've used, I think, operating cash flows to enterprise value, if I'm not mistaken. I mean, they almost look the same, isn't it?
Yes.
Number-wise.
We did think about this as well while we were coming up with the values, like coming up with the metrics. So for free cash flow, it excludes capital expenditure. When we're calculating free cash flow, we subtract the capital expenditure. So that basically gives us a judge of how much the company is spending and like currently for future incomes. OCF, on the other hand, is how much it is earning on the basis of their operations currently. So free cash flow is a future outlook. How are they doing in the future? How would they probably do in the future? And operating cash flow is for current year. How are they doing right now?
We are done. Very good. Thank you.
Thank you.
Amazing presentation. The way you detailed your investment philosophy and used Monte Carlo simulation really stood out. And now it's time for the last team of the day. Let's welcome Team Alpha Generators from the Indian Institute of Management, Raipur, led by Dharmendra Yadav, joined by Aman Kumar Shah, Harsh Tiwari, Shreya Raghuvansh and Astha Bansal.
Okay. Good afternoon, everyone. We are Team Alpha Generators from IIM Raipur. So I will start with a quote that once Steve Jobs said, that is, great things in business are never done by one person. They are done by a team of people. So I would like to introduce my architects of Alpha Generators, that is me, Aman Kumar Shah, serving as CEO, followed by CFO Harshvardhan Tiwari, Chief Compliance Officer Astha Bansal, and CIO Dharmendra Yadav, and lastly, Chief Marketing Officer Sriya Raghuvans. If you look at the mutual fund in India, it began with UTI as a household savings channel, and today this industry has evolved into a retail-driven SIP revolution, with monthly inflows now crossing about 28,000 crore. Yet, India's AUM remains just 18.2% of GDP, with compared to the global average of 182%. This gap highlights massive untapped potential, especially in B30 cities. Alongside, passive and factor-based investing are scaling rapidly as transparent, low-cost alternatives, giving Indian mutual funds a strong structural growth runway. Against this backdrop, here we present our mutual fund, that is NJ Asset Aggressive Hybrid Regular Fund, with a tagline built on rules designed for resilience. And our mission is simple: to simplify wealth creation through rule-based, factor-driven funds that deliver growth with stability, protect capital across cycles, and build enduring investor trust. So, our philosophy lies on 5 pillars. The first and foremost is the core ethos, that is trust, discipline, consistency, with long-term focus on investor goals, followed by a rule-based approach, that is 100% rule-based and data-driven, eliminating biases. The next is multi-factor approach that balances risk and return, and so resilience across cycles. And the fourth is investors that they ask is outcome. We target a 3 to 4% above inflation with lower volatility and investor-centric design, that is SIP optimized for disciplined and sustainable wealth creation. Looking at the objectives, our objectives are clear, that is long-term wealth creation with capital protection, along with superior risk-adjusted return and resilience through backtesting across multiple crises. Factor-based portfolio construction is introducing debt for stability through 25% allocation on debt and disciplined rebalancing of 100 diversified stocks and SIP and growth. Now, I would invite Astha, our Chief Compliance Officer, to share more on fund specifics.
Thank you, Aman. When it comes to SEBI, the compliance is not negotiable, it is mandatory. So as an aggressive hybrid regular fund, we have been 100% SEBI compliant. As the product category, SEBI specifies 65 to 80% equity investment while keeping the 20 to 35% debt. Our mutual fund has 75% of equity, 25% of debt, which gives the investor protection against the volatility in the market of 100% equity while giving them 100% tax benefit similar to as an equity-oriented mutual fund. Now, as come to the TER ratio, we looked at the limitations and we have kept it at 1.18%, which is 1% plus GST. It is covering all the costs which is required for rebalancing while coming the stricter rules and having the cost saving for investment. Now for the disclosure, we have made the detailed fact sheet having the disclosure regarding all the asset category, riskometer, and all the other industry-wise holdings as well. In the benchmark index, we have used that 75 to 25 index, and we have also completely disclosed the performance of the benchmark against our mutual fund. Now, talk about diversification of risk, which is a primary goal for the investor. We have kept 100 stocks in the portfolio, out of which 25% is debt, and we have done the diversification according to the SEBI guidelines, keeping the cap at maximum 5% per stock. Now the parameter weightage will be explained by Dharmendra.
Thank you, Astha. So now I will discuss about the portfolio factors, how much weightages we have given to the factors and specific parameters. So we have considered all 4 factors for building our portfolio rule. So firstly, we have given 30% weightage to the momentum, because momentum captures short-term to medium-term price movement. So we can work on, we can consider that. And secondly, 30% weightage to the quality. Why? Because quality will provide us resilience during the downturns of a market. And thirdly, we have given 25% weightage to the value, so that we can target undervalued stocks with long-term re-rating potential in those stocks. And secondly, it will also help us to avoid paying high amount of money for the overvalued stocks in overvalued markets. And fourthly, we have given 15% weightage to the low volatility so that we can reduce the portfolio volatility without diluting our growth potential. So now I will discuss about the specific parameters which we have selected for the factors. So coming firstly for momentum, so we have chosen the scaled momentum instead of a non-scaled momentum so that we can also counter the volatility because of a momentum. So we have considered 6 month for look back period with a lag of 1 month. Why 6 months? Because we believe that after reading few articles also that 6 month will give us the like exact price trend, and secondly 1 month lag will avoid us a reversal bias, which will be the recent biasness got created because of that. And for volatility calculation we have used the daily price movement, and we have given 12 month for the volatility calculation, and we have kept Z score from -1 to 3. And secondly, coming to low volatility, we have given 15% weightage to the low volatility, and we have selected 16 months, 36 months for look back period. Why? Our rationale behind is that because 3 months are long enough to understand the long-term volatility of that stock. So because of that, we have chosen 3 years, and we have kept the Z score from -3 to 3. Coming to quality, we believe that this is the most important factor in factor investing. So we have given 30% weightage to the quality, and for non-financial companies, we have given 25% weightage to the 4 parameters, which are ROCE, ICR, equity to capital, cumulative FCFF to NOPAT. ROCI will give us how companies efficiently utilizing their capital. ICR will help us to get to know how company can pay their interest obligations from their operating profit. And thirdly, equity to capital ratio will help us to understand whether company is utilizing optimal debt to equity ratio or not. And lastly, FCFF to NOPAT will help us to understand whether company is able to convert its operating profits into the cash or not. And it is most of the time analysts use this metric to get to know whether there are some fraudulent activities are going inside the company or not. And for financial lending companies and financial non-lending companies, we have used the ROC, because we believe that this is the metric which will also help us to get to know what is the growth of the company. And for value factor, we have given 25% weightage, and for non-financial companies, we have given taken the book value yield for valuing the company. And for non-financial companies, we have used EBIT to EV ratio, because we believe that it is a neutral to the capital structure of a company, and secondly, it will also work on the cyclical stocks also. Now coming to the portfolio constructions parameter. So our stock universe is Nifty 500, which was mentioned by the NJ also. But in case if it was not mandatory, even though we would have selected this, because it is almost represent the Indian market by 95%, and it ensures the liquidity so that there should not be very high liquidity cost while doing the rebalancing, and it also avoids the micro cap stocks which have very high volatility. And number of stocks we have selected in our portfolio is 100, and the weightage given is based on the composite method, and that composite score is calculated on the basis of a 30% weightage of momentum, 30% weightage of 30% weightage to the quality, 15% weightage to the low volatility, and 25% weightage to the value. And we have kept maximum stock weightage as 5% so that we can prevent the concentration risk, and we can also be compliant with the SEBI norms. And we will do the rebalancing quarterly on the 15th of a month. And for an example, if quarters end on 31st of March, so we will do our rebalancing in the month of May, 15th May. Why? Because so that companies can give the result within, most of the companies give the result within 90 days after the quarter ends. And lastly, we will rebalance all our stocks. Now I will request Harshvardhan Tiwari to explain our performance of mutual fund.
Thank you, Dharmen. And I'm excited to share the backtest performance of our portfolio. Our strategy isn't based on luck or a star manager's discretion. It's built on disciplined, rule-based, multi-factor model, and the result speaks for themselves. This first chart, shows our cumulative performance from 2006 to 2025 against the benchmark. The red line represents our fund and the blue line is the benchmark. We can see a clear and consistent outperformance over the entire period, with the gap widening significantly over time. Our fund delivered an impressive 18.87% CAGR, for far surpassing the benchmark's 12.6. Now, let's look at the risk-adjusted return. We designed this fund, when we designed this fund, our mission was to provide growth with stability and capital protection. The next two charts prove that we have achieved this. First, our Sharpe ratio is a remarkable 0.77, more than double the benchmark 0.35. This tells us that for every unit of risk taken, our fund generated more than double the excess return compared to the benchmark. This is the hallmark of a truly efficient investment strategy. Next, our Sortino ratio is 1.19 versus the benchmark's 0.51. A higher Sortino ratio means we were highly effective at creating positive returns while minimizing the losses during the market downturns. Finally, the maximum drawdown. This is perhaps the most important metric for our target audience of disciplined wealth creators. Our strategy limited the maximum loss to 38.74%, while the benchmark suffered a much more severe loss of 50.4%. This is the direct proof of the effectiveness of our quality and low volatility factors. These charts provide a more granular view of our fund's consistency. Look at the rolling returns over 1, 3, 5 and 10 years. You can see a clear trend. Our fund consistently delivered higher mean, median and maximum returns while simultaneously exhibiting a lower volatility than the benchmark. For example, over the 5 years, our fund's mean return was 18.99% with a rolling standard deviation of 10.63%, while the benchmark returned only 11.74% with a higher standard deviation of 13.97%. This demonstrates that we delivered higher returns with less risk. Now, let's turn our attention to the calendar year absolute return table. This is where the power of our multi-factor model becomes undeniable. Out of 20 calendar years, we outperformed the benchmark in 16, giving us an impressive 80% win rate. The momentum and value factors helped us amplify gains in the bull market, such as in 2009 and 2014. But crucially, our quality and low volatility factors provided significant capital protection during major crashes. Look at 2008, a year that sent shockwaves through the markets. Our fund lost 32.82%, which was still far less than the benchmark's 42.63%. The same is true for 2011. We lost 6.3% versus the benchmark's 19.12%. This isn't incidental performance. It is the direct outcome of our synergistic model where momentum and value drives growth and quality and low volatility provides a resilient foundation. To bring this performance to life, I would like to introduce you to Rohan, a hypothetical investor whose journey perfectly illustrates the power of our fund. Back in 2006, Rohan started a small but consistent SIP of rupees 1000 with us, a young professional with a dream of wealth creation. The initial years were easy, but the real test came during the market downturns. Anyways, Rohan trusted our rule-based strategy and kept investing. This discipline paid off. The result, Rohan's total investment of 2.33 lakhs. Today, in 2025, that investment has grown to over 19 lakhs, a 8-fold increase. Rohan's journey proves that our fund is about building wealth through discipline and a strategy built on rules, not emotions. Our fund is designed to be a reliable partner for investors like Rohan, helping them achieve their goals with a peace of mind. Now, for the strategic roadmap, I would like to call Shreya.
Thank you, Harshvardhan. So currently, India is on a retail investing super cycle with about 28,500 crores flowing into SIP monthly and about 9.1 crores active SIP accounts, and that is our demand pool and our opportunity. Coming to our target audience, let me introduce you to Ravi Sharma. He's 45 years old, he's a cardiologist in Ahmedabad, and he earns about 45 to 50 lakhs annually. He's married, he has two children, and he has a risk appetite of moderate to high. His goals are to build a retirement corpus for 60 plus, and he wants to fund his children's higher education abroad. However, when we come to the pain points, he feels anxious during market crashes, for example, the COVID 2020 that we all know, and he wants a transparent rule-based approach rather than a fund manager discretion. And he dislikes chasing alpha products or short-term speculative schemes. When we look at the segment profile, the age band is about 35 to 60 years, and the investment goals are beating inflation by 3 to 4%, steady wealth creation, and SIP-driven compounding. Their mindset is disciplined, long-term focus, they prefer transparency, and they want drawdown protection. And we are also focusing that they're comfortable with a ticket size of investing 5,000 rupees monthly SIPs or about 1 to 5 lakhs lump sum. Why we think this target segment is ideal? They are SIP savvy, they are trust oriented, we feel that they're underserved, and they have a high lifetime value. When we look at the sub-segments, we look at 3 potential subsegments: professionals and entrepreneurs, HNIs, and SIP savvy middle class families in tier 1 and tier 2 cities. Coming to our USP and comparison with traditional hybrids, we are 100% rule based, and there is no space for tactical drift. We are designed for systematic investing, we are SIP optimized and tax efficient, we are accessible, we are disciplined with our minimum SIP amount of rupees 1,000, and we have superior risk adjusted returns. The equity style taxation help us in long-term capital gain benefit. Coming to the communication narrative, we are focusing on education, trust, and confidence. Our core distribution would focus on the NJ Wealth Distributor Network, corporate tie-ups, and investor awareness programs. When it comes to digital marketing, we'll be using Google Ads, LinkedIn campaigns, YouTube videos, and we'll have a dedicated microsite for investors to create awareness. When we come to public relation, we'll be building credibility for our new AMC. We'll be publishing thought leadership articles, we'll be having panel discussions, and we'll be publishing white papers on smart beta for hybrid funds. Coming to our go-to-market strategy, it will be a phased distribution. In the pilot launch from month 0 to 6, our objective would be to establish traction in the strongest region. We'll be focusing on geographies such as Western India, Mumbai, Pune, Ahmedabad, and Surat. And the second would be scaling it to national level in months 7 to 12, and we'll be building momentum across tier 1 and tier 2 growth markets such as Delhi, Bangalore, Chennai, Hyderabad, and tier 2 upcoming growth hubs such as Indore, Coimbatore, and Bhubaneswar. When it comes to our future expansion strategy, we believe that we can expand it to factor-driven ELSS, multi-asset allocation funds, high-risk reward equity fund, and thematic smart beta funds which are on the rise. We'll also be investing into investor-centric utilities such as SWP Optimizer and goal-based dashboards. With this, we conclude our presentation. Thank you. Now, we are open for questions.
Your maximum drawdown was around 38.74%, right? So I guess this was without the expense ratio. 1.18% is the expense ratio. Now if we incorporate that, then, and if it is very near to the desired drawdown, then there is a possibility that in future it can be below 40%. So how do you justify that?
So actually, the composition of our portfolio helps us to gain back what we have lost. Like if we are losing 40%, with the momentum and value factors, we think, and it is shown in our PPT as well, that we bounce back even stronger.
I understand that, but the requirement is such that the drawdown should not be more than 40%, and the investor or the required portfolio should be less volatile. That is what I was trying to state.
So sir, adding on to his answer is that even adding the expense ratio for that exceptional year, which was the 2008, we are less than 40%. So what we believe behind creating these factors is that there would be some exceptional years, but it won't be like happening again. So our rationale was our rationale was that.
Case of non-lending finance companies, you have not given any value parameter. What is the reason for that?
Yes, sir. So, not giving any value parameter for non-lending companies, that, sir, firstly, we backtested with that also. We used PB ratio for that, but our return was getting reduced. Secondly, PB won't be justify the valuation of a non-financial company because it functions like a in between of a lending company and the non-financial company. So we out of the ratios given, we haven't felt that any ratio can justify the valuation of a non-financial financial non-lending company. That's why we haven't selected that after backtesting.
Don't have any value factor which will justify like a asset management company is a non-lending finance company and various others wealth management businesses. They don't have any value factor which will be able to justify that.
Sir, there are factors, but what our constraint was that we are using the smart beta platform. So because of that, we haven't selected that, and we backtested with PB ratio and the combination of a PE ratio. But our return was getting reduced, so because of that, we haven't used that.
I had just one observation, in value you was talking about. I mean, people invariably tend to use EV EBITDA. You used earnings yield. So I'm just intrigued as to why do you think, I mean, it doesn't make a difference. I mean, just look at it the other way around. But I was intrigued that you used that ratio. But I mean, from the question perspective, you've got quality, low volatility and debt, right? So if you add them up, it comes to how much? 55 plus 25%, if I'm not mistaken. It clearly looks like an, overreach in terms of being conservative. Just a thought. That looks like a bit of an overloading. That was one observation that I had. The other observation that I had is that this particular slide, now that you put it up, it strikes me that you've got 4 years of underperforming the benchmark. So, I mean, this particular thing, is it? Why do you think this occurred? I mean, any particular reason why the model didn't work in these 4 years? Did you try to analyze that? Is it something to do with the fact that I don't know, the correlations didn't work, or what was the observation that you had?
So, sir, specifically for 2025, data was very less. We did backtesting till May. So that was the one reason for specifically 2025. For 2025, we found that momentum has dragged our return. Because of that, we got less return as compared to the benchmark. And similarly for the 2007 also, as we know that there was very high momentum before the crash. So our portfolio was consisting stocks which were having very high momentum. But after the sudden crash of market, so because of that, we underperformed the market.
Fair enough.
Thank you so much.
Thank you, sir.
Great way to end the presentations. Your customer-centric approach stood out, from the thoughtful go-to-market strategy to keeping more than 65% in equity for tax efficiency, all explained with great clarity.
What a marathon of ideas. I think our brains just did more crunching than Excel this morning.
Absolutely. And now it's time for another type of crunching, the delicious lunch waiting in the hall next to.
So let's take a well-deserved lunch break. I request you all to please return by 3:15 sharp. We are starting in a few minutes. We request everyone to take their seats. Next up, we have an address by a true symbol of integrity and community service whose initiatives have left a lasting impact on Surat, Mr. A.K. Tomar. He will be sharing his insights on the inevitable buzzwords that is on everyone's mind right now, artificial intelligence. Before we welcome him on stage, here's a short video introduction. We request Mr. A.K. Tomar to please come on stage.
a very good afternoon to everybody, and especially it's a pleasure to have our ex-Chief of Army Staff, General Vikram Singh, amidst us, and other dignitaries, my dear friends at NJ Investment, and all of you brilliant and very capable people in whose hands I see India's future very safe and bright. You have been talking about factor investing. Factor investing is a data-driven approach towards generation of profits, generating wealth. So does AI. My topic today is concerning artificial intelligence. Not only about artificial intelligence, I make a hypothesis here. This is perhaps the greatest disruption ever in human history till date. And why I say so? Because the first revolution in this world took place almost 10,000 years back, agricultural revolution. From hunter-gatherer, people, human beings started settling down in small hutments, and they started doing some sort of agricultural operations. It was a big shift. And then thereafter, another significant change occurred in year 1440 AD, when Gutenberg came out with his printing press, printing machine. The books started getting published, knowledge started getting transferred, and the world was never the same again. People started reading, people started writing, and printing took us to a stage that, in fact, just about preceded the Renaissance in Europe, Italy, Spain, Portugal. This was second disruption the world saw, significant one I'm saying. The third one is the Industrial Revolution, 18th and 19th century, electricity, steam, all these things changed the world. Mass production started, artisans, they started getting sidelined, and the world was never the same again. Another, rather next revolution took place in late 19th century, early 20th century. I'm talking about automobiles and also flying. The Wright brothers, and there were people like Henry Ford who came out with V8 engine of all, and then internal combustion engine made us all mobile like we had never been before. Thereafter came TV, and then came computer. Computer in 60s, ARPANET for defense services. A lot of these concepts came from defense forces. ARPANET was essentially used by defense forces in America and some other countries subsequently. Then Barnsley, he came with WWW, World Wide Web, 1988-89. And internet started taking the world in its fold. And then after 1995, it took the world by storm. All these revolutions I wanted to talk about before I talk about the disruption caused by artificial intelligence. When Benjamin Franklin was dealing with charges and electricity in the year 1852, when he flew the kite made of a special material and he saw charge, he could feel it, then he touched his knuckle on the metal key that he had tied to that rope, and he found there was some jerk. He knew electricity can be taken from one place to another like this. The world changed. But mind you, it took electricity long 50 years before it reached 50 million people. Long 50 years. Then 1876, Graham Bell, he was doing his tinkering with something through which the voice could be sent over from one place to another. And when he was doing all this, people were saying, But in any case, even if you succeed, who will use this instrument? People are talking about telephone. And then telephone also became popular, became very popular, but it took telephone almost 75 years before it reached 50 million people. Sorry, when I say 50 million, please get me, I'm correcting myself, 5 million people I'm saying. Thereafter came things one after another. Internet took 7 years before, after coming into being, it was able to reach 50 million people. And then comes ChatGPT all of a sudden. Within 2 months, it crossed 100 million people. Never before any technology has shook the world like this, shaken the world like this, and the world is never going to be the same again. Like all other earlier disruptions changed the world, AI is going to change it. AI is still more competent, more potent, simply because never before any technology has attracted this kind of money. In fact, all other disruptions can be dwarfed. All other technologies are dwarfed as compared to artificial intelligence. And we are talking only about artificial intelligence till now. When it comes to artificial general intelligence, some people who are knowledgeable, they say it is not really very far off. Some people give ourselves about 3 to 5 years, some people say maximum 10 years. And when artificial general intelligence comes here, factor investing will undergo a sea change. Already it is going a sea change. It's a systematic data-driven approach generating wealth, and AI is also a systematic data-driven approach dealing with neural networks. I want to start with a quote by Geoffrey Hinton, who is supposed to be the grandfather of artificial intelligence. Last year only, he was talking in a conference, and before he started talking, he said, if after listening to me tonight, you are able to sleep peacefully, you have not understood me. When Hinton said this, responses came from various walks of life. Many people from the field of artificial intelligence talked about it, and some people started making comments about Geoffrey Hinton. And Geoffrey Hinton, mind you, was a person who in 70s and 80s was dealing with neural networks, and thereafter he worked with Google, and then he left Google, and he says now in so many words, I had to leave Google because I want to tell truth to the people, I want to speak the truth. While working with the corporates in the same field, I was constrained, I was not able to speak the truth. And he came out with truth. That is really concerning. As you all know, after advent of internet, 2004, the Facebook came. Facebook initially was MySpace for college students. Then came Facebook 2004, 2005, YouTube, 2006, 7, 8, Instagram, Snapchat, and then 2007-8 came Apple, and then came App Store, and everything was reaching everybody. Everybody was using everything. Why I say it is a very big disrupting force, simply because Arab Spring was simply caused by social media, and social media had no engine attached to it that we say is artificial intelligence. Because when artificial intelligence, when factor investing is supercharged by artificial intelligence, you never know what can be the possibility. Social media, when it took the world by storm, initially people were just about innocently getting in touch with each other. They were sharing things, they were sharing their responses, their takes on various things in world life. They were sharing photographs, they started sharing videos, they were feeling connected. Everybody was feeling gung-ho about it. And then we have a generation, with due respect to all of you, we have never seen in human history a generation so anxious and so depressed. I can say so because I'm in my 60s now. In our times, I really never came across any case of depression in my generation. If somebody was sitting quiet, somebody will go and push him around. They'll also give them a couple of slaps here and there. If he goes back home, his father can give him a couple of slaps, and next day his depression was all over. And when people are connected nicely like never before, we have this generation. And I'm a big fan of this generation. This is not your doing. This is not your doing. Because people who are born from 1997 to 2012, and all of you are this cohort, we can call you internet generation. Internet generation is characterized by certain features. I was just now talking to General Saab during lunchtime. I would like to repeat some of those things. Number one, most of you come from nuclear families. Number two, hardly have at the most one sibling. In most cases, no sibling at all. Thirdly, generally you do not go to schools. After 7th, 8th, 9th standard, you start going to the tuition classes, preparatory classes. And then, when you go to the preparatory classes, you do not get to play any team games. When you do not play any team games during your growing up years, you really do not know how to collaborate with each other. You learn to excel, you learn everything, you focus sitting alone with your notes, but you do not know how to deal with conflict. Conflict management is not known to us. When we are talking about, in these terms, about social media, there were some people at the advent of social media, they were warning us, handle this technology carefully, handle these platforms carefully. Nobody paid any attention. It went berserk, and that is why we are seeing so many dysfunctions, so many dysfunctions. I hope and wish AI does not go this way. It is a disruption, certainly. I would like to use a PowerPoint presentation here. Shall I use the pointer or somebody else will do it for me? This is the one? All right, all right. Artificial intelligence, the fastest disruption in human history. I gave you some background about it. I already told you, electricity took nearly 50 years to reach 50 million users. The telephone took 75 years to reach 50 million users. The internet took 7 years to reach 50 million users. Now compare it. There's a simple comparison. ChatGPT reached 100 million users in just 2 months. That's the speed of disruption. AI, please do not take it as just another technology. No, it is not. It's a force multiplier across every sector simultaneously, in the field of agriculture, in the field of finance, in the field of materials, in the field of quantum mechanics, in the field of astronomy, rocket science, in the field of crime control, governance. It touches everything, including finance, including factor investing. And unlike past disruptions like steam, electricity, internet, AI is not limited to one sector. It touches everything. It touches law, medicine, policing, finance, education, governance, and you can keep adding as far as our imagination goes. It touches almost everything. Because it touches everything, there's a problem. Because it is such a potent force, that is why there's a problem. You can think of it as if there are about 1 million Nobel Prize winners sitting in a data center ready to do everything for you. The world till date, right since year 1901 when Nobel Prizes started, till now about 976 Nobel Prize winners we have seen till date. 1 or 2 plus minus. India till date has produced only 9. Most of them are settled as foreign citizens in America or Europe. When 976 people winning Nobel Prizes and some other notable exceptions who did not get it, maybe a couple of thousand more, when so many people have really changed it so significantly, the world has undergone such a big change. Imagine what million people sitting in a data center and they do not go to take food like we went for our lunch. They don't need any rest. They don't shirk. They don't sleep. They're working all around. They're always at your disposal. Such a potent force. If we use it wisely, and mind you, I would like to underline it, if we use it wisely, it can lead us to an age of abundance, abundant of food, abundant of healthcare, abundant of wealth creation, abundant of good quality education, abundant of entertainment, abundant of happiness all around. And why so? Because artificial intelligence learns, improves, and scales faster than human systems. It improves, learns, and scales like nothing else has done till date in human history. It does not require massive physical infrastructure. It scales through data and cloud only. You don't need to build bridges and huge structures. You don't need a lot of hardware, etc. These are the things which were not true about any other technology till date. It may be the fastest disruption in the history, but whether it becomes the humanity's greatest enabler or its gravest risk, it's up to us. It depends not on the machines, but on us, our wisdom, our vision, and our values. Now, mind you, these three things are generally talked about in very light sense. Wisdom, vision, and values. Because there can be only two possibilities. AI is already here, AGI is round the corner, and they are very potent forces, touching almost everything. Now, mind you, there can be two approaches. One approach is make it open source. Let everybody get the advantage of artificial intelligence and AGI. And like this, it will reach everybody. It will reach good people. It will also reach bad people. And then we'll have social engineering. Then we will have deep fakes. And it will be very difficult to choose fact from fiction. There will not be any segregation because this is a very potent tool. Now, anybody can really show you a video of this function today, and I may be speaking on your mobile something entirely different from what I'm doing now. I think what I'm speaking now to now is fact, but tomorrow you'll see my lip will be synchronized with a very entirely different message, and you'll get to understand as if this fellow was speaking something else yesterday, and today he's speaking somebody else. I've never sung in my life. Maybe there are some of you who have never sung in their life, and they can make you sing with your own voice. Your lips synced beautifully, nicely. So artificial intelligence, when it will supercharge augmented reality and other kind of realities, you know all that, then it's going to be extremely difficult to find what is fact and what is fiction. That is why I would like to repeat here our wisdom, vision, and values. When it is open AI, everybody has got it, even the bad people will get it. Second option can be keep it highly regulated. The companies do not share things, nations do not share anything. Like the Nuclear Non-Proliferation Treaty. Human beings have been able to largely handle it. After 1945, we have not seen another nuclear explosion in the world. There have been wars. But Nuclear Non-Proliferation Treaty, similarly in the field of genetic engineering, genes editing, it has been highly regulated. I'm talking about this kind of regulation, very strict regulation with deterrence. And if it so happens, AI will be with some specific companies. It will be with NVIDIA, it will be with Amazon, it will be with Microsoft, Google, in our close neighborhood, DeepSeek, and also OpenAI that gave us ChatGPT. ChatGPT 5 is already here. People are talking about ChatGPT 6 also. Everything is happening in such fast sequence, one after another, and they are all fighting against each other. Now imagine these 6, 7 companies, if they keep it highly regulated, they do not share this technology with anybody, they'll get immense wealth and immense power. And with that kind of immense wealth and power, with some companies and some nations, America is leading the pack by a huge distance, followed by China. Even UK is quite close by. Maybe France, England, UK, France, England, Israel too, are on India, Japan, and South Korea also following. But the fact remains that America has a huge lead. And if you have this kind of power concentrated in some people, they do not share this kind of capabilities with others, this will be a standard dystopia. Total hegemony, total monopolistic structure with this kind of power. And hence, again, I would like to repeat, that's why the world needs wisdom, vision, and values if we have to make good use of artificial intelligence and artificial general intelligence. AI is shaping the future. This is not what I'm saying. Sam Altman, and I need not tell you who Sam Altman is. AI is shaping the future. Sam Altman says, significant step along our path to AGI. He gives us maximum 3 to 5 years. He says, most of the original research and development has already taken place. It's only a matter of finding some more applications. Then Satya Nadella, CEO of Microsoft, he says AI will be a CGI moment for gaming industry. CGI moment is a moment that changes everything. It changes things upside down. A catastrophic change, a huge change, a big change that changes everything. This is what Satya Nadella says. It means creative industries entering a new era of realism and immersion. And you are already hearing about smart glasses. And you will be immersed in a different kind of reality. You will not have to take this phone in your hand. You will only talk to them. And then come a time when it will directly interact with your brain. You will be able to use your brain like Google, like ChatGPT. And when you are going to a street and you are thinking, where should I go for my lunch now? And it will automatically start giving you indications that this place is so far away, it looks like this, and you will get this kind of things there to eat. And if you are feeling threatened and you think, this is such a lonely road, and I find some funny looking people around here, it will also give you the local contact number of the local control room, and it will tell you how far is the nearest police assistance van, where it is. So the world is going to be very, very, very different with the smart glasses and different kind of things which are about to be in offing now. It's becoming a serious labor issue. Who says it? Demis Hassabis. Job disruption, reskilling, and regulation challenges ahead. You know, TCS, a company like TCS, highly respected company, they relieved more than 12,000 people. And a lot of coders, software programmers, they're feeling shaky. A lot of designers, they are finding problems. A lot of lawyers are feeling shaky. A lot of accountants, they are finding that they have to look for something else if they want to build their future in this field. Mark Zuckerberg says, folks who don't use AI glasses, I was talking to you about in a very short few words, folks who don't use AI glasses will be at a pretty significant disadvantage. Mark Zuckerberg. Augmented reality, aided by artificial intelligence, adoption will drive future social and economic divides. It opens us to wonderful possibilities and some very concerning possibilities. everyone on earth will be capable of accomplishing more than the most impactful people can today, thanks to AI. You have your co-pilot, you have AI tools, and some people in my generation, we have ideas, but our typing speed is very poor because we never learned it as students. And we can't really prepare our PPT very fast. We have to depend upon somebody now, Chat GPT, and there are so many other tools available. They do it fantastically for me. This was done like this only. And I'm struggling to cope up with this world when this kind of tools are available, and they are available to everybody, including me. We have been handing over more and more activities we have traditionally done with our minds to big tech, causing those parts of our mind to atrophy. See, I'll give you an example what happened to the hippocampus of some people. University of London conducted a research in early 90s. A good number of you must have gone to London. I have been there several times. London is a very complex city, a maze of roads and lanes and different kind of angles. Central London goes like this and this and this. Difficult to find place. And a person who is working as a cab driver in London, he has to be really good at finding directions, remembering places, and understanding directions, understanding locations. His spatial abilities have to be of very high order. So their brains were scanned, and it was found, compared to normal people, the hippocampus, that part of our brain that deals with spatial understanding, it was bigger in size, significantly bigger. And people made several comments about this research, and some people forgot about it. Same university in year 2003-4 conducted same kind of scans on the same people. In the meantime, a big change had happened. Google Maps had come, and those all drivers, they had started using Google Maps. They scanned their hippocampus, their brains again, and they found in most cases the hippocampus had shrunk in size. Otherwise it does not happen. This is the kind of atrophy I'm talking about. To put it in very simple words, if we start using AI tools to do 2 plus 2 is equal to 4, it means we are not using our brains at all, we are not applying our brains, and this ability to calculate will go into atrophy. You will not be able to calculate. In my generation, when I got into service, when I completed my education, late 80s, mid 80s, most of us were carrying a telephone diary. But we hardly referred to them because we knew 50, 60, 70 numbers, and those are the numbers we needed. Most of the people, they never referred to their diaries. We remember those numbers. And now I conducted empirical survey with many people, with many cohorts. People hardly remember. There are very few people remember more than 4 numbers, unless they are in a series. Some people even refer to their phone if I ask them their number. And other than their spouse, they don't remember even their children's number in most cases. I'll be surprised if there are people who can remember 10 numbers unless they are in a series. So the brain has learned it is at your beck and call. It is there in your hands. Anytime you can refer it, and you don't feel like remembering it. I've been moving around Ahmedabad for a long time. I had been DCP there, I was joint CP there, I was chief of ATS there, I was special CP crime there. Spent more part of my life than in my village in Ahmedabad. I never needed Google Maps. Now when I go there, some flyovers have come up, and even I feel like sitting on the back seat, I put it on my Google Maps, and I try to find location. Then I feel pity for myself. It means my brain is going in atrophy. And it is happening to all of us. When I talk to young people, and mind you, I talk to a lot of young engineers and MBAs, and I find when their managers give them some problems to solve, immediately they use AI tools. They come up with very quick solutions, but they are not applying their mind. As a result, what is happening is their critical analytical abilities are going down. When I say we have to use AI with vision and wisdom and with values, we have to be careful we do not use them unnecessarily. Wherever we can make do without artificial intelligence, we should give our brain some chance to give some exercise to those neurons, those synapses, so that we do not lose our natural capabilities. Google CEO Sundar Pichai said, AI will be more transformative to humanity than electricity and fire. Needless to say, I have told you earlier also, and I'm repeating because Sundar Pichai also says so. And 65% of companies have adopted AI in at least one function. I know NJ is also doing it, and so are most of the companies around. And with investment over 500 billion by year 2024, this is what I mean when I say this is the technology. It has dwarfed all other technology. This kind of money has never been put to any other technology before. AI helps diagnose diseases, predicts patient outcomes. I'm saying applications and impact. Personalizes treatment plans. This is in the field of healthcare. In the field of industries, the middle part. Finance, education, transport, entertainment, and the list can go on and on and on. Almost everything. Robotics will take place, take jobs away from most of the people. In fact, the fact is, AI will not take your jobs. That person who knows AI tools, he will take your job. So it is time to get friendly with AI for all of us. And when I say will take our jobs, not only your jobs, even my occupation, my livelihood, my job too. Job market automates routine tasks. AI automates routine tasks. Anything which can be done routinely, AI and robotics, they will take over that. Because they'll be more efficient. Because they will not ask for any leave. They will not even ask for holiday or festival leave. They do not want any rest hours. They'll continue to work. Their efficiency certainly will be way high up compared to human beings. Create new roles and opportunities. Artificial general intelligence, the next frontier that I'm saying is just around the corner, maximum 3 to 5 years now. OpenAI's rivals, Anthropic, Google, that is DeepMind, etc., with rapid advancements in large language models, the race to AGI is heating up. The former Google CEO Eric Schmidt says AGI may come in 3 to 5 years. And it is going to be a storm now. Damis Hassabis, CEO DeepMind and Google, says AI could replace doctors' diagnostic tasks, but not human empathy and interpersonal care. जाके माथे पे हाथ रख के ये पूछना कि यार कोई बात नहीं, पेन है जरा लेकिन कल तक ठीक हो जाएगा, मैंने मेडिसिन दी कल तक ठीक होगा. This kind of reassurance, this kind of empathy, we have to be good at it. We can't lose it. And the day we lose it, AI will be all over us. It will kick us out. Humans and AI will work in collaboration. AI taking on repetitive and data-driven tasks. But what are the challenges and risks? I'm talking about challenges and risks now. Example, AI systems commit errors, and they can do bombastic errors at times. For example, an AI agent accidentally wiping a database. I'll give you some more examples. Somebody gives a very large, very powerful AI agent a command, make humanity happy, and it gives everybody sedatives. These are the possibilities, and this kind of funny things are happening with AI even now. Because AI, the way it scales up, it is unimaginable. It grows, it takes up its own information, it scales up itself. It is beyond our control. And sometimes its logic is impossible for humans to understand. And it is happening even now. In some of the experiments, things like this have happened. Job automation risks. Automation of white-collar jobs, lawyers, accountants, software developers, etc., could lead to significant job losses. And unfortunately, this is going to be true very soon. Already it has started happening. Widening wealth gap. Please indicate me when my time is about to be over. Give me 5 minutes before I finish. Thank you. Concentration of wealth with companies and individuals who own and control AI technology. This is what the widening wealth gap inequality will lead to. Huge amount of tremendous power and wealth in a couple of hands. This is the dystopia I'm afraid of. Privacy and surveillance. Rise in surveillance technology, raising significant privacy concerns. For example, AI-powered tools, facial recognition, gait analysis in the whole crowd when faces are not visible, only from your way of walking it will be able to recognize you. And this kind of profiling, it has huge implications in the field of internal security, in the field of surveillance, in the field of intelligence, in the field of keeping tab on your enemies, on the people whom you do not like. And it can be used by governments and corporations for mass surveillance. Threatens personal freedom and privacy. Personal freedom will take a big hit. Privacy will take a big hit. Everybody will know. In any case, even now WhatsApp and Google understand us more than how our spouse understands us. More than what we understand ourselves, these platforms, these algorithms, they understand us better. AI challenges and risks. Safety, accountability and control. What is the challenge? Aligning AI with human well-being and values. It will not align automatically. We have to work hard and we have to be wise enough to do so. Autonomous weapons. AI making life and death decisions without human intervention. You send an AI-driven drone with description of a person and it finds somebody, his twin brother, he finds the description perfect and it kills him and comes back. AI will give us the kind of weapons. You see the sentries standing in front of many offices, government offices, vital installations. Now there is no need to put a man there. Automatic AI-driven rifles will be there. And if they meet their criteria, if they get the right analytics, they'll shoot. There's no man behind that. It is this kind of weapons I'm talking about. They are frightening possibilities. Opaque decision making, that is the black box problem. Advanced AI systems often lack transparency in decision making. Why did you make this decision? And their logic can be so complex that we will not be able to understand it. And they'll be taking decisions on our behalf. Existential risks. AI could inadvertently cause catastrophic harm or destroy life. It's a strict possibility. And this is what Geoffrey Hinton meant when he says, if after listening to me you are able to sleep peacefully tonight, you have not understood me. Concentration of power, I have repeated it time and again, risk of AI oligopolies. Oligopoly is like a few companies and nations controlling AI more capable than any human ever in history and could dominate global decision making and innovation. Misinformation at superhuman scale. I was talking about deep fakes. I was talking about wrong kind of morph photographs and videos and what it can do. We have seen just only a bit of sample till date how criminals are using them. AGI could generate highly convincing fake content, deep fakes and propaganda. Propaganda is another point. You will never be able to find what is the truth. We'll go by the narratives which are there in the media all the time, social media and all platforms. Indistinguishable from reality. They'll be so close to reality. There'll be two people standing here. One my 3D image, second I'm here, and it will be impossible for you who's who. Potential to destabilize democracies and markets by manipulating public perception. I'm talking about AI and AGI. You know What happened in Arab Spring from 2010 to 2012? It was social media only that shook the power in so many, shook the governments, exited the governments had to exit, they had to leave power only because of social media and this kind of Arab revolutions aided by artificial intelligence and AGI, one can only really shudder while imagining. Now, these are the last couple of challenges I'm talking about. Loss of human autonomy. We think we'll be able to control AI, where the fact is, over-reliance on artificial general intelligence for decision making may erode human critical thinking. We will lose our capability and they'll be able to take their own decision on the basis of data sets of their choice, of information compiled by themselves. Security risk and weaponization. AGI could design cyber weapons, automate hacking, and develop advanced bioweapons. And you never know. When an AGI-aided robo can decide enough of these human beings, they are the most inefficient creatures, and we can't do without them. Alignment problem. An AGI pursuing a misinterpreted goal could cause unintentional harm. Like I told you, I'm giving the same example. If asked to make humans happy, it may chemically sedate people instead of improving their lives. Now, this is among the last slides I'm using. It will be able to create a digital twin of you. Exactly the same person. AI model trained on your data, habits and style can act like you, can answer calls, negotiate deals, write in your style, and even sing in your voice. So how to find out who's the real person and who is the digital twin? And then possible uses. Positive uses, I'm saying, health monitoring, personal productivity, possible risks, identity misuse, and deepfake impersonation. I talked about all these things. Thank you. I hope the picture I painted before you was not really very grim, because if we act wisely, if we keep our brains active, if we keep application of mind in our own hands, and if our values are in right place, this will create a world of abundance that the humanity has never seen before. In case of any questions, I'll try and give my observations with respect to that. Nizba, is this part of the whole thing? In case, if there is any question, I'm game for that. And if there are no questions, I hope you'll be able to sleep peacefully tonight. Thank you, and have a good day. Pardon me if I take half a minute more. With due respect to people of my generation sitting here, I find this a standard feature with the younger generation. They do not ask questions. A society where the young people stop asking questions does not really show us in very good light. I find in India, younger generation does not really question. After listening to somebody about 30-40 minutes, if your brains are not really processing this information and are not agitating you enough to ask questions, I'm really worried. It leaves me worried. It does not leave me a happy person. Because, can I tell a little story, Neeraj bhai? A 2-minute story. When I was heading ATS Gujarat, we were working with some Israeli officers, and he was training my people in certain skills. After the class, I talked to that colonel of, he was an ex-colonel of Israeli army. I asked him, Weber, how did you find my boys? And he said, they're fine. And I found there was something missing. Because when he says everything's fine, when Americans say everything, yeah, it is interesting, it means nothing. And I understood when the Jew says it's fine, it means it is not up to the mark. So having understood him, I asked him, why do you say so? He said, but they don't ask any questions. I asked him, how do the young people in Israel do? Bola, when I was a major in army, even when I was a colonel in the army, 17, 18, 90 years old boys and girls, they used to do their jobs with us, conscripted. And when I was giving them an operation, I was explaining to them the SOP. They listened to me very carefully, active listening, and then they say, no, Colonel, you are wrong. There is a better way of doing it, and they used to explain it to them. I asked him, why are they different? Because in my family, when we sit on dinner table, he told me, my father and mother are there, me and my wife are there, and our young children are there. And he says, my grandfather, he's very fond of talking. And he keeps going blah, 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 blah. And my 7 and 8 years old sons, they said, no, grandpa, you're wrong. My grandpa asked, how do you know I'm wrong? Because my teacher told me, because I looked up at Google, because I read it in my books, I read in the newspapers, and my friend was telling me things like this. His father is an expert in this field. And the grandfather will not give him a slap. Unfortunately, in our society, बड़ों के सामने बोलना नहीं है. ये पहले से घुटी में पिला दिया जाता है. नंबर 2, प्राइमरी स्कूल की टीचर्स कहती हैं नर्सरी क्लास में, शट अप, क्लास में चुपचाप बैठना है, आवाज़ नहीं निकलनी चाहिए. Same thing goes in school. Similar thing happens in college. And unfortunately, we get people. And the difference is, till date I told you, India got only 8 or 9 Nobel Prizes. I can count all of them. 1912, Rabindranath Tagore. 1930, Professor C.V. Raman. 1968, Hargobind Khurana. 1970s, Subramaniam Chandrasekhar. And then Mother Teresa, Amartya Sen, Abhijit Banerjee, Kailash Satyarthi, and Venkatraman. This is the whole number till date. And how many Nobel Prizes have gone to the Jews? They are 1% of our population. We are 150 crore almost. They are less than 1.5 crore. They have won 223 Nobel Prizes till date. So my dear friends, please ask questions. Thank you.
Thank you, Tomar sir, for your insightful take on artificial intelligence. I would now like to request the co-founders of NJ Group, Mr. Neeraj Choksi and Jignesh sir, to felicitate him.
But the mescaline was running strong. Good mescaline comes on slow. First hour's all waiting.
Continuing the spirit of inspiration, we now have the privilege to hear from a leader whose courage and vision have served the nation with great distinction. The chief guest of the event, General Bikram Singh, former Chief of the Indian Army and Chairman Chiefs of Staff, we are honored to welcome him with a short video introduction.
session today. I'm a director, incidentally, independent director with the corporate house. And despite that, they made me I would say, the guest of honor or the chief guest, whatever it is. But it's with tremendous humility that I'm standing here from that point of view to speak to you all. A very electrifying, a very motivating talk has just been given by Mr. Ajay Kumar Tomar, the former DGP. And a very interesting thing, because I'm going to be speaking based on what has happened today. I'm going to draw certain lessons from the entire proceedings of today, because I wanted to correlate it with that, and that's my forte. And I love questions, again, as he brought out. I just spoke on the 11th to the Siemens, one of the verticals. The strategic leadership was there. And my talk went on for 2 hours. And that was because I spoke for about 40 minutes, and the remainder of time was question answers. I love question answers because that's where the interactive session you enjoy, because a lot of points come up from where you learn as well. The speaker also learns. And mind you, because the learning loop never closes, I believe in that. You're never complete, you're never full. I'm still learning. In fact, Mr. Naik, who was sitting next to me, he's a co-director. He told me, he says, you've been taking notes, or was it maybe the CEO, he told me. So yes, I've been taking notes. Why? Because there is so much to learn from your presentations. But yes, I have certain observations as well, which I'm going to cover and highlight certain aspects of leadership to you all, leadership, management, and strategy. And let me first start by, the promoters. A word about them. I'm not indulging in psychophancy by any chance. But let me tell you, these two gentlemen, they epitomize, they exemplify camaraderie. For good about over 30 years, I think these two gentlemen have stayed together, opened a company which is today a very renowned empire, a corporate empire, where they have been able to establish a wonderful culture which motivates everybody, which inspires everybody. And culture, as you know, is the ecosystem. Culture is based on customs, traditions, values, assumptions, certain beliefs. I mean, most of you, in fact, for that matter, all of you are from very renowned B schools, and each of these B schools must be having its own culture. The Indian Army has its culture. Indian Army has an adaptive, learning, innovative, and a value-driven culture. And same is the case with NJ group of companies, NJ Asset Management Company, where I am an independent director. It has a wonderful culture, and that's the reason today that you'll find a very vibrant environment. You would have seen the way things have been organized meticulously. You would have seen the way everything has been done with precision. And therefore, I wanted to first highlight their leadership attributes, and what can be learned from them is that, remember in life, humility pays. You kids are, in fact, my lecture is aimed at you all, not anybody else in the front rows, because these people are already wise people, I'm speaking to you guys, not that you people are not wise, you are wise as per your age. But wisdom comes with experience. So, and of course, with knowledge as well. So you people are wise, definitely, given at the moment, your age group. But I'm trying to bring out the facts, what these people have done and how they have done. And one aspect which I'm highlighting is humility. Humility is like virtually, it's like a tree that bears fruit. It comes closer to the ground, if I have to use that analogy. The tree bends, it comes closer to the ground. Do that, be that. And because when I attend the board meetings, this is the second company where I have seen it's free for all directors to make their points, to give their points. And good leaders must have a good ear as well. That's very important. Listening is an art. Become good listeners. Only then you'll be able to succeed in life. You cannot be, as part of the interpersonal skills, of course, communications is very important. We heard today the kids coming here and speak. Wonderful. They spoke very well. Each one of you spoke very well. And my compliments to all of you. But along with this is also the body language. There were very few speakers who supplemented what they were saying with their body language. And I can, of course, quote one young lady. I remember her name because one of my best friends in the army, who is no more, he got Veer Chakra in Sri Lanka, was called. Where is Miss Kaul? Miss Kaul was in the 4th group, am I right? Where is she around? Can you please stand up, ma'am? There you are. This lady, though she was reading, she was using her hands. Her expressions were such, they were supplementing her communication skills. That's very important. When you speak, thank you. Thank you for standing. So, and mind you, the lady who followed you, that young lady, did the same thing. And mind you, large number of you did that. I remembered her name because, as I said earlier, I had the brigadier call who died, a poor chap, Veer Chakra from Sri Lanka, and that's the reason I remembered her name. Right, now the next point I want to come out is, lesson from the judges. You saw the points they gave out. You could make out the depth of the knowledge they had, the expertise they had. They are subject matter experts, and that expertise comes in if you are dedicated, committed. If you have that insatiable appetite to learn, to listen to people, attend seminars, get into brainstorming, idea showering sessions. This is where you learn, and it was visible. This lesson I wanted to leave behind, that like the judges become one like that, people endowed with fantastic intellectual prowess, intellectual sophistication, so that you can lead your organization forward and do well. A word about the CEO and his staff. I think very meticulously organized. The second session that I'm attending, second season as they've called. First one, it was the first one apparently, but the second one is far better in terms of coordination. And of course, the CEO is done under the aegis of the two promoters and the co-founders of the NJ enterprise. But I must compliment you and your staff for excellent and for meticulously coordinating everything. The next point about where is the Nirme, friend Nirme. Nirme is a budding global leader, ladies and gentlemen. He's a kid I like. You must have heard him. A couple of things which stand out. He named everybody. He didn't refer to notes. Remember, in life, it is not only people who are visible on the stage who should be actually honored, but the unseen hands that shape the punch must also be honored. And he did that. He named everybody who was not visible in this hall of the Pakistani army. And I had one brigade which was commanded by a brigadier from Nepal. It had battalions from 3-4, different countries. And the greatest problem I faced was that the animosity which is there between India and Pakistan, it actually at times flows to the United Nations. And every time I would pass the orders to Brigadier Bajwa, who was a brigade commander, he would say, sir, just no problem, but sir, I have to take permission from Rawalpindi, sir. I have to take permission from my GHQ. I cannot take action on my own. But what happened was one day when I was having a conference in my office, and around 5 o'clock, when it is time for, the afternoon prayer, I think it's called Azhar, if I'm not wrong. Asar. So during Asar, time was there. So Brigadier Farooq, who was my deputy, he said, sir, can I go and pray? I said, please go ahead. So mind you, in India, no officer would have asked this from their GOC, but you're an international arena where you got to respect the sensitivities of various contingents and various countries. So I said, please go ahead and do it. So he went out. It was raining cats and dogs. The veranda outside was totally wet. He put a little mat over there and was almost going to bend down when I saw from the window he doing that. I came outside and I told him, I said, Farooq, move into my office. You pray over there. We will stand outside. So I took the other two brigade commanders and my staff, principal staff officers, into the veranda, and he went into my office. He moved the table on the carpet. He said the prayers. That did wonders. Mind you, when Nakunda, the rebel, he was advancing towards the Indian brigade, and the Pakistani brigade was south of it. And I wanted Pakistani brigade to stop the advance of Nakunda, the rebel, by firing from the south. I told Brigadier Bajwa, I said, can you take it on, Bajwa? He said, sir, we rest assured it will be done. I had told him around, I think, midnight, this thing. He called me up in the morning at 3:30. He said, sir, I have two companies. You asked for one company, I've sent two companies, and they are firing on Nakunda. And that is what saved the Indian brigade. What I'm trying to tell you is that if you respect the sensitivities, the custom, traditions, religion, values of the other people, it can break the most, I would say, the strongest of barriers and get people together. I thought I'll share this example with you. The other values, of course, I have already talked of. Duty, I've said, fulfilling your obligations. Amongst the attributes, the most important attribute, we have the mental attribute, emotional attribute. In the mental, what we focus on is willpower. And you will see, if you study the history of various corporate houses, you will see that there was a time when they were almost giving up because of funds, because of their strategies going wrong, because of infighting, problems occurring, investors going away, banks not giving loan, pilferage, something or the other going on. But these people stuck to their principles. And they continued, they persevered, they didn't give up. And these people have succeeded. And I can name you 6 or 7 of these. And they are succeeded today. They are actually virtually ruling the corporate world. They're doing very well. Emotional intelligence, very important as an attribute of interpersonal skills. And this is something I would urge you all to read. There's a book by Daniel Goleman. Have you read that book on emotional intelligence? Anybody amongst you all? Of course, the DG has. But if there's anybody else, go back, tell your faculty members to buy this book in the library. This is what we have in the army, let me tell you this. This culture. The moment a book which is relevant to the functioning of the army, it hits the book stands. The battalion commanders, they purchase 5 to 6 copies of those. They are distributed to the company commanders. And you people think, we only have elbow drill in the evening, drinking away to glory at the bar. वो पिक्चरों में दिखाते हैं, they romanticize war as well, और ऐसे लड़ाई नहीं होती है. So, but what happens is in the mess, those books are discussed. People are asked to make presentations. And that is one of the reasons when I said learning culture. We have a learning culture, which is there in NJ as well. We send our people to IIMs. I'm sure some of you would have seen army officers who are retiring very soon doing these courses. You have in your B schools, anybody? Then you're not walking around much. You're stuck to your rooms and your classrooms, am I right? Or getting out with your friends to watch movies and going to restaurants. We are sending to almost every B school. IIM Ahmedabad has got our people. In fact, there's Colonel Benibal who's been picked up by Mr. Adani. He's a graduate of IIM Ahmedabad. So there are a large number. We are sending everywhere, and that is one of the reasons today we have a very fertile, we have people with intellectual sophistication, very creative, very innovative to handle various situations. And you've got to have today, you people have got to be agile leaders. In the dynamic world where the disruptions are taking so fast, where the changes are occurring so fast, you might as well be thinking on your toes. And that can only happen if you have that mental agility. If you are versatile to move from one task to the other seamlessly, you have to develop this capability. We create our leaders like that. If you have any questions, I can tell you how exactly we do that. Right, and culture, of course, I have talked of. Peter Drucker, you heard of Peter Drucker? You know what he said about culture? Anybody from B school? तुम लोग पढ़ते नहीं हो, है भाई? मुझे लगता है. Peter Drucker, who was a famous management expert, he died in 2005, an Austrian American. He said, culture eats a strategy for breakfast. सुना आपने ये? नहीं, अभी breakfast की याद आ गई सबको. What it means is, he didn't undermine strategy by any chance. He said that culture is very important. Ecosystem. If you have to unfold your strategy, your plans, it requires an ecosystem where people are motivated, they are committed, they are united by a common cause, by certain values. And that is what the culture is all about. So that's very important. And before I take on any questions, and I want to make it interactive, and there is time, so I'll take the permission of both the co-founders and promoters, Neeraj Bhai and Vignesh Bhai. Best ek do sawal lunga. And you've been told, if you don't ask questions, that means you're duds. And I'm sure you're not duds. You're intellectual people who are with the future global leaders, right? The last, of course, is that I would like to finish off with the quote of Stephen Hawking, which appeals to everybody, including me. He said that the greatest enemy of knowledge is not ignorance. It is the illusion of knowledge. You know, we start believing, we start thinking we are Mr. Know-all. Just because I was a chief, I think मैं सब जानता हूँ. अरे भाई, वो subject matter experts नीचे बैठे हुए हैं. They are majors, captains, they are colonels. Listen to them. So remember this, when you rise in your hierarchy, it doesn't mean you know everything. There are people who are experts in their field. leverage collective wisdom, leverage collective intelligence, leverage collective genius. That's what should be part of our decision making. If you take informed, what leaders are meant to do what? Take decisions. A decision has got to be informed, and informed decision is based on collective wisdom, collective genius, collective intelligence. Get people to give their views. And it can only happen if you have what these two gentlemen have, humility. Humility होगी तो लोग आके बात करेंगे. Humility होगी तो लोग ideas देंगे. लेकिन if you're going to have a no-nonsense look on your face, a stiff neck all the time, गुस्सा दिखाते रहोगे, लोगों को shout ही करते रहोगे, you'll be intemperate all the time, you lack emotional intelligence, you're not empathetic, कोई मुंह नहीं खोलेगा. Nobody will give you any ideas. And if you're an autocratic leader, which are, you find, in the world over, you'll find a lot of leaders, they create an echo chamber around themselves. Echo chamber is the arena they create of sycophants who are around them. And they tell only what the leader wants to hear, what is music for his ears. And that's the most dangerous situation. If today there's a problem in China, if there's a problem today in Ukraine, if there's a problem in Russia, it's on account of this. And there are other countries as well. So autocratic leaders are okay only when you have to push people, otherwise use your personal power. Pull people towards you. Lead through example. But you have to push them only when time is at premium. And it's a question of national security. Then we push. I've done that. But it has to be done for a very short duration of time. If you prolong it, you will only antagonize people. You only create negative energies. You only create turbulence. You only create centrifugal energies within an organization, which are bad. So I think I'll stop with that. And I'll be too glad to take on any questions which you have. And I want, you've already been nudged nice and proper by Mr. Tomar, that people who do not ask questions, sadly they are not worth of being in any audience listening to talk. Chalo, kaun puchega sawal bhai? Please, he's a gentleman. Please, sir, please, sir. लेकिन मैं एक बात आपको बता देता हूँ, as a matter of habit and the principle, anything which is controversial, I generally avoid. तो मेरे को अगर आप कोई ऐसा controversial सवाल पूछेंगे which has got political overtones, which I avoid, I've been a political leader, मैं थोड़ा उसमें थोड़ा परहेज करूँगा, otherwise please go ahead.
Sir, I am not asking any question, I am just supplementing what you gentlemen said. In fact, there is a benefit while attending seminar or listening any dignitaries, that when you will listen them with questioning mind, in that case there are two benefits. Because if you listen with questioning mind, in that case you will be attentive and that things would be registered in your mind. And second byproduct, that you will not feel sleepy.
Anybody from the student fraternity, participant fraternity? Your fate has already been sealed, so you don't have to, you can ask a stupid question, a maverick question as well, because वो आपका seal हो गया है fate. उन्होंने result बना के तब lunch के लिए आए थे, and they were all smiling. So mind you, even I don't know the result, but I'll clap definitely. Yes, please go ahead, beta. Yes. Can you come forward? I'm slightly hard of hearing, unless of course the acoustics are fine. बोलिए.
So sir, thank you so much for such an insightful speech and all the recommendations that you gave. I will definitely work on implementing that. I was just wondering, sir, as a leader, have you faced any situations where you had to strike a balance between when to be empathetic and when to have a firm stance, and you get
balance between
when to be empathetic and when to have a firm stance and get things done? I wanted to know some of your stories where you had to face some difficult situations like that.
There are a large number of situations, beta, which I brought out. You know, what happens is, empathetic while dealing with people is, of course, the bedrock of your leadership. You've got to be all the time that. And it's not a weakness. Somehow, in yesteryears, it used to be viewed as a weakness. It is no more a weakness, mind you. When you read this Goldman's book, Daniel Goldman's book, he will tell you that to rise in the higher echelons of leadership, this is one thing which people are looking at, emotional intelligence. Yes, I did strike this kind of I had to change my position because, you know, a leader, an effective leader has got to be a father, he's got to be, that is a parent, he's got to be a sibling, he's got to be a friend, he's got to be a philosopher, guide, give all kinds of, you know, he's got to be a counselor as well, a mentor. So you wear different hats in different situations. And you wear the hat of a Hitler to push people through, to change from an empathetic stance to a more aggressive and autocratic stance, only where the time is at premium, as I brought out. I've had this when I was commanding my battalion on the line of control in Tangthar. I had a number of times the situation where, for example, a Jawan was hit by a bullet and had to be evacuated. And there was firing going on. At that time, one had to lead by example, get the people moving, get the doctors, shout, make sure people reach there on time, get a helicopter to the base down below so that the person is evacuated to Srinagar to save him. So, you know, that's the time you've got to push people. Because at that point of time, if you're empathetic, then that, you know, your goodness doesn't deliver results. But that is momentarily. You cannot continue with this kind of leadership for too long, autocratic kind of leadership. So that's very important. And when you communicate again, you know, remember this, there is something known, you know, in the communication skills, there is something known as communication agility. Communication agility is seeing the body language of the person who's listening to you, seeing whether that person is on the same page or not, and thereafter articulating your thought process accordingly. I'll give a small example. When I made the presentation to the CCS, which is headed by the Prime Minister, on the Mountain Strike Corps, there was a lot of resistance. Both the chiefs were not keen because it's a zero-sum game. The national budget is a zero-sum game. The budget which comes to the military, it is divided amongst the three resources, three Army, Navy, Air Force. So the other two chiefs were not very keen that we raise a Mountain Strike Corps. But I went through with it, and I remember when I made the presentation, I had to exercise communication agility to change my tone from passive to diplomatic to assertive. You understand? You've got to modulate it accordingly. Only then the person understands. But if you're throughout very soft and keep speaking, like most of your people did, you know, Miss Call, she read, but she was moving. She was assertive. She was showing her this thing, you know. So that is what is to be done. Of course, when I made the presentation, I spoke extempore. Like I'm speaking today, I just had few points, even not that. I told the DGMO to wait outside. I went inside the CCS and I presented, I made that presentation. I made the presentation to the Honorable Prime Minister for three things which he agreed. When BJP took over, I briefed him for 3 hours in the military operations. I personally did that. And he's a wonderful, let me tell you, leader, a great leader of our country. He agreed. He agreed to all the points. Today, if we have the memorial, you know, which is there for the defense forces, it is courtesy him. It has been lingering on for I don't know how many years. They were very decisive leadership, let me tell you this. So I had to be decisive in terms of being slightly autocratic, authoritative a number of times, but it was basically in the larger interest of national security. And same is the case with you all. I had a kid, you know, I had given a talk to JITO. There is a JAN, some international organization. In Hyderabad, I was invited. And there were 4 or 5 kids in a set, so we want to discuss with you. They landed up in my room. They barged in fact, I never called them, but I couldn't tell them to get out. So they sat with me, 5 hours they kept asking questions. So one of the young girls like you, beta, she called me up. She said, sir, I have taken over the youth wing of JITO, but no one is listening to me. So I said, beta, for how long is your tenure as a chairperson or as the president of the youth? She says, 1 year, sir. So I said, it will take time for you to establish yourself. In any case, you are a first among equals. Remember this. When you are a leader, you are first among equals. They are all equals. But you have shown a bit of thought on merit, or otherwise you've been made the leader. So when that happens, use your personal power to move people. And that requires being affable, being a good listener, walking up to them, being selfless. If somebody's got a problem at home, going and sitting down on the computer of that person, telling him, you go home, I'll handle, don't worry about it. So all these things. So I hope I've answered your question, beta.
Yes, sir. Thank you so much, sir.
Thank you, beta. Any other question? She deserves a better applause, please, for heaven's sake. Here's a lady with courage. There's a lady with courage. None of the gents has got that courage. I'm going to write your faculty. पूछो जरा कोई है कोई और? I think Mr. Ajay Tomar was absolutely correct. वो Israeli जो था, हालांकि I had a different experience. When I went to Israel, I used to make it a point. I went to China, Israel. I used to tell them, look, I will speak to their National Defense University. I used to make it a point. So I spoke in China, I spoke in Israel, I spoke in the United States, all these places. And the questions never came, and of course I had to nudge them. China, of course, they had 3 people. They had questions which were already, doctored. People had been, told to ask those questions. One was on mountain strike force. The next was that why, if you have come here for friendship, for the sake of friendship, then why are you raising a mountain strike force? You already, given orders for it. So I told them, I said, look, it is not aimed towards China. We are creating a capability. And that capability is basically for national security. It is neither aimed at you, neither at Pakistan. It's a capability we are creating. It is not centric towards China. So anyway, any other question, please? Thank you so much.
Thank you, sir. Now to felicitate General Bikram Singh, we would like to call upon stage the co-founders of NJ Group.
But never turn your back on a drug, 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 on a drug,
Hare Krishna. It's always a treat to listen General Bikram Singh ji. A special thanks is come all the way from Mohali. A big round of applause for General Sir. Shri A.K. Tomar ji also has come all the way from Gandhinagar and also has given immense insights on AI and future cyber risk. उनके लिए भी हो जाए. And all the directors of NJ Asset Management Company अलग-अलग जगह से आए हैं. Devesh ji is here from Baroda. Imtiaz ji यहाँ से ही है, and 2 directors they have already left. They had a train. And my fellow judges, how can I forget Dhirendra ji from Delhi and Sashi ji again come all the way from Mumbai. Right? So I know I'm in between you and जो जिस घड़ी का आपको इंतज़ार है वो तो उसके बीच में मैं हूँ. But let me first thank all of you for participating wholeheartedly. We also have several partners of NJ. They have come from all the parts of India. My wholehearted thanks to all of them. And how can I forget my entire team of NJ Asset Management and NJ Group. We work very closely for making this successful. I am sure आपको मज़ा आया होगा. And जब मैं आप लोगों को देखता था तो हिंदी मूवी का गाना याद आ गया मुझे. कोई लौटा दे मेरे बीते हुए दिन. राइट? तो हमारा ज़माना था तब इंटरनेट नहीं था, गूगल नहीं था, चैट जीपीटी नहीं था, बट जज्बा वही था. राइट? एंड you know, it was very difficult for us. My both fellow judges will agree with me. At least it was extremely difficult exercise for us because all of you were so fine, so meticulous. And when I look at it, मैं जब आपके जितने एज का था, I didn't even have 1% of what you are knowing today. And the way in which you were prepared, it was done, I mean, thoroughly, meticulously, and really, my congratulations to all of you, and also to all the participants who have unable to be to come here. But my congratulations to all of you. एक चीज मैं बता के इमीडिएटली हम रिजल्ट पे आ जाएंगे. जब मैं और जिग्नेश भाई कॉलेज में हुआ करते थे तो वी यूज टू शेयर अ रूम वल्लभ विद्यानगर में, गुजरात में है वल्लभ विद्यानगर, काफ़ी लोगों को पता होगा. तो हम क्या है, रात को 2 बजे जिग्नेश भाई को खाने का शौक था तो मुझे लेके जाते थे चिकोदरा चौकड़ी पे रोटला और सेव टमाटा खाने के लिए. एंड दोज वर द टाइम्स वेयर ऑल द आइडियाज़ वर कमिंग. और कंपनियाँ बनती है राइट हॉस्टल के रूम में. गूगल कहाँ बनी थी? हॉस्टल के रूम में. एंड आई एम श्योर यहाँ पे जो बैठे हैं ना, वो उससे भी कुछ बड़ा करेंगे एक दिन, हॉस्टल के रूम में बैठ के सोच के बड़ा. सो वी वांट कि अब जो भी कंपनियां दुनिया की नंबर 1 बनेगी ना, वो इंडियन कंपनी होगी. वी डोंट वांट टू गिव एग्जांपल्स ऑफ अमेरिकन नेम्स. लेट अस हैव दैट कमिटमेंट. एंड जो सर से हमने सीखा आज, आई थिंक हमें वो इम्प्लीमेंट करने की ज़रूरत है. आई नो द डे हैज़ बीन वेरी लॉन्ग, काफ़ी टायरिंग था, बट वी हैव टू हैव दैट पेशेंस. एंड आई थिंक पेशेंस ऑलवेज पेज. तो जिसका हमें था इंतज़ार एक और गाना, वो घड़ी आ गई है. निर्मय प्लीज़ कम and announce the results. And may I also request both our fellow judges, Shri Dhirendra Kumar ji, CEO of Value Research and Director of NISM, Sasi Krishnan ji, to be on the stage. You've been phenomenal and it was wonderful being a co-judge with you.
Wow, so what an amazing day it has been. Definitely a very long day, and I'm not going to take a lot of your time, I know, but many congratulations to each one of you, irrespective of whatever the result is going to be. Obviously there's a limited people who are going to win today, but that is how life is. But kudos to all of you once again. What Neeraj sir said, what everyone talked about, special thanks to General sir, Ajay Tomar sir, for sharing their insights and enlightening all of us. And the things they shared, I could completely resonate with that and agree to the fact that what you guys have done is truly phenomenal. So yeah, without further ado, let us please first give a huge round of applause to all the judges, all the external judges, Mr. Dhirendra Kumar and Mr. Sashi Krishnan, for spending their valuable time of their busy schedule and coming as judges for the second season of NJFIO. And I would like Mr. Jignesh Desai as well to come on the stage to felicitate them along with Mr. Neeraj Choksi. Please, huge round of applause. I would request all of you to please stay on the stage. And I would also request our chief guest, General Bikram Singh, to join the rest of the people on the stage along with Shri A.K. Tomarji for the prize distribution ceremony. So, how do you all feel now? This is the most, nerve tangling, jittery moment I feel for all of you. A little bit of excitement, a little bit of maybe, heartbeat raising. So, how do you all feel? Like, who do you think? Any guesses? Come on, at least participate. Any guesses? Come on. ISB, okay, okay. Right, so let's not, keep a lot more suspense anyway. So, it's been extremely challenging as Neeraj sir mentioned, and that's why on this special occasion we took a decision extemporaneously that we are gonna give the second runners-up prize to two teams. So there is a tie for second runners-up, and it is IIM Ahmedabad Alpha Vault. So I would request the entire team of IIM Ahmedabad Alpha Vault to come on the stage. Mr. Jitesh Agarwal, Muskan Balotia, Mayuk Sardar, Ranjana Ramesh, and Vyush Agarwal. Along with IIM Ahmedabad, the other team to secure the second runners-up is from IIM Raipur, Alpha Generators, Dharmendra Yadav, Shreya Raghuvanshi, Harshvardhan Tiwari, Aman Kumar Shah, and Astha Bansal. Huge round of applause for both the teams. Both the teams would be getting a check of 2.5 lakh rupees each. So they've done a phenomenal job, and as I said, it was an extremely challenging decision to choose the top three, so we had to choose 4 teams. Many congratulations. Ahmedabad, curated their portfolios and the deep academic ties in their research and the simplicity of IIM Raipur was truly phenomenal. So we'll move ahead now with the first runners-up, and yes, the first runners-up is from the Indian School of Business, Hyderabad, Team Factorial. So huge round of applause to Team Factorial. Akshat Daga, led by Akshat Daga, Vasu Verma, Akriti Sogani, Ishana Kaul, and Nikhil John. Huge round of applause to them as well. They will be awarded a prize money of 3.75 lakh rupees. Again, their simplicity, their clarity of thoughts, the way they articulated it, their go-to-market strategy, their positioning, everything was on point, and they definitely stood out from the rest of the team. And now the final moment is here. Now, I mean, it would be much simpler, much easier to guess, but again, let's not get into the guessing game, and I would rightly call up, let them guess. Okay, so let's make it a bit exciting. So yes, before I say any guesses, it's simple. PDPU, ISP, Mohali, PDPU, any other guesses? Bitsom. Okay, now let's play a small game. Just think of some other team other than yours. Because you're obviously gonna say Bitsom and the rest are gonna say PDPU, but any other guesses other than your team, like the 4 other teams that are remaining? PDU, okay. One last guess. Did someone say Bitsom? Someone else, not you guys. Okay, so let's not get into that. And it is again Indian School of Business, Mohali, Alpha Edge, led by Het Chande, Shubham Bordoloi, Devansh Modi, Devam Gada and Karan Agarwal. Fantastic job that they did, and the coherence that they had in their QVM model, quality value momentum model, their solid analysis, and everything that they did, it was extremely fabulous, and they really differentiated themselves from the rest. Huge round of applause for them. Really loved how they did the 25,000 simulations using the Monte Carlo simulation as well, and how well in a very simplistic manner they could put all of it together. It was truly commendable. Many congratulations once again. And again, many congratulations to rest of the teams as well. PDU, Bitsom, IIM Visakhapatnam, you all did a great job as well. The winner for this NJFIO Season 2 would be awarded a cash prize of 5 lakh rupees. I know there's a paucity of time, but I would request if you guys want to share a few thoughts regarding your experience, hey Chande and your team, please feel free to share your thoughts. If you want to share a few thoughts regarding the same. You can share a few words. Yeah, you can share a few words with everyone if you want to.
So yeah, it was still a very surreal feeling. I think we all started with a blank slate. There was a lot to learn. It was not like we knew what factor investing is. Like we had a basic idea, but it was a tremendous learning journey. And luckily, all 5 of us fell in love with it from the head start itself. And I think it was, to be honest, a much more fun experience. And we were in it for we started with a target to win, but then eventually it was more about falling in love with the subject itself. There were random times when before exams we were discussing about the case comp rather than studying for the exams, because we, like all of us, love finance as such, and then we were just so driven by this that I remember one day before exam we were like, भाई अब पढ़ लेते हैं थोड़ा, PPT कब तक बनाएंगे. So yeah, it has been an amazing journey. That's all.
Yeah, I would like to say the same thing as Hate. Basically, like, we had no idea about the subject. We had no idea what factor investing was. We had to get into it from the very basics. And I think what worked for us was probably going extremely deep into research. We used all the resources that were available to us, and we went deep into research for each and every factor, for each and every decision we made. And I think that helped us even explain everything and provide analysis. So yeah.
I think one more thing was that we used to sit down together and we used to discuss and we used to brainstorm a lot of things. And I think I'm going to miss those moments, but I think it's been really worth it. So.
One takeaway for us was our team was very complementary in the sense everyone brought a separate skill set with them. That helped us put together a lot of different things together. Otherwise, if you notice, this is a very intense competition. You have to do a lot of research on various different factors, go very deep into it, read those research papers, gather some insight out of it. So having a diverse team would definitely help a lot.
So thank you very much, Heth and team from ISB Mohali, and I would request Vineet sir to share his few thoughts and give the vote of thanks. Thank you.
So, very good evening, everyone. I think it's been a fantastic whole day. And we are at the fag end of the session. And first of all, many congratulations to everyone for participation. It was really tremendous work. Tremendous work when I said it was talking about 1,000+ portfolios creation by everyone. And the winners who have come strong, the other team members who haven't won, I think you guys also a winner, right? So a big clapping for you, because your participation, dedication really speaks volumes, the kind of effort you've done. And I'm sure you always have some winner, right? But you always win in the life. And I think keep doing the good work and keep grinding. I think you will get there and you will do much successful as years to come. So what I wanted to do was I wanted to give the vote of thanks to everyone. So it was an honor and privilege to deliver the vote of thanks on behalf of the NJ Group, on behalf of the NJ AMC, to everyone who is present here. But first and foremost, I would extend our heartfelt gratitude to our Honorable Chief Guest, General Bikram Singh Sirji, for gracing us with your presence and your inspiring words. You know, your thoughts, actually when you were sharing it, you know, have truly motivated everyone, including us always. And it's always about, you know, your encouragement and motivation, where students will take a lot from here and there is a lot to learn, right? We also have people thankful to Mr. Ajay Tomar Sirji. I think it's always a pleasure to, you know, hear you and have your presence, and your valuable insights and unwavering support is always welcome, and really thank you, sir. Thank you for coming and gracing this occasion and, you know, giving thoughts about a very important topic today to the students. You know, a very sincere thank you for our distinguished guest. I think our independent directors of NJ AMC, Imtiaz Pirzada Sirji, Sanjay Naik ji is just left, but independent directors of NJ Trustee, Devesh Patak Sirji, Mosmi ma'am, I think thank you so much for coming. I think your leadership and support always steer us towards excellence. We continue to work towards all the good, apart from the business, you know, these kind of events, so that we can, you know, contribute to society. Big heartful thank you and a very big gratitude to all our NJ partners. I think your support and your trust in us and confidence and repose in NJMC is truly valuable, and we really thank you from bottom of our heart. And also a big round of appreciation goes to our participants, right? Our colleagues whose energy, whose talent and hard work, I think, is much said. I think Nirman named everybody, but I wanted to thank a big thank to everyone, no being left, because they have done so well in organizing and orchestrating this whole thing, superbly done. You'll always have some glitches here and there, but when you look at, and I just wanted to mention that this hall where we're having this event wasn't ready, available till 12:30 in the night because of the side door was used by some, a consulate person from Zimbabwe. So the team has to tirelessly work the whole night to get the show ready in the morning. And I think it was a sleepless night, but it went very well. So thank you once again, the entire team. It's a fantastic job. And I really want to thank and clap for them because they've done a fantastic job. And last but not the least, I think our colleagues, when I talk about, I think since I've joined, it's been 5 years in NJ. And it's never feel that we have a different entity. When I talk to HR, when I talk to admin, when I talk to our peers in wealth, I think everybody is like one family. And they always support all endeavors what we do. And without them, I think this all possible is not possible. So thank you so much, everyone from our group and our team members. And I think all the NJ group members can stand, and please, I would want to clap for them. Just please, Dhaval bhai, everybody who's part of the NJ, I think we can just clap for your contribution. Please, please, please. Apurva bhai, Dhaval bhai, really want to clap because everybody, Samanvay, Sarji, Himanshu, I think everyone, Samanvay bhai, Rajiv, I think everybody who's there as part of research team has done so much work. I think you have looked at the teams, but the Spock, everybody has worked so much. Divyajit is standing here. I think we have, please get up. I think we want to showcase everybody. Vineet is here, right? Everybody who has been sitting with the team, mentoring them, telling them what the nuts and bolts of the whole presentation has to be. So I think, and Lakil, I think he has been tirelessly working on giving the system up and ready for them to do work. So really thank you everyone, and really, really dhanyavad from core of our heart. Thank you for making it today, and really, really special. Thank you so much. So with that, it's the end of the day today, and thank you so much once again. Happy evening and a good weekend. And for the winners who are there, we will, it's a AI word, so we'll transfer the winning award to your account. We'll get some details and it will reach you shortly. So don't worry, right? Cheers.